Hello friends, let's start our marathon lecture with a very basic topic, simple topic, GST in India. Not so important for exams, but yes, might be from MCQ's point of view, you may get few questions, and that too importantly only from the two areas where you're talking about certain constitutional aspects for the introduction of GST and subsuming of taxes in GST. Nevertheless, we'll walk through this entire chapter, this being the first topic, GST in India. As you already know that GST is applicable on all goods and services other than supply of alcoholic liquor for human consumption. So Article 366(12) itself tells that GST is on all goods and services, supply of all goods and services other than alcoholic liquor for human consumption. Now let's see the process how GST came out, that is the timeline of GST or genesis of GST in India. Obviously before GST you had other indirect taxes like your VAT, CST, excise duty, service tax, etc., entertainment tax, software duty, etc. Then finally, what made it to come out as CGST, SGST, or CGST, UTGST, or IGST? On certain goods, you may have even compensations. So, what was the entire process of removing the old indirect taxes and bringing the new indirect taxes, which is basically GST? So, it all started in 2004, where the Kelkar Task Force recommended for a fully integrated GST in the year 2004. So long back in 2004, Kelkar Task Force said that okay, let us bring GST in India, and they said that let us bring fully integrated GST, which never happened, but at that point of time that was the recommendation. Thereafter in 2006-07, the former finance minister P. Chidambaram, who was the then former finance minister, he said that we are planning to bring GST from 1st April 2010. So when presenting the budget speech of 2006-07, at that point of time he said that we'll bring GST with effect from 1st April 2010. Again, this never happened. This was tried by that government, but it was not so successful. Then when the new government came into power in 2014, immediately they said that GST is very important. So what they did, they started with the first step, which was amendment of constitution. Normally when an act is passed, you don't require amendment in constitution, but for GST there were two-step process. Step number 1 was amendment of constitution, and step number 2 was making the law. So we are talking about the first step, where you are talking about amendment of constitution, and thereafter it was the second step where you are talking about bringing out the law, that is that. So first step was bringing out the amendment in constitution, which was 122nd constitution amendment bill. It was presented in parliament, then passed by Lok Sabha, then passed by Rajya Sabha. Finally, it was also passed by 50% of the states. So once it was done, 122nd Constitution Amendment Bill was converted to 101 Constitution Amendment Act in 2016. So your Constitution Amendment Bill was presented in 2014, tabled in Parliament in 2014. Then passed by Lok Sabha in 2015 and passed by Rajya Sabha in 2016. And this constitution amendment required both two things. One, it was to be passed by Parliament. Also, it was to be required to be passed by 50% of the states. When both the things happened, it was converted to 101 Constitution Amendment Act in 2016. So it happened in 2016, August 2016. Rajya Sabha passed it. Then it was 50% of the states. Rather, the right date where 101 Constitutional Amendment Act came into effect was your 8th September 2016. 8th of September 2016, your 101 Constitutional Amendment Act was ready. So August 2016, Parliament did work. Then 50% of the states ratified it, and it became 101 Constitutional Amendment Act on 8th of September 2016. Obviously, between the Constitution Amendment and between making the GST law, there was one connecting point which was required, which was nothing but your GST Council. So GST Council was immediately constituted. The provisions were ready on 12th of September 2016, and GST Council was effectively working from 15th September 2016. First GST Council meeting was there in September 2016 itself. Thereafter, there were acts to be passed. Parliament passed your CGST Act, UTGST Act, IGST Act, and Compensations Act. They were tabled as bills in March 2017, and they were passed as Act in April 2017. So Parliament did this work. This was the work to be done by the Parliament. That is CGST Act, UTGST Act, IGST Act, and GST Compensation to States Act. Whereas when you talk about the states, they had to pass their respective SGST Act. Telangana was first to pass the respective SGST Act, and final state was Jammu and Kashmir. So this was done by your legislature of each state, right? So they started passing respective SGST Act, and in between, obviously, when council will recommend, it has recommended all the acts, whether it is CGST, SGST, UTGST, IGST, or Compensation Cess Act. But Parliament did it work by passing CGST Act, IGST Act, UTGST Act, and GST Compensation to States Act, and states passed their respective SGST Act. And in between, obviously, Parliament was also ready with their set of rules. So rules are also recommended in May 2017. And rather, GST was effectively started with effect from your 1st of July 2017. So everything was ready as on 30th of June 2017, except Jammu and Kashmir passing its state SGST Act. And GST was launched with effect from 1st of July 2017. Finally, immediately within a week, Jammu and Kashmir, at that point of it was state, it also passed Jammu and Kashmir SGST Act with effect from 8th of July 2017. So this is how GST came into India. Now let us see the other basics of your indirect taxes and about your GST. Understand that when you talk about taxes, taxes can be bifurcated into direct tax and indirect tax. Remember that DT classic example is your income tax, IDT classic example happens to be your GST. So when you're talking about your basic difference, the main difference, when you talk about your direct tax, you cannot shift the burden. Whereas indirect tax, the burden keeps shifting. Manufacturer shifts the burden to the wholesaler, wholesaler shifts the burden to the retailer, retailer shifts the burden to the final consumer. Actually, the end burden is only bared by the final consumer. Rest all people are collecting taxes from the next person and paying to the government. Only the burden finally shifts to the final consumer. So that happens to be the main difference between DT and IDT. DT you have to pay from your pocket, but IDT you pass it to the next person. That is, you collect it from the next person and pay it to the government. So you don't actually have to feel the pain of it. Other differences, direct tax is on person, including artificial persons, whereas indirect tax is on goods and services, product, goods and services. Also, your direct tax is progressive in nature. The more you earn, the more you have to pay income tax. The lesser you earn, the lesser you have to pay indirect taxes. Direct taxes. This is all about your direct taxes. The more you earn, more you pay income tax. Less you earn, less you pay income tax. Whereas the indirect tax is regressive in nature. Whether your earning capacity is more or less, whether a rich person comes to my place or a poor person comes to my place, when I'm selling my product, I'll sell for the same price and the same GST. So in that way, it is one of the negative feature of indirect taxes, that is, it is regressive in nature. It cannot see you whether the consumer to whom the burden is shifted is poor or a rich person. And to make sure that this regressive effect is reduced, not eliminated, fully reduced, essential commodities will generally have no tax, that is 0% tax, or a very lesser rate of tax, which is say 5% or 12%. So these are the basic difference between your DT and IDT. And when you understand the differences between your DT and IDT, the features of indirect taxes are very, very, very simple and clear. That when you talk about indirect taxes, it is a tax on goods and services. Indirect taxes, it happens to be one of the most important source of revenue to the government. Rather, indirect tax revenue is more than your direct tax revenue. When you talk about your indirect taxes, it has got a wider tax base, and the number of GST registered persons are in fact more than the number of income tax payers, not the persons who are having PAN, income tax payers. Indirect tax and direct tax, the main difference that I said was to differentiate DT and IDT was, in indirect taxes, the burden keeps on shifting. The manufacturer to wholesaler, wholesaler to retailer, and the final burden goes and sits on the shoulder of final consumer. As the burden keeps on shifting, there is no perception of direct pinch. Why? The persons who are contributing to indirect tax revenue, which means the person who are paying to the government, they are manufacturer, wholesaler, retailer. They don't pay it from their pocket. They pass it on to the next person and pays to the government. So they are not at all having the pain of paying the indirect taxes. And the person on whom the burden is shifted, end consumer, he is not having any direct contact or communication with the government. Therefore, most of the times, the end consumer who actually bears the final burden is not having that direct pinch on him. So that is very smooth compared to your direct tax. Indirect taxes is both inflationary in nature as well as regressive in nature. Both are having different meaning. Inflation in nature means it's a change in rate of tax. If 5% is changed to 12%, or if 18% is changed to 5%, that is direct impact on the final pricing. If 5% is changed to 12%, the products are going to become more expensive from the date when the rates are going to change. If 18% is going to become 5%, the products are going to become less expensive from a date when the rates are going to change. So direct effect on the pricing from the angle of end consumer who cannot take any credit. Regressive in nature is the point where you're talking about whether you're rich or poor. It is not having any difference. If the product is having the rate as say 18%, whether you're a rich person or poor person, both of them have to pay the same GST. So that is regressive in nature. And indirect taxes, one of the other features is it indirectly promotes social welfare, because when you talk the highest level of indirect taxes, it will be on sin products like tobacco and alcoholic products. It will have the highest rate of tax. So going by that understanding, it promotes social welfare by telling that if we have the highest rate of indirect tax on all these sin products, then the consumption will be lesser. So these are all the features of your indirect taxes. Now coming to an area why it was important to have GST. So obviously when your earlier indirect taxes are something different, that should be something which is problematic in the earlier indirect taxes which gave the birth or origin to your GST. Now let us understand what are the earlier indirect taxes to understand why GST was necessary. One of the earlier indirect taxes was your excise duty, which was on manufacture of goods, and the revenue went to the central government. The other was your service tax, which was for provision of services, again the revenue of which went to the central government. Whenever I tell that the revenue went to the central government, it would be there under your list 1 of schedule 7. So you will find all these things covered in your list 1 of schedule 7. The next one, which is customs duty, which was there before GST, which is still there after GST, is on import and export of goods. The revenue goes to the central government, which means again it is there in list 1 of schedule 7. Then we had other indirect taxes like your VAT CST, which was on sale of goods, the revenue of which went to the state government. Whenever I am talking about state government, the item would have been covered in your list 2 of schedule 7. Then you had other indirect taxes like your entry tax, which was on entry of goods, reverse of sale, purchase of goods or entry of goods into that particular state or territory. Again the revenue of which went to the state government. Then finally you had other indirect taxes like your entertainment tax. This list is only illustrative list. There are a lot more other indirect taxes. Entertainment tax, which was on entertainment activity, the revenue of which went to either state government or local authority. As India is having 3 tax structures: central government, state government, local authority. So list 2 covers both state government as well as local authority. So revenue of entertainment tax went to both state government as well as your local authority. Now the problem with the earlier indirect tax, these are the basic indirect taxes that you had, general indirect taxes that you had. The problem with earlier indirect taxes was you never got much credit. So when you talk about your industry, generally in your industry you will have either a manufacturer, either you will be a manufacturer of goods or a trader of goods, or you will be service provider. Either of them. Either in the industry, whatever businessman you see, either he will be a manufacturer or a service provider or a trader. Manufacturer got the credit of excise duty. He also got the credit of service tax. He also got the credit of VAT. But he did not get the credit of CST. Also, when you're talking about other indirect taxes, if I'm talking about other indirect taxes, so the moment I talk about other indirect taxes, he did not get the credit. Other indirect taxes, no one got the credit. So manufacturer did not get the credit of CST and other indirect taxes. Even customs duty, he got the credit of 2 elements, CBD and special CBD. When you talk about service provider got the credit of your excise duty. He got the credit of your service tax, but he did not get the credit of VAT, CST, other indirect taxes. So he never got the credit of VAT, CST and other indirect taxes. Manufacturer did not get the credit of CST and other indirect taxes. Both of them got the credit of customs duty, but never both of them got full. Customs duty, small portion was received by manufacturer, which was countervailing duty, which is duplicate of excise, and special countervailing duty, which is duplicate of VAT. And service provider got the credit only of one part of customs duty, which was countervailing duty, which was duplicate of excise, not special CVD. Whereas a trader was so unlucky that he got the credit only and only of VAT. He never got any other credit, be it excise duty or service tax, be it CST, other indirect tax, no. So how you need to remember, manufacturer generally got all the credits but not CST and other indirect taxes. So he got the credit of excise duty, service tax, VAT, but not CST, other indirect tax. He also got the credit of customs duty, but only 2 limits out of 5, CVD, special CVD. Service provider did not get the credit of VAT, CST, other indirect taxes. He got the credit basically of only of excise duty and service tax. Customs duty only one part, which is CVD. Trader was so unlucky that he got only the whole credit of VAT. No other credit he was getting. Now the problem was not getting the credit. After GST, whether you are a manufacturer or a service provider or a trader, first of all, there is no differentiation. If it is purchased from within the state, which is called as intra-state supply, you will get the credit of CGST, SGST or CGST, UTGST as the case may be. If you are purchasing from other state, that is interstate inward supply, it will be IGST, you will get the credit. So, after GST, whether it is intra-state supply or interstate supply, everyone gets every credit. That is the beauty of GST. So, if it is intra-state supply, it is CGST, SGST, get full credit. If it is interstate supply, it is IGST credit, get full credit. So this issue of not getting the credit, now it is a very changed situation in GST. First of all, don't see whether you are a manufacturer, service provider or a trader. Just ask yourself whether the purchase is from within the state or expenses is from within the state. If it is CGST, SGST, get full credit. If it is IGST, get full credit. If it is interstate supply, IGST, get full credit. Right. This was a major reason why GST was brought in. There are other problems or other issues also in your old taxation. Like there was valuation, double valuation, with overlapping of valuation, which means when you're talking about VAT was also charged on excise duty. Excise duty was on selling price, but VAT was on selling price plus excise duty. There were other issues of double taxation, which was more common in your software sector, construction sector. So double taxation was very clear. Food sector, construction sector, software sector, clearly there was VAT as well as service tax. There was also problem of no uniform in nation market, which means when you are purchasing from within the state, it was VAT, you will get credit in certain scenarios. But if you are purchasing from other states, CST, if you see CST, no one used to get credit of CST. So there was no uniformity in the market, and obviously there were multiple taxation. When I tell multiple taxation, there were so many taxes. You need to understand and each of the different taxes and act accordingly. So the major challenge was credit, double taxation, overlapping of valuation. These are the major challenges. Credit was not fully given. There were double taxation, multiple taxation was also there because multiple taxes were also there, and other issue was overlapping of your valuation. Now, when GST was brought in, what happened? First, let us understand the concept of GST, then obviously the advantages that you have with GST coming in. The moment you understand the old indirect taxes and the problems in the old indirect taxes, both these things, concept of GST and advantages of GST is automatic. The concept of GST, just like any other indirect tax, it is a value added tax. You're going to pay tax only on the value addition. Each person pays tax only on his value addition. That is tax multiplied by valuation done by him. There is a continuous chain of tax credit. Everyone gets a credit. Tax paid by manufacturer, output tax paid by manufacturer, wholesaler will get the credit. Output tax paid by wholesaler, retailer will get the credit. The final burden is shifting only on the final consumer who will not get the credit. Everyone else in the chain, right from the beginning till the end, will get the credit except for final consumer. The moment I tell that there is a continuous chain of tax credit, obviously there is no cascading effect. Which means when you get the credit, it is not added to your cost. When it is not added to your cost, you are not adding to your selling price. When it is not adding to your selling price, there is no tax, output tax or input tax. There is no cascading. Only when you don't get the credit, your cost increases, your selling price increases, your final tax increases. When you get the credit, your cost decreases, your selling price decreases, there is no tax on tax, so tax also decreases. So the concept is pretty simple. It is value added tax just like any other indirect taxes. There is full chain of credit, continuous chain of credit. The moment the credits are fully given, there is no cascading. The only person who will not get the credit and who bears the final burden is final consumer. And moreover, there is no differentiation of goods and services. So whether it is goods or services, obviously technically there is a difference between goods and services, but you need not refer to the definition of goods elsewhere in some other act and services elsewhere in some other act. Both the terms are given within your GST law, so you can refer your GST law to understand what is goods and what is services. Now this is the concept of GST, and the moment you understand the earlier indirect taxes, problem in earlier indirect taxes and the concept of GST, advantages are pretty direct. There is one nation, one market, unified nation market. So earlier when I was purchasing from other state, it was CST, no one used to get the credit. Now whether I purchase from my own state, it will be CGST, SGST or CGST or TGST, I'll get the full credit. Or whether I'm purchasing from other state, it will be IGST, I'll get full credit. There is one nation, one market. And as discussed, there is no multiple taxation. There were a lot of other old taxes. There's only GST. There's no multiple taxation. There's no double taxation. Both the problems are solved. Earlier I used to remember a lot of that you have to go through all the other various types of indirect taxes. Now there's only GST. The concept is very simple and neat and clear. So you need not refer to lots and lots of other indirect taxes. So it's only GST. Earlier there used to be double taxation on the same commodity. Say for example you're talking about construction sector or food sector or software sector. You need to pay VAT as well as CST, VAT to the state government as well as CST to the, or as well as service tax, VAT as well as service tax, VAT to the state government and service tax to the central government. Now there's no double taxation problem. Earlier the credits were not fully given. When the credits were not fully given, there was cascading. When you don't get the credit, it gets added to your cost, added to your selling price, tax on tax will be there. So earlier there used to be cascading, but now there is no cascading. And it also promotes Make in India initiative, because now the foreign investors are very much interested in investing in India because of the economy of India, because of the population of India, also because of the fact that India has implemented GST. Because GST is there around in 165 plus countries already, out of 200 odd countries. So foreign countries are already well aware of the concept of GST. So when they are investing in India, their headache is reduced. They need not see lot of other taxes. They need not be worried about double taxation. They are already aware of the concept of GST. Pan India, they can appoint only one consultant. So it makes the job easy for the foreign investors, which will promote Make in India initiative, which will promote foreign companies to invest and manufacture in India. Also, when you talk about government revenue, in the long run, it is going to increase. These are the basic advantages of GST that you can foresee. Very clear advantages now that we have already crossed more than 5 years. So it's very clear that these are the advantages of GST, that all these advantages you can clearly see. One nation, one market, no double taxation, no multiple taxation, no cascading, full credit. Make in India initiative is now showing the results, and government revenues also increased drastically. These are all the advantages of your GST. Now talking about the constitution provisions. Now this is a place where you can expect a few questions basically in MCQs. So when you talk about the constitution provisions, again simple understanding of constitution. What is quickly we'll walk through areas and we'll highlight on those areas where your questions may be asked. Now in India, whenever you want to have any tax, you need to have a law. So no tax can be levied or collected except under the authority of law. So for having tax, there should be law, nothing but Article 265. So for a tax to be levied and collected, that should be a backup called as law. Now next question which will arise, that who will make law? Laws are either made by Parliament or state legislature. Parliament for the whole of India or part of territory of India, or state legislative assembly for the whole of state or part of the state. So for a tax to be there, law to be there, law should be there. Article 265. Laws are made either by Parliament or legislature of state. Article 245. Now which law is made by your Parliament and which law is made by your legislature of state is answered by Article 246 read along with Schedule 7. So which law made by Parliament and which law made by your state legislature is discussed in your Article 246 read along with Schedule 7. So few laws can be made only and only by Parliament. List 1. So if your laws are listed in list 1, union list, only and only Parliament can make those laws. Few laws are listed to state list, where laws can be made only and only by state legislative assembly. And few laws are listed in list 3 concurrent list, where both Parliament and state legislative assembly together can make laws work. Examples, when you talk about your customs duty, excise duty, service tax and all, they were there in your list 1. Right, where only and only Parliament can decide. Example, where the tax laws were under list 2 was your nothing but excise duty on alcoholic liquor, narcotics, opium, state excise duty, call it as, not the normal central excise duty, it is state excise duty, VAT, and you're talking about entertainment tax and all. They were there only on your list 2, where only state legislative assembly will have powers. List 3 never ever had any tax items. Even after GST, it is not having any tax items. Rather, when GST was about to be launched, the right place where GST could have been placed was list 3, because both Parliament and State Legislative Assembly will have concurrent powers. But finally, it was decided that GST should not be there in list 3 because it is having a problem. What is the problem in list 3? List 3 is to be read along with one article called as Article 254, which tells that there is supremacy of Parliament. Whenever there is a dispute between Parliament and State Legislative Assembly, whatever Parliament tells, State Legislative Assembly has to necessarily follow the same. So that is called as supremacy of Parliament. That was the exact reason why GST is not placed in list 3. So when you see your GST is placed in a new article called as Article 246A. So the birth article of GST is Article 246A. Article 246A, where now Parliament and State Legislative Assembly will have concurrent powers to make the laws of GST. Also, there will not be any supremacy of Parliament, which means if there is any dispute, that will be settled in a manner which is prescribed in your GST Council, which you are going to see Article 279A. Right, so there's no supremacy of Parliament in Article 246A. Birth article of GST, friends, it is Article 246A. Be very, very clear. Article 246A is the birth article of GST. But it comes with a caveat. There are few items which can be done only and only by Parliament. Which means normally when I tell GST, it is to be decided both by Parliament and State Legislative Assembly. Article 246A. But there are few items which is decided only and only by Parliament. Basically only two subject matters. Whether a supply is interstate supply or intrastate supply is to be decided only and only by Parliament. They will decide place of supply. So for a transaction to be called as interstate supply or intrastate supply, you require location of supplier and place of supply. That will be decided only by Parliament. State Legislative Assembly will not have any role. Also, when you talk about distribution of IGST revenue, so whenever you talk about CGST revenue goes to central government's pocket, SGST revenue goes to state government's pocket, or if it is UTGST revenue, it will go to union government pocket. Rather, central government will have it if at all it is controlling those union territories. But when you talk about IGST revenue, will go to central government's pocket. Finally, it will be apportioned between central government and state governments by the law which is drafted by Parliament. So IGST revenue does not go fully to central government's pocket. Partly it will be kept by central government, partly will be given to the states, but on what principles? On the principles set by Parliament. So Parliament will decide two things. Whether a supply is interstate supply or intrastate supply, that is drafting place of supply rules is only done by Parliament. If it is IGST, that revenue goes to partly to central government, partly to states. Now which states, what is the formula? All is decided only and only by Parliament. Welcome to Article 269A. And there's an article called as Article 279A, which is GST Council. Rather, please remove that. Without GST Council, nothing can happen. Everything inside GST only happens under the control of your GST Council. Everything. It is only through your GST Council that everything that happens is happening only through your GST Council. Now, GST Council, if you see, immediately at the moment your 101 Constitutional Amendment Act was ready on 8th of September 2016, the first of the day work. Within 4 days, 12th September 2016, GST Council provisions were ready, and it got the assent of the president, and it started functioning from with effect on 15th of September 2016. Rather, the first GST Council meeting was then and there held in September 2016 itself, because in GST nothing can get amended without the consent of GST Council. That is the importance of GST Council. Now, before going to the other aspects of GST Council, what all works GST Council does? If you see, the list of works are very lengthier. Finally, you need not remember anything for exams. What tax will be there, subsidy inside GST, what will not be there is decided by GST Council. What will be the rates on the goods, what will be exempted, what will be the threshold limit for registration, what will be the threshold limit for composition scheme, decided by GST Council. The model GST laws which are brought before GST came into existence were prepared by GST Council. How IGST will be apportioned, GST Council. Place of supply rules, GST Council. Date when the petroleum products which are temporarily now outside GST, temporarily they might come inside GST at any point of time. Which date will be decided by GST Council. Special rates during special circumstances like calamity or floods and all. So you may have special rates in a particular state or a territory, that is decided by GST Council. You have special category states, that is for GST special category states are Tripura, Manipur, you are talking about Mizoram and Nagaland. So Tripura, Manipur, Mizoram, Nagaland, special category states. There are special provisions for them, special threshold limit, special limit for composition scheme, decided by GST Council. If at all there is any dispute between two governments, dispute will be settled by GST Council. Any other matter, just remove this way. Anything in GST is to be decided only by GST Council. So any changes are going to come, anything that is a problematic situation where something has to be resolved, everything is done by GST Council. Now coming back, so you need not remember for your exams, everything is done only and only by GST Council. Now when you talk about GST Council, the chairperson of GST Council is the Union Finance Minister, and the vice chairperson will be decided by the members who are there in GST Council. Now you may ask, how many members are there? Center has got two members. One is Union Finance Minister, who is the chairperson, and one more member which is Union Minister of State, who is in charge of finance or taxation. So there will be a communicating person between the Union Finance Minister and the State Finance Minister. He is the Union Minister of State. Again, he is a central minister, the Union Minister of State, who is in charge of finance or taxation. Now when you talk about states, there are 31 representatives. Understand that in India you have 28 states plus 3 union territories, which is your Delhi, Puducherry and Jammu. Delhi, Puducherry and Jammu, they will be treated as states for the purpose of GST. Jammu and Kashmir is no more a state, it is 2 union territories, one is Jammu and one is Ladakh. But when you talk about GST considers as number of states as 31, 28 normal states plus 3 special. That is 3 union territories which have assemblies which will be considered as state. They are Delhi, Puducherry and Jammu and Kashmir. So when you have talk about states, there are 31 states, and in GST Council meeting or GST Council members, all the states will have a person. So State Finance Minister or his nominee will be sitting in the GST Council. So total members of your GST Council is 2 of center and 31 of state. So 33. Now, how your GST Council matters will get resolved? First, understand that for a GST Council meeting to start, there should be quorum, and quorum is 50% of the total strength, which means only if total members are 33. So only if 17 members are present, GST Council meeting will start. If quorum is not present, meeting itself is not start. So only when minimum of 17 members out of 33 members are present, GST Council meeting will start. Other than if at all these members are not present, GST Council meeting itself will not start. Now next important thing to understand that how the matters are decided in GST Council. Supposing a GST Council meeting is there to discuss on 10 points which are there in the agenda. Each of the point has to be seen whether it is passed or failed, whether this change will come or not come. So that is decided by 75% of the weighted average members present in voting. The weight about the pass percentage is 75%. This will be done for all the 10 points. If at all GST Council meeting is on 10 points, for all the 10 points, you are going to apply the 75%. Out of 10 points, 3 points may pass and other 7 points may not pass. So for each of the point, you have to see whether you are getting 75% pass percentage. Understand that the 75% pass percentage, that is 3/4, is weighted average. It's not a simple average, it is weighted average. 1/3 weight is given to center and 2/3 weight is given to state. And when you're counting the percentage, only count the members who are present and voting. Only those who are members are present and voting, you have to decide. So total members, you do know, center is 2 and state is 31. Supposing members present and voting, center is 2 and state is say 20. Supposing you're talking about members in favor. So one of the point is discussed that members in favor are 2 and states 10. So understand first thing that you should check the quorum, whether quorum is present. Yes, quorum is present. Then calculate the pass percentage. Then calculate the percentage, whether how much percentage is there. When you're calculating the percentage, understand that calculate in this way. Center 2 are in favor out of 2 and 1/3 weight is given to the center. State total 10 are in favor out of how many? 20 who are present and voting. So when you are seeing this percentage, forget about total members present and voting, and 2/3 weight is for state. So when you see the percentage here, center you will have 33.33% and state you will again have your 33.33% in this particular case. So the percentage that works out is 66.67%, which means it will not pass. So whatever is the subject matter being discussed, out of 10 items we are discussing only about one item, it will not be passed. So this is how you have to calculate. Step number 1, see whether quorum is present or not. Step number 2, if quorum is present, see the percentage. If it is more than 75%, that matter is passed. Other matters you have to again see the votings and see whether it is passed or not. That is how you work out whether a subject matter is passed or failed. Now, when you talk about your taxes subsumed inside GST, there is a big myth. The first aspect that usually comes in your exams was your constitution provisions, MCQs that we have discussed. Second aspect, taxes subsumed in GST. It is a normal thing that is being asked. So when you talk about taxes subsumed in GST, central taxes which are subsumed in GST, state taxes which are subsumed in GST. When I tell that taxes are subsumed inside GST, it means that they are no more there. These taxes are not there, now they have become GST. Now there is a myth that all the indirect taxes are subsumed inside GST, which is not true. Which is not at all true. Now understand that when I talk about central taxes which are subsumed inside your GST are your excise duty. Whether it is central excise duty or additional excise duty or excise duty on medicinal and toilet preparations, they are subsumed. So it is first excise duty. So this, make it as one point, excise duty. Second, you have your customs duty, but understand that customs duty used to be BCD, CVD, education cess, secondary education cess and special CVD. So customs duty before GST was basic customs duty, CVD which is nothing but duplicate of excise duty, education cess, secondary education cess and special countervailing duty, counterbalancing duty which is nothing but duplicate of VAT. Now after GST, BCD remains, customs duty is still alive, customs duty is not merged into GST, customs duty is still alive. CVD and special CVD, they have become IGST. Now there is no education cess, secondary education cess, it is replaced by social welfare surcharge. So education cess, secondary education cess has merged into social welfare surcharge. It has got nothing to do with the birth of GST. But CVD and special CVD, now they are no more there. They are merged into IGST. So customs duty, understand that whenever the goods are imported, it is customs duty, is not GST. Now, in today's context, customs duty breakup is basic customs duty, social welfare surcharge, and IGST. There's no more CVD, special CVD. When excise duty and VAT is not there, their duplicate CVD and special CVD cannot be there. So now it is replaced by IGST. I repeat, when the goods are imported, it is only customs duty. Don't call it as GST. Customs duty, and the breakup of customs duty is BCD, social welfare surcharge, and your IGST. That is second is CVD and special CVD of customs duty. Now it is replaced by IGST. You have service tax, which is no more there. You have CST. CST is levied by center but collected by state. So levy was by center, so we are seeing in the central list. Revenue goes to the state government, but later levy was by central, CST. Last point you need not see because it is talking about surcharge and cess on these taxes. These are the four central indirect taxes which are no more there. Excise duty, whether it is basic excise duty or additional excise duty or excise duty on toilet and medicinal and toilet professionals. So we call it as excise duty. Customs is still alive, but CVD, special CVD of customs has now become IGST. Today's breakup of customs duty is BCD, SWS, IGST. Service tax is no more there. CST is no more there. Other central indirect taxes, like if I am talking about your air travel tax, still alive. All other central indirect taxes, they are still very much alive. Only these are the central. Others central taxes, indirect taxes may be there. Small amount will be there, but they may be there. One of the example I have given, air travel tax, still very much alive. Now state taxes that are subsumed, that are no more there, is your VAT and sales tax is gone. Reverse of that is entry tax or purchase tax, that is also dead. Taxes on advertisements, dead. Taxes on betting, gambling, lottery, dead. When I tell dead, they are now merged into GST. Luxury tax, dead. Entertainment tax by state government, dead. If it is by local authority, it is still very much alive. So there are other central taxes like your road tax, still alive. Entertainment tax by local body is still alive. Entertainment tax by state government is dead, but entertainment tax by local authority or local body is still alive. So what are the central state taxes that are dead? VAT, sales tax, entry tax, purchase tax, advertisement tax, betting, gambling, lottery tax, luxury tax. And when you were talking about entertainment tax by state government is dead. It's gone. But entertainment tax by your local authority or local body is still alive. Road tax is still alive. So you need to understand that these are only 6 state indirect taxes which are dead. Other state indirect taxes which may be small in amount, but they are still alive. Last point again, it talks about surcharge and cess, not so important. Now, when you talk about subsuming of taxes, associated point you should know that there was some negotiation with the state governments to bring inside GST. So there are some special products on which even today you have excise duty and VAT. Let us discuss those products. So first of those products you are talking about alcoholic liquor for human consumption. I am not talking about other alcoholic products. We are not talking about raw alcohol, industrial alcohol that attracts only GST. That is having only GST. I am talking about alcoholic liquor for human consumption. It is permanently kept outside GST. It's seen in the beginning that it is from Constitution itself. It is said that it is outside GST. And the tax on it is state excise duty and state VAT. Both of the revenue goes to the state government's pocket. State excise duty, state VAT. And the next item is 5 notified petroleum products. Not any petroleum products. Petroleum crude, high speed diesel oil, motor spirit, which is commonly your petrol, natural gas, aviation turbine fuel, which is used in airline, white petrol. These 5 notified petroleum products, which are permanently not outside GST, only temporarily they are outside GST. They are not permanently kept outside GST. As of now, they are kept outside GST. When GST Council wants, they can bring inside GST. These items will have central excise duty and state VAT. If you see, the first item was state excise duty, state VAT. Both revenue will go to state government. Now it is central excise duty will go to central government. State VAT or CST will go to state government. Please understand the difference. Alcoholic liquor for human consumption is permanently outside. GST, which means GST can never be there, constitution amendment will be required, and they are having state excise duty, state VAT. Both state excise duty goes to the pocket of state government, state VAT CST also goes to the pocket of state government. Whereas 5 notified petroleum products, if it is other than these 5 notified petroleum products, it is only GST. So 5 notified petroleum products, that is petroleum crude, high speed diesel oil, your motor spirit, that is commonly called as petrol, aviation turbine fuel, light petrol, natural gas. On them it is central excise duty which goes to the central government's pocket, and state VAT CST which goes to the state government's pocket. Plus they are not permanently outside GST. As of now they are outside GST. GST Council can bring them inside. When it is coming inside GST, it will be having only GST, not these taxes. Now there are certain other items which is having both GST and other taxes. Like when you are talking about your tobacco, it is having central excise duty plus GST. So that is central excise duty. Along with that, there is GST. So tobacco and tobacco products will have central excise duty plus GST. So it is not inside, outside GST. It is inside GST, but other taxes are also there. Indian hemp, opium, narcotics and narcotics drugs. So when you are talking about Indian hemp or opium, narcotics, narcotic drugs, it will have state excise duty plus GST. So along with GST, there will be state excise duty. First, it will be state excise duty, and GST will be on price plus excise duty. So when you talk about tobacco and tobacco products, it has got central excise duty plus GST on price plus central excise duty. You talk about Indian hemp, opium, narcotics and narcotic drugs, it has got state excise duty plus GST on price plus state excise duty. So they are inside as well as outside GST. GST will be there along with other taxes. Now if you see all these 4 items carefully, none of the taxes are common, which means clearly you can easily find that the taxes are all separate. If it is alcoholic liquor for human consumption, it is state excise duty, state VAT. 5 notified petroleum products, central excise duty, state VAT, not state excise duty. When you talk about tobacco products, there is no VAT now. There is no VAT. It is central excise duty, GST. If you are talking about Indian hemp, opium, narcotic drugs, state excise duty, GST. You have to be very, very careful with what is the item, then decide. And as GST was brought in, government also knew that there will be some unforeseen losses which may be there. And initially, whenever certain items which has got compensation cess, initially that compensation cess will be, for the first 5 years, this entire compensation cess will be distributed to the states. So compensation cess is basically on posh items or items which are sin items, right? So highest rate as of now in GST is 28% plus compensation cess. Though GST rate can go up to 40%, normally you have seen that it is only 28% plus compensation cess, which can be more than even 100%. So compensation cess is actually belonging to the central government, but for initial 5 years, central government said that we will give the entire compensation cess to the state governments, depending on which state government has occurred what amount of loss. Right, so that is all in all about your GST in India. This entire area, when we discuss subsuming of taxes and special items, this area automatically gets covered. And in India, we have gone for dual model of GST. Dual model of GST. We have interstate supply as well as intrastate supply. If it is from one state to another state, IGST. One state to union territory, IGST. Union territory to another union territory, IGST. Same state to same state, it is CGST plus SGST. Same union territory to same union territory, it is CGST plus UTGST. So what is the dual model? Either it is intrastate CGST plus SGST or CGST plus UTGST, or it is interstate, it is IGST. We have gone for dual model of GST. So that is everything about your GST in India. Yes friends, now let us discuss about an important topic called as Levy of GST. Again, mark wise, you can expect few questions on supply either as a separate question, which normally does not happen, or as a part of a big question. So you can expect questions on supply as well as you can expect questions on your composite supply, mixed supply for sure. Generally, they are asked as a part of a bigger question. So when you talk about levy of GST, basically we are talking about charging section. As already discussed, GST applies to whole of India, including the state of Jammu and Kashmir. Then it was a state, now it is 2 union territories. So GST is applicable on both Jammu and Kashmir as well as Ladakh. And friends, when you talk about the charging section, what is the charging section for your GST? It's section 9. Section 9 of CGST Act. And when you're talking about IGST Act, it is section 5 of IGST Act. So charging section of GST is section 9 of CGST Act read along with section 5 of IGST Act. So when you talk about the charging section, what are the 6 P's that are required for the charging section? One is your product, one is your process, one is your place. Then you have price, that is valuation. Then you have percentage, that is classification. Finally, who's to pay GST? Person. So you make it as 3 P's plus 3 P's plus 3 P's. So first 3 P's, product, process, place. Next 3 P's is about basically about collection, price, percentage and person. When you talk about the product, what is the product that is there? You're talking about the product being goods or services. Either they are goods or services. Goods means every kind of movable property, and service is a very simple thing, anything other than goods. So goods is every kind of movable property, whether tangible or intangible. Services, everything other than goods. Both goods and services will not include money and securities. So money and securities is neither goods nor services. Product, place. When you talk about product, other process. Process is supply. The process that you have is your supply. Right? No more using the term sale or service. It is supply. That is the process. And place, when you talk about your CGST Act, you call it as intrastate. And when it is about IGST Act, it is interstate. That is the only difference where you find between section 9 and section 5 of CGST Act and IGST Act respectively. So when you see CGST Act, they are talking about intrastate supply, which will have CGST plus SGST or CGST plus UTGST. When you see the corresponding provision of IGST Act, which is section 5, you will find interstate. Once you cross the first 3 P's, then you have the next 3 P's. Price is nothing but valuation as per section 15. Valuation will be discussed in your section 15. This is just a separate chapter by itself, section 15. Price, percentage. Now percentage that you have percentages where it is 0 or 5 or 12 or 18 or 28. It might be even special rates like 0.1 or 0.25 or 1%. Right? Percentages, the maximum CGST rate that you can have is 20%. Maximum SGST rate or UTGST rate that you can have is 20%. Whereas the maximum IGST rate, again there's a difference here, is 40%. So in CGST Act, you'll have maximum CGST rate, which is 20%. And in IGST Act, you have maximum IGST rate, which is 40%. So whenever you are referring to percentages, normal rates are 0, 5, 12, 18, 28. So when I talk about 28, it is 14% CGST, 14% SGST or IGST 28%. So when I talk about say 12%, 6% is CGST, 6% is SGST. If it is intrastate supply, if it is interstate supply, it is 12% IGST. So again, there's a difference. So when you see your CGST Act, you will find the maximum CGST rate as 20%, IGST Act maximum IGST rate as 40%. And the person who is required to pay tax, normally supplier collects the tax from the recipient and pays to the government, which is forward charge mechanism. But at times it can be reverse charge mechanism also, where recipient has to pay tax himself. So person who is going to pay tax is taxable person. So normally when you talk about taxable person, he is the supplier. Can recipient be the taxable person? Yes. Taxable person means the person who is registered or who is liable for registration. So normally who pays the tax? Normally it is supplier. He will collect tax from the recipient and pays to the government. So he is responsible to the government. But at times it can be even your recipient. In RCM cases, supplier will not pay tax, it is recipient who will pay tax. Rather, when you talk about RCM, there are 2 types of your reverse charge mechanism. One is section 9.3, one is section 9.4. So RCM type 1, RCM type 2. So you have 2 RCMs, RCM type 1, RCM type 2. That is given in section 9.3, 9.4 of CGST Act, 5.3, 5.4 of IGST Act. And 9.5 is all about ECO, where neither the supplier pays tax nor the recipient pays tax. It is third person, electronic commerce operator through whom the supply is made, he will pay tax. That is for notified categories. This entire discussion will happen when we talk about your reverse charge chapter. So 9.3, there are two types of RCM, 9.3 RCM, 9.4 RCM. In IGST Act, 5.3 RCM, 5.4 RCM. And there is one type where neither the supplier pays tax nor the recipient pays tax, which is your 9.5 of CGST Act or 5.5 of IGST Act, where electronic commerce operator through whom the supply is made, that will pay tax. All the discussion, everything about ifs and buts about this 9.3, 9.4, 9.5 will be discussed in a separate chapter called as your RCM chapter. Now, one provision is left out where you are talking about section 9.2. Section 9.2 very clearly tells that these 5 notified petroleum products, which you have already discussed, crude, petroleum crude, high-speed diesel oil, motor spirit commonly called as petrol, natural gas and aviation turbine fuel, as of now, there is no GST. They are temporarily kept outside GST, but in future they may be brought inside GST on recommendation of GST Council. This is said in section 9.2 of CGST Act, correspondingly section 5.2 of IGST Act. So when you see a charging provision, that is all about your charging section, section 9 of CGST Act, read along with section 5 of IGST Act. There is one special point in IGST Act which is not there in your CGST Act. This is the special point that we are talking about. This special point tells that whenever goods are imported, you will have customs duty. The breakup of which is basic customs duty, SWS and IGST, which we have discussed some time back. So whenever there is customs duty, you will have BCD plus SWS plus IGST. So IGST portion you will have to come to IGST Act, but that IGST Act will again take you to Customs Act and Customs Tariff Act. So understand that when the goods are imported, it is only customs duty which is there. The breakup of which is basic customs duty plus social welfare surcharge plus IGST and compensation cess. And whenever you are talking about the IGST portion, understand that import and export can only be IGST, interstate. So that IGST portion you will come to proviso to section 5.1 of IGST Act, which will again tell that customs duty includes IGST, but finding out valuation for IGST and classification of IGST, you again go back to Customs Act and Customs Tariff Act. So that is there only and only in IGST Act, not there in CGST Act, because understand that import is always interstate. Right, so import of goods, please make one thing very clear, that is customs duty. BCD, SWS, IGST, breakup of which is BCD, SWS and IGST. For IGST, you come here to IGST Act, but again go back to customs law. And if it is import of services, it is only IGST. There is no customs, only IGST. Now, we are talking about the most important definition of this chapter, which is supply. Rather, this entire discussion chapter is only about the term supply, and final part is about composite supply, mixed supply. So when you talk about the discussion, if you see product, which is goods and services, we have discussed. Process, supply, we are going to discuss. Place, intrastate, interstate, we have already discussed. Understand that if it is from one state to another state, interstate supply, IGST. State to union territory, interstate, IGST. Union territory to another union territory, interstate, IGST. Same state, from that state to that state, it is CGST plus SGST. Same union territory, from that union territory to the same union territory, it is CGST, UTGST. But even within the same state, if it is to special economic zone, supposing if it is from Maharashtra to Maharashtra, special economic zone, it is IGST. So that's an exception. If it is from Delhi SEZ to Delhi normal place, it is again IGST. So even within the same state or same union territory, it can be IGST transaction if the supplier or the recipient is special economic zone. So that is an exception. So product we know about it. Place also we have discussed. Now we are focusing on the process, supply. So when you talk about the term supply, supply is defined in section 7, not defined in section 2. Normally definitions are there in section 2, but supply is so important that it is defined in section 7. Taxable event is supply. Supply you have to bifurcate into 3 parts. First being actual supply, then we are talking about deemed supply, then you are talking about not supply. So once it is supply, then you discuss whether it is supply of goods or supply of services. So you have 3 parts: actual supply, deemed supply, not supply. When you talk about actual supply, there are three elements present in it. There's activity, any activity, business, it is in course or furtherance of business, and consideration should be there. They have given 8 examples like sale, transfer, disposal, barter, exchange, license, lease, rental. These are only examples. Forget about it. What is the activity? Any activity. ABC. Remember ABC. Activity, any activity. Business, it should be there. Activity should be there. Business should be there. Any activity, business is in course of furtherance of business. You are doing that activity in course of furtherance of business, and you are getting consideration. Consideration should be present. So you are doing any activity in course of furtherance of business, and you are getting consideration. So if all three are satisfied, it is actual supply. It is actual supply. As I said, actual supply has got two parts. Section 71A, Section 71AA. Deemed supply has got two parts. Section 71B, Section 71C. And not supply has got two parts. Section 72A and Section 72B. Everything has got two parts. Now, actual supply, second part, is only talking about club and the members. The transaction between club and the members. So, activity between club and the members, either by club to the members or by members to the club, for consideration. For consideration. It is actual supply. This again, understand that this is only to overrule a Supreme Court judgment which recently said that activity by an unincorporated club to the members or members to unincorporated club is not at all supply. To overrule the judgment, there is an amendment which is brought, which is telling that activity, any activity, what activity? Any activity. By whom? Club to the members, that is unincorporated club to the members or members to the club, will be treated as supply if it is for consideration. Understand that here also activity is any activity. Here also, when you talk about club to the members, member to the clubs, if you see the definition of business, business includes one of the definition. This definition of business is 2 plus 2 plus 5. There are 5 specific clarification. One of the clarification of business is any work done by club to the members or members to the clubs for a consideration is business. So business is by default present because of the definition of business, and it should be for consideration. Again, all the three elements are present. Activity, any activity. Business, by default it is present because when club is giving anything to members or members is giving anything to club for consideration, it is treated as business by the definition of business, and consideration is present. Right. So again, the same three things. This you need to understand that this is again clarified or given only to overrule a Supreme Court judgment which stated that it is not supply. Now that Supreme Court judgment need not be seen. It is specifically brought in the definition of supply itself, that any activity by the club to the members or members to the club for a consideration is treated as supply. So activity, any activity, consideration should be there. Business is implied. It is not directly given. It is implied because when you see the definition of business, club to the members or members to club for consideration is treated as business. So that is the second part of actual supply. So actual supply, rather the second part of actual supply is more of a clarification. It was already covered in the first part. More of a clarification to overrule a Supreme Court judgment. Then friends, we are talking about deemed supply. So when you talk about deemed supply, it is given in two parts. Deemed supply part 1, deemed supply part 2. Deemed supply part 1 talks about only importation of services. The activity which is only there is importation of services. The only activity where it is talking about is importation of services. Business may be there, may not be there. Consideration should be present. Importation of services, business may be there, may not be there, but consideration should be present. So this is your deemed supply. So here the focus is on importation of service. Importation of service. So business may be there, may not be there. Business may be there or may not be there, but consideration should be present. Importation of services. Right. Likewise, when you see deemed supply part 2, it is talking about schedule 1 4 cases. Activities only schedule 1 4 cases. Activities only schedule 1 4 cases. Business, when you see all the 4 points, business is silently there, though not specifically said, but business is silently there. Consideration is not there. Consideration is not there. So when you talk about schedule 1 4 cases, they are talking about business should be there silently. But if you see the specific points, they're not talking about business, but when you see all the 4 points, you'll find that business is silently there. Consideration should not be there, whereas because the other name of Schedule 1 is supply without consideration. Now let us see this supply without consideration point to understand what it is trying to tell. So when you talk about supply without consideration, Schedule 1, they are talking about 4 aspects. First is, whereas when the moment you talk about Schedule 1, it is supply without consideration. Consideration is absent. The first point is permanent transfer or disposal of business assets on which ITC has been availed. Look at the conditions. First, you are talking about permanent transfer or disposal. So the transfer should be permanent. Transfer or disposal of business assets on which ITC has been availed. Basically, you are talking about gifts or free samples. Gifts or free samples, and the coverage here, friends, is only and only your goods. They are not talking about services. Permanent transfer or disposal of business assets on which ITC is availed. So if I am giving you gifts or free samples on which I have availed ITC, I have to pay output tax, it is deemed supply. But if I am giving you gifts or free samples on which I have not availed ITC, if I have not taken ITC, then it is not covered here. I need not pay any output tax because it is not my deemed supply. Remember friends, when you're talking about this para 1, they always ask yourself a question. If ITC was availed on what is given as gifts or free samples, then you need to pay output tax as it is deemed supply as per Schedule 1. If ITC was not availed on the purchase or ITC was availed and later on reversed, then what is given as gifts or free samples, you need not pay output tax because it is not deemed supply as per Schedule 1. Now second part of Schedule 1 talks about supply of goods or services. Friends, here the coverage is of both goods and services between related person or distinct person in course or furtherance of business. In course or furtherance of business, but it should be between related person or distinct person. Understand, when you are talking about related person, distinct person, you need to understand what is meant by related person. Now related person has got 4 parts. The first part discusses about your members of the same family, employer-employee, legally recognized partners, officers or directors in each other's business. So related person totally has to split into 4 parts, where the first part talks about you are talking about either your members of the same family or employer-employee or legally recognized partners or officers or directors in each other's business. First part. Now your second part is talking about either, supposing we are talking about VJ and PJ, supplier and recipient. Either both of them are controlled by third person SRK, or both of them together controls third person, say SRK Limited. So either both of them are controlled by third person or both of them together controls third person. So that is the second part. Third part, one of them controls the other. So either VJ controls PJ, supplier controls recipient, or PJ controls VJ, recipient controls supplier. Now the fourth part is a clarification or an extension of second part, where it tells that third person means say SRK, who's neither the supplier or recipient. Third person is owning, holding or controlling 25% of holding stock in both of them. Both of them means supplier and recipient, VJ and PJ. Third person, you're talking about third person. So when you look at the definition, they have got 4 parts. One is first part, which talks about 4 small aspects, which are members of the same family, employer-employee, legally recognized partners and officers or directors in each other's business. Second part, either both of them, which is supplier and recipient, VJ, PJ, are controlled by third person, SRK Limited, or they are together controlling third person, SRK Limited. Third part, one of them controls either VJ Limited controls PJ Limited, or PJ Limited controls VJ Limited. Supplier controls recipient, recipient controls supplier. Fourth part, third person, that is SRK Limited, is having more than 25% both in VJ Limited supplier as well as more than 25% in recipient PJ Limited. Then VJ and PJ are related person. Now, these 4 parts are there. You see the first part, it covers employer-employee, important point to discuss, and it also covers members of the same family. Remember, family is equal to, if you're talking about your children and spouse, without any condition they are family. Children and spouse are family unconditionally. But when you talk about parents, grandparents, brothers and sisters, they are members of the same family only if they are wholly or mainly dependent on you. So very important aspect, ICS tells us many a times. So when you talk about brothers or sisters or parents or grandparents, they are your related person. That is, they are members of the same family only if they are wholly or mainly dependent on you. So if I am getting a service from outside India, from my brother who is a well-known advocate, and I am well-known businessman in India, both are independent. So when I am getting that service from him, it is not a related party transaction. Why? Because he is my brother, and my brother is my related person if he is dependent on me. So when I said my brother is a well-known advocate in London, then he is independent and I am a well-known businessman in India, I am independent. So we are not related person. So members of the same family, be very careful. Spouse and children, whether they are dependent or independent, they are members of the same family, related person. But brothers, sisters, parents, grandparents, they are members of the same family, that is, they are related person only if they are wholly or mainly dependent on me. Now talking about this part, there is an important exception here. If at all, you are talking about, we have discussed related person here, there is one more person, distinct person. Distinct person means branches of the same company. Branches of the same company having different GST number. So whenever a company is having branches in two different states, for sure they'll be having different GST number, they are distinct persons. Understand that branches of the same company within the same state, normally they are not distinct person. There is no supply. So branches of Reliance Limited in Tamil Nadu and Maharashtra, they are distinct persons. Supply between them is deemed supply. Because for surely they'll be having different GST number or they are required to take different GST number. But if two branches are of Reliance Limited within Tamil Nadu, then they are not distinct persons. There is no supply, there is no deemed supply normally. But again there is an exception. Two branches within the same state, they can opt, at their option they can opt for multiple registration. If within the same state, if you are having two branches and they have opted, now they decided to go for multiple registration, then they become distinct person. Remember this thumb rule, if you are having branches in other state, always they are distinct person. Supply between them is deemed supply, GST will be there. If you are having transaction between branches in the same state, normally there is no supply because they will be working under the same GST number. But if they have opted for multiple GST number, then they are also distinct person, that also will be treated as deemed supply. So distinct person here. Now coming to an important exception given here is, normally if there is a supply between related person, distinct person, then it is deemed supply, whether of goods or services, GST has to be paid. Exception. Gifts given by employer to employee up to 50,000 per financial year per employee, then it is not supply. Understand that this exception is only for employer-employee, not for others. Only for employer-employee. Employer-employee are one of the related persons. Now what are they trying to tell? Understand, again here they are talking about gifts, which is also already covered in first part. Supposing Tata Limited decide to give gifts. It is giving gifts. If it is giving to unrelated person, unrelated person means, ask yourself a question. ITC is availed, then it is deemed supply. ITC is not availed, then it is not supply. If it is given to related person, but not being employer-employee, understand whether ITC is availed or not availed. If ITC is availed, it is deemed supply as per para 1 of schedule 2. If ITC is not availed also, then it is deemed supply as per para 2 of schedule 1, not schedule 2, beg your pardon, schedule 1. So if gifts are given by Tata Limited 1 to unrelated person, ITC is availed, deemed supply para 1. ITC is not availed, not supply. If gifts are given to related person, ITC is availed, deemed supply para 1. ITC is not availed, even then it is deemed supply para 2 of schedule 1. So when the gifts are given to related person, they are deemed supply. Whether you take ITC or not, they are deemed supply. Now, one of the related person is employer-employee. Now coming to the third concept. If the gifts are given by employer to employee, if ITC is availed, then it is deemed supply by para 1. If ITC is not availed, basically it is deemed supply by para 2, but there is an exception. If the gift value is up to 50,000 per employee per financial year, then it is not supply. Then you have to ask yourself a question, whether the gift value is more than 50,000 per financial year per employee, yes, deemed supply para 2. If it is up to 50,000 per financial year per employee, then it is not supply. So there are three types of gifts. Tata company giving gifts to unrelated person, ITC is there, deemed supply para 1. ITC is not there, not supply. First part. Tata company is giving gifts to related companies. not employer-employee, related persons, other related persons. ITC is availed, deemed supply para 1. ITC is not availed, even then deemed supply para 2. Tata Limited is giving gifts to its employees. ITC is availed, forget about the value, it is deemed supply para 1, whether it is up to 50,000 or more than 50,000. ITC is not availed. ITC is not availed, then if it is gifts up to 50,000 per financial year per employee, not supply. If it is more than 50,000 per employee per financial year, then that is deemed supply para 2. So that you need to understand. And the next point is all about your principal agent, supply of goods between principal and agent. Here it is only about goods. Friends, we are not talking about normal agent, we are talking about a very special agent where he is having the authority to raise invoice under his own name. So from the customer's point of view, customer will always think that this agent is the owner of the goods, though he is not. So you are talking about a special agent. Let us call this agent as special agent. Special agent as per schedule 1. So we are not talking about normal agent, we are talking about an agent who is having the right to raise invoice under his own name. So when he is raising the invoice to the customer, he will not be raising invoice of principal, he will be raising invoice under his own name, because principal has given him the authority to raise the invoice under his own name. Though he is not the owner of goods, but he will be raising the invoice under his own name, special agent. Now let us understand, if there is a normal agent, if I am the principal, you are my customer, there is a normal agent. Then there are two transactions, principal to customer, actual supply of goods, you will be giving me consideration, paisa, actual supply of goods. I am supplying you goods, you will be giving me consideration, actual supply of goods by principal to customer. And my agent will be charging commission. So agent to principal is actual supply of services. So he will be taking commission, he will be charging paisa, consideration, actual supply of services. So if it's a normal agent, agent to principal who will be charging commission is actual supply of services. Principal to customer will be taking the consideration from customer, it is actual supply of goods. Both are actual supply. Agent to principal is actual supply of services, principal to customer is actual supply of goods. Now talking about here, there is no deemed supply concept, both are actual supply. Talking about special agent here, this special agent now will have the right to raise under invoice under right to raise the invoice under his own name when the goods are given to the customer. Now the entire transaction changes. First, principal will be giving the goods to the agent. As ownership is not transferred, consideration is not given. So principal to agent, though there is no paisa, there is no consideration, it is not actual supply, but it is deemed supply of goods. We are now talking about special agent. Normal agent we have discussed. There is no concept of deemed supply there. Special agent, principal to special agent, when the goods are given, ownership is not transferred, consideration is not received, even then it is deemed supply of goods. Deemed supply of goods. Special agent to customer, customer will be giving consideration, paisa will be there, and it is actual supply of goods. Now the entire transaction changes. There is no transaction between principal customer, it is principal to special agent to customer. Principal to special agent to customer. Principal to special agent, consideration is not there, but it is deemed supply of goods, only goods, deemed supply of goods. Valuation rules will take care of it. Deemed supply of goods, principal to special agent. So principal has to give invoice, he will pay output tax, special agent will take input tax credit. Special agent to customer, consideration will be paid by the customer. Though it belongs to principal, but will be paid by the customer to the special agent, because customer will always think that special agent is the owner. It is actual supply of goods. Now it is principal to special agent to customer, deemed supply of goods, principal to special agent to customer, actual supply of goods. So both only goods are involved. One is deemed supply of goods, principal to special agent. One is actual supply of goods, special agent to customer. So that is all about your third para. But here we are not talking about normal agent, we are talking about special agent. And we have discussed the difference between both normal agent and special agent. Now talking about the last part, importation of services from related person or from branch outside India in course of furtherance of business. Here the discussion is only about service. For the second time we are discussing importation of services. Second time. First time we have discussed importation of services, deemed supply part 1. That time it was importation of services. Business may or may not be there, but consideration should be there. So first time we are talking about importation of services. You divide this importation of services into multiple categories. It is in course of furtherance of business, and consideration is there. The recipient is not receiving in course or furtherance of business. It is from the angle of recipient, because importation of service is always under RCM. So it is from the angle of recipient. So you are getting the services in course or furtherance of your business and you are paying the consideration. You are getting the services for your personal use, but consideration is that you are getting the services in course or furtherance of business, but there is no consideration. It is from related person or branch outside India. You are getting the services in course or furtherance of business, which will be using for your business as a recipient. Consideration is not there, and it is not from related person. It is not from branch outside India. It is from unrelated person. You are getting the services which is not for your business and you are not paying anything. So all these permutation combinations are there. All these permutation combinations are there. One of the favorite question of ICA because of multiple permutation combination. If it is in course or furtherance of business as a recipient and you are paying consideration, it is actual supply, because both business and consideration are present. If it is not in course or furtherance of business and you are not paying consideration, it is not at all supply. So last extreme corners are very, very simple. Now, if it is not in course or furtherance of your business, you are not, as a recipient, it is not used for your business, for your personal use, and but you have paid consideration, it is deemed supply as per part 1. As per part 1, deemed supply. Right, section 7.1b, deemed supply, part 1. We call it as part 1. And when you talk about ulta scenario, very careful. If business is absent, consideration is present, deemed supply. But if business is present, consideration is absent, you should have to satisfy additional condition that it should be from related person or distinct person. It is an additional condition. Then only it is deemed supply as per part 2, that is para 4 of schedule 1. Now if I tell that it is in course of furtherance of business but consideration is not there and it is from unrelated person, then it is not supply. So if you look at this analysis, if business is absent and consideration is present, automatically it is deemed supply, no extra condition. No extra condition. But if business is present and consideration is absent, there is an extra condition which is required for it to be called as deemed supply as per para 4 of schedule 1, which means that should be from, this importation of service should be from related person or branch outside India. So you have to be very careful. If it is not for your business but you are paying consideration, automatically deemed supply. If it is in course of furtherance of your business but you are not paying consideration, then for it to be as deemed supply as per para 4 of schedule 1, it should be from your related person or branch outside India. Extra condition is required. So that is all about your importation of services. If you look at these points carefully now, you will find that business is there silently. First point, permanent transfer or disposal of business assets, business. Second point, supply of goods or services between related person or distinct person in course of furtherance of business. Third point is principal agent, obviously it is only for business. Fourth point, again your point finding in course of furtherance of business. So in all the 4 points of schedule 1, business is silently present. Now if you look at the definition of supply, we are done with the concept of your actual supply, both the parts. We are done with the concept of deemed supply, both the parts. What is left out is your not supply. Lastly, you are talking about your not supply. You are talking about your not supply. Again, not supply has got your 2 parts. Schedule 3, totally 8 cases and notified 3 cases. Schedule 3, 8 cases and notified 3 cases. Now quickly tell me what are schedule 3, 8 cases. First point, schedule 3, 8 cases. Just a quick walkthrough, just the heading, then we'll just see the important points and close with that. Point number 1, employer, employee. Wait, employer, employee, what are they talking about? Buy services by employee to employer, either in course of employment or in relation to employment. Basically you're talking about all the 3 categories of employees. We are talking about laborers, normal employees, privileged employees. Laborers, whether you pay wages to them or bonus to them or gratuity to them, it is in course of employment or in relation to employment. Gratuity is in relation to employment. Normal employees, whether you pay salary or bonus to them in course of employment. Gratuity to them in relation to employment. Privileged employees, partners of partnership firm or designated partner of LLP. Remuneration to working partners or working designated partners. Privileged employees. Technically they are not employees but privileged employees. Directors. Now you have to wait here. Directors. Again a circular is there clarifying that. Directors. If we are talking about managing director or whole-time director. Managing director or the main condition is they are spending their full time there. Even the company deducts TDS under section 192. TDS on salary. Technically it is not, they are not employees, but company is also deducting TDS under section 192. TDS on salary. So again, there is no question of any supply. But if it is other directors, other than managing director, whole-time director, company will deduct TDS under 194J, professional or technical fees. They are not employees then. They are not employees. Whether GST will be there? Yes. Why? Why? Now we are not talking about employees there. They are professionals. GST will be there, but under RC. So supplier is other directors, recipient is company or body corporate. Who will pay GST? Company or body corporate will pay GST. Right. So when you talk about first point, employer-employee, make it one thing clear that it is by employee to employer in course or in relation to employment. The laborers are covered, normal employees are covered, privileged employees are covered. Salary, wages, gratuity to them is outside the ambit of GST. When you talk about privileged employees, it can be partners or designated partners. But when you talk about directors, who are covered there? Managing directors and full-time directors, and the company is also deducting TDS in line with employer-employee relationship, that is under 192. If it is other directors, then it is 194J. They are not employees, so GST will be there. It is not covered in Schedule 3. When it is not covered in Schedule 3, GST will be there, but it is under RC. Now one more special point, it is by employee to employer. If it is by employer to employee, if it is by employer to employee, then it is supply. If company is giving something to employee, then it is supply. Only one thing which is not supply is gifts up to 50,000 per financial year, and that too when ITC is not available. Anything other than that given by company to employee, whether free food or free transportation, it is all supply. It is all supply. That is first part. Second part, employer-employee, then it is MP-MLAs. Right, so MP-MLAs are got three parts. MP-MLAs or member of panchayat or member of municipality. Second, constitutional post. Any person who is having, they are not MP-MLAs or a member of panchayat or member of municipality. Constitutional post. President of India, Governor of State or Chief Justice of India, RBI Governor, Comptroller, Auditor General of India. They are all constitutional post. So any payment to them, it will not attract GST. And last, chairperson, member or director in a body established by government. It is not government company. In a body established by government. It is a department of government. Body established by, we are not talking about government company. Body established by, classic example is your CBDT, CBIC. CBDT, CBIC. They are part of government, body established by government. They are not government company and all. Right, so when you talk about CBDT, don't you have the chairman? Don't you have members? When you talk about CBIC, don't you have members and chairman? Right, directors. So you're talking about chairperson, members or directors of body established by central government, state government or local authority. That is the second point. What is the third point? First point is employer-employee. Second is MP-MLAs covering 3 points. Third, you are talking about court, tribunal. You are talking about court or tribunal. Right. Anything paid to court or tribunal, there is a clarification telling that even consumer dispute redressal committee is working just like tribunal. So that is also covered. That is outside the ambit of GST. Payment to court, tribunal is outside the ambit of GST, not payment to advocates. Payment to court and tribunal is outside the ambit of GST, not payment to advocates and arbitrator. That is within the ambit of GST. It may be exempted, but levy is there. Next, you are talking about your deceased. Funeral, burial, crematorium, mortuary, including transportation of deceased. Including transportation of deceased. It is outside the ambit of GST. Transportation of deceased is outside the ambit of GST. Transportation of patient is inside the ambit of GST but exempted. Next, you are talking about land and building. Land and building. So when you talk about building, you are even touching schedule 2. This we are talking about schedule 3. We have already covered schedule 1. So we are even touching schedule 2 now. Understand that when you are talking about your particular aspect, where land is there, land is always outside the ambit of GST. So if there is a complex in which all of us have booked a flat or booked a shop, land portion, undivided share of land is always outside the ambit of GST for all of us. Now, for whom it will attract GST for the building portion? If there is an advance payment, whether full advance or partial advance. Whether full advance or partial advance, the moment you give the advance to the builder, whether full advance or partial advance, he is doing construction for you. He is doing construction for you. It is supply of service. It is supply of service. If few of you are paying full amount after completion certificate or first occupancy, either municipality is giving completion certificate or one of us has occupied there, whichever is earlier, then it means building is ready. When building is ready and you are paying full payment after that, I am selling the building. I am not doing construction for you. I am selling the building. Is that clear? If all of us has booked a flat or shop there, one thing make it very clear. UDS of land is not supply for all of us. Whether you pay full advance or partial advance or you pay full amount after completion certificate or first occupancy. Now, for whom building portion is taxable? Few of you have given full advance, it is taxable. Few of you have given partial advance, it is taxable. There is no differentiation. Levy is there for both. Valuation is there same for both. Time of supply may be different. Levy is there for both. Valuation is same for both of you. Time of supply, when the tax will be paid may be different. Right? Full advance or partial advance, no difference. And when you talk about, with respect to levy and valuation, there is no difference. When you talk about few persons who have paid the entire consideration after completion certificate of first occupancy, the builder was not giving any construction or works contract service to them. It is sale of building, not supply. Sale of building, not supply. Full advance, partial advance, construction of building, supply of service. Full payment after completion certificate of first occupancy, sale of building, not supply. Not supply. Next, you are talking about actionable claim. Actionable claim is goods, but it is not subject to GST other than betting, gambling, lottery. If you see the definition of goods, goods includes actionable claim. It is goods. But what all actionable claims will attract taxes? Only 3. Betting, gambling, lottery. Only betting, gambling and lottery are the 3 actionable claims which will attract. All the other actionable claim, including your debtors or insurance claim, they will not attract GST. Right. So these are the first 6 paras. To walk through first 6 paras, what are they quickly? First, employer-employee, MP-MLAs. MP-MLAs contain 3 points. Right, MP-MLAs constitutional post, chairperson, member, director of body established by central government, state government or local authority. Court, tribunal, deceased, land and building, action. Now the last 2 areas are dealing with your customs. What are they? Drop shipment. When you talk about drop shipment, what is happening? Simple example. I am there in India. I am importing from USA and selling it to Australia. But I am not bringing the goods inside India. Directly I am asking my supplier of USA to give the goods to Australia. Give the goods to, it is called as drop shipment. Neither I have done import, so there is no question of import duty, nor I have exported, so no question of duty drawback. Directly it is going from USA to Australia. It is called as drop shipment. in India, I will not pay any taxes. I will not pay customs. I will not be paying GST. So then when I am not paying any taxes, there is no question of any refund on exports. Exports will get refund, but there is no question of any refund. Technically, it is neither import nor export. Technically, it is neither import nor export. So there is no Customs Act implication, no GST Act implication. I am outside Customs Act, I am outside GST Act. I am not at all touching those. It is called as drop shipment or merchant trading. Technically, it is not import export, so Customs Act will not cover it. No import duty, no duty drawback. Even GST tells that we are not going to touch you. Basically, my trading account will have purchases and sales, but I will neither pay imports and exports, but I will not pay any customs duty nor I will pay any GST. Drop shipment. Next, last point talks about two areas. One is your, we call it as high C sales. One is you call it as high C sales, and another is we call it as sale of warehouse goods. In customs, the first place where the goods are coming is customs station. The next place where goods may go, not always, is customs warehouse. It is customs warehouse. Understand that I imported the goods are at customs station, or the goods are yet to come at customs station. I am transferring title to you. I am transferring title to you when the goods are in movement or when the goods are at customs station. It is called as high C sales. Now, whether first importer will pay import duty or second importer will pay? Second importer will pay import duty. Now, look at the first importer. I am the first importer. I will neither pay import duty nor I will pay GST. On my purchase, I will not pay import duty. On my sale, I will not pay GST. My both purchase and sales are tax free. I will neither pay import duty nor I will pay. You are the importer, you will pay customs duty, and only after customs duty GST can start. So here customs duty I never paid, so there is no question of on my purchase, on my import, no import duty. On my sale to you, it is called as high C sales, no GST. No, when he clears, he will pay import duty. When he sells, he will pay GST. Are you clear with that? The same thing can happen. I have taken the goods at customs station. I am not clearing them. I may take it to customs warehouse. When you take the goods to customs warehouse, please understand that you don't pay any import duty. It is deferment of duty. I am postponing the duty. Now, when the goods are in customs warehouse, I get a customer. I transfer the title to you. I don't clear the goods, I transfer the title to you. So, I am importer 1, you are importer 2. Who will finally clear the goods? Importer 1 or importer 2? Louder! Importer 2. He will pay customs duty. Again the same answer for me. On my import, I will not pay any import duty. On my sales to importer 2, I will not pay any GST. I will not pay any GST. I have to conclude this. When importer 2 clears the goods, he will pay import duty. When he sells the goods, he will pay GST. I am outside the ambit of GST. So that is high C sales and sale of warehouse goods. Technically, there is no difference in answer. Places are different. Customs station, customs warehouse. Concept is exactly the same. Are you clear with this understanding? In the previous case, drop shipment, no one paid import duty, no one paid GST. Here, someone is paying, but not first importer. But not the first importer. That is para 7 and para 8. Now we are done with 8 cases of schedule 3. Not supply has also got 2 cases. One is schedule 3, 8 cases. Other is 3 notified cases. 3 notified cases. Now when you talk about the 3 notified cases, for the first case it is interlinked to first case. Always remember that when you see the first case, please remember your schedule 1 para 2. What is schedule 1 para 2? Related person, distinct person. Now what are they trying to tell? They are telling that for the conveyance, that conveyance can be bus, truck, helicopter, aeroplane, railways, ships, any kind of conveyance. Any kind of conveyance. When the conveyance is going from one place to another place, along with the tool, spares, rigs on it. Along with the tools, spares or rigs on it. See, when I'll take a very simple example. VR Logistics is taking the truck from Tamil Nadu to Karnataka. Strictly speaking, it is covered by deemed supply, schedule 1, para 2. How? Supply between distinct persons. VR Logistics may be registered in Tamil Nadu, may be registered in Karnataka. But it is very wrong for them to tax it. So what they tell? Will not tax it. How? They bring it under not supply. They bring it under not supply. What they tell? The truck which is going from Tamil Nadu to Karnataka, it is not supply. Not only the truck but also the tools, spares, rigs on it. They are not supply. But wait, this relaxation is only from deemed supply. The difficulty was deemed supply. The relaxation is only given from deemed supply. If VR Logistics actually selling the truck, it is actual supply. Pay GST. Pay GST. If VR Logistics is taking the truck and taking repair and maintenance services, if there is repair and maintenance services on the truck, it is actual supply. Pay. The relaxation is only from deemed supply, not from actual supply. Right. To conclude it, one example. Remember it. It has been asked by ICA in form of a big question, big question rather. 8 or 10 marks question was only based on this. Right, only and only based on this. The wordings are very, very crucial or important there. Now when you talk about that particular aspect, how to remember it, let us assume that and understand that this is not only for the transportation sector, it is also for the companies. Companies may have their own trucks. So if Reliance Limited is taking its goods from, rather than giving it to VR Logistics, it's having its own truck. It's taking its goods from Tamil Nadu branch to Karnataka branch. Then there are three elements: truck, spares on trucks, and goods inside truck. For truck and spares on trucks, it is not supply. But for goods inside truck, it is deemed supply. The relaxation is only for the truck and tools, spares, rigs on it. So it is not supply. But the goods inside the truck, they are deemed supply. Deemed supply, not actual supply. Branch, it is between branches. So it is deemed supply. It is deemed supply. Right. So that you need to understand. First point. Second and third point focuses only on government transactions. First point focuses on any person. Second and third point focuses only on government. Now what are they talking about government? Now first thing they are telling that government doing municipality related functions. Article 243 W, municipalities W, and Panchayat related functions, Article 243 G, it's not supply. Understand that when you see the definition of business, you will find that government doing any work, including statutory function, is business. Government doing any work, including statutory function, is business. But what are the cases which is not attracting? What are the cases which is not attracting? GST, which is not supply. Municipality related works, Article 243 W. Panchayat related works, Article 243 G, by government is outside supply. Is outside supply. Now one more thing is outside supply of government. Now this time it is only state government. You are talking about alcoholic liquor license. Alcoholic liquor license fees collected by state government. Collected by state government. In together I call it as PML. PML. So P stands for Panchayat, M stands for municipality, L stands for liquor license fees. Liquor license fees. Understand that liquor license fees is only the subject matter of state government, therefore that is only state government. Panchayat, municipality can be both for central government, state government, including local authority, therefore everything is covered there. And one more thing, understand that only liquor license fees is outside the ambit of GST. Any other license fees, including telecommunication license fees or mineral extraction license fees or any other license fees collected by any government, is inside the ambit of GST. Only liquor license fees is outside the ambit of GST. Right. 8 plus 3 cases of not supply. 8 plus 3 cases of not supply. Not supply, there's a circular given as very simple. Donations, whether it will attract GST or no GST. If it is a normal donation where there is no quid pro quo, there is no contractual obligation. I have given donation, I don't expect anything, it is not supply. Because it cannot be called as consideration. It cannot be even called as consideration. But if I give a donation which is specifically telling that I am going to give a donation and my name should be there somewhere on the event or on the building somewhere, then it is supply, rather the specific name of the supply is advertisement. I want my advertisement. So I am paying this amount for my name to be displayed. So that is nothing but advertisement. That is nothing but advertisement. But understand that if I give donation, I don't expect anything, then the opposite person is writing my name, I cannot help it out. If you go to various trusts or various places, you will find the list of donors. List of? That donor has not said write my name. I gave donation, I came out. He is telling that the trust or the organization or the college or any institution, though this circular talks only about charitable trust, it is not only for charitable trust, it is for everything. Right? Now, if the name is written by the recipient on their own will, it is not supply. Why? I gave them the amount, I did not expect anything, they wrote my name. There was no obligation. There was no obligation for the recipient to, for the donee, rather not recipient, for the donee to do anything. Either I am the recipient, if I pay something, I am the recipient. There was no obligation on the donee to do anything. He wrote my name out of love, affection, or out of the normal practice, which is that. Are you clear on this understanding? That is everything about your not supply. Not supply. And the last area of this chapter, which is nature of supply. Nature of supply. We are done with your supply. We are actually done with your supply. Actual supply 2 parts, deemed supply 2 parts, non-supply 2 parts. What is left out is only nature of supply. Quickly tell me the answer. See, I will make this very, very simple. If it is goods, if an item is goods, it may be supply of goods or supply of services. If the item itself is service, it is always supply of service. It is always supply of service. Don't call it a service. Goods and service is product. Nature of supply is supply of goods or supply of service. So if the product is goods, it may be supply of goods, it may be supply of service. If the product is service, it is always Is this clear? Now, in goods, there is 2 categories, supply of goods or supply of service. Now, when it is supply of goods, only when the title is transferred. Only when the ownership is rest all cases. It is supply of service. So, quickly, I want the answer loud and clear. That is transfer of goods, where title is also given. Supply of goods. Where there is transfer of title in goods, but which will be at a future date. Hire purchase. Now goods are given, but title will be given in future. It is supply of goods. Title will be given, not now, but in a future date. So supply of goods. There is transfer of goods, but without transferring the title. I am giving you the goods, but no transfer. Simple example, I am giving you the goods on rent or lease or license. So that is transfer of goods, but without transfer of title. It is supply of service. This point is repeated again in your para 5, transfer of right to use any goods. Again it is repeated, same point. Para 1 contains this point, para 5 also contains this point. Transfer of right to use any goods. So title is not given. I am giving you the right to use this particular property. Supply of services. Now, when you talk about other areas, land, now the focus is on land and building. Now, we have discussed about the construction portion and all. When we discuss about your the supply as well as not supply, both. Now we are talking about rent. Supposing I am owning a land, I am giving that land on rent or lease. Supply of services. I am having a building or a flat or a shop. I am giving it on rent or lease. Supply of service. Even if it is a very long-term lease. So it is whether it is lease or tenancy or easement or license to occupy land or building is always supply of service. Even if it is a very, very long-term lease where state government is collecting stamp duty. Even if stamp duty is collected, nothing is affecting GST. State government may collect stamp duty telling that no, we are treating it as sale of land or sale of building. But forget about it. For GST, it is still supply of service. Supply of service. Right. Understand that even for your building, again this point is repeated in para 5. Again repetition. Renting of immovable property. See, para 2 and para 5 again tells the same thing. There the wordings are lease, tenancy, easement or license to occupy land or building. Here the wordings are renting of immovable property. Again the same thing. Again supply of services. It is a repetition. Now, in para 5, immediate next point, we are talking about land and building together. So, immediate next point in para 5 is all about your construction, which you already discussed. Discussed what? If at all you pay advance, whether full advance or partial advance, it is supply of service. Construction sector, works contract is always treated as supply of service. When it is not treated as not supply. Only if except, there is an exception, except when the entire consideration is received after completion certificate or when you talk about exception, it means that it is neither supply of goods nor supply of service. Neither supply of goods nor supply of services. Are you clear with this understanding? Alright, I am taking the related points. I am going line by, but if at all something is related in other paras, I am touching those areas as well. Now, next, what if I talk about your job work? Supply of goods or supply of services? Job work is always supply of, even if job worker is using some of his own goods. Essential character is supply of services. So when you see para 3, the language is treatment or process applied on other person's goods. Nothing but job work. When I talk, I am working on other person's goods, I am a job worker. I am a job worker. Supply of service. Supply of service. Now, para 4. Para 4, I think I have tell it. Para 4, the only area where you have to spend some time in schedule 2 is para 4. Para 4, read schedule 1 along with schedule 2. Para 4, you cannot read it together. Schedule 1 along with schedule 2. Then things are simple. Very simple. Now, we know that permanent transfer or disposal of business assets on which ITC is availed is deemed supply. But it is of goods or services. It is deemed supply. It is deemed supply. But deemed supply of what? I will make it very simple. Gifts of free samples. When I am giving gifts of free samples on which ITC is availed, it is deemed supply. But now, question is whether it is supply of goods or supply of services. Supply of? Why? That is permanent transfer or disposal of business as a title is transferred. Title is transferred. Right. But when I tell that, no. I am giving the company is giving its assets for the director to use it. The company is giving its assets for the directors to use it for his personal purposes. Then it is deemed supply. How? Related person. Para 2. Supply between related persons. Though it is without consideration, that is supply between related persons. It is deemed supply. Now it is deemed supply of goods or services. Deemed supply of goods or services. So if a company is giving its car or giving its helicopter for the director to use it, if it is for business purposes, forget about it. Nothing will happen. No supply at all. But if it is for personal purposes, it is deemed supply by virtue of schedule 1. Now it is deemed supply of goods or services. Why? Title is not transferred. So if title is not transferred, it is supply of services. And the last point of this particular para 4, if I cease to be a taxable person, if a person ceases to be a taxable person, which means if Vishal Jain, who was registered, now is cancelling his registration. He is cancelling his registration. Understand that for GST, Vishal Jain registered is different from Vishal Jain unregistered. Vishal Jain registered is different from Vishal Jain unregistered. Is it deemed supply? Yes. How? There is permanent transfer or disposal of stock by Vishal Jain registered to Vishal Jain unregistered on which ITC is availed. So it is deemed supply. Now it is deemed supply of what? Goods. Why? Title will be given. Vishal Jain registered, has given the stock to Vishal Jain unregistered. So it is supply of goods. Deemed supply is set by Schedule 1. Whether it is deemed supply of goods or services is set by Schedule 2. Now there is exception though here. If at all you are talking about businesses transferred as going concern or carried on by personal representative, understand that it is still supply. That is not changing, but GST will not be there. When there is a transfer on going concern basis or someone else is carrying over the personal legal head is carrying over the business, understand that it is still supply, but there is no GST. If you see exemption, you will find that there is an exemption. Business transferred on going concern, whether to third person or by legal hire, it is exempted. It is still supply, but there is no GST. When there is no GST, forget about whether it is supply of goods or supply of services. Are you understanding this particular point? That is para 4. And para 5, if you look at out of para 5, there are 6 points. And out of 6 points, we have covered already 3. Renting of immovable property, we have covered. Construction of building, we have covered. Right to use goods, we have covered. The other 3 leftover points. One is about your intellectual property rights. One is about your software. So we'll discuss these. When you talk about intellectual property rights and software, one thing is common, both are goods. Though both are not tangible, but both are goods. Now when you talk about goods, if I give the title, it is supply of goods. If I don't give the title, now if you see these points, they are talking about title is not given. So if you see intellectual property rights, what is the language that they have used? Temporary transfer or permitting the use or enjoyment. Permanent transfer, they are not spoken about permanent transfer. Temporary transfer or permitting the use or enjoyment. Supply of? If I tell it is permanent transfer of intellectual property right, supply of goods. Software. They said about lot of points. Adaptation, development, design, customization, programming, upgradation, implementation, enhancement. Nothing is about sale. So anything other than sale of software is supply of service. But if the software is outrightly sold with the source code, it is supply of goods. Right. So here they are focusing only on other than sale of goods. So it is obviously supply of service. Right. Now if I tell, if I am promising not to do a service or not to do business in Coimbatore and I am getting a payment, then it is refraining from doing an activity, which is supply of? Refraining from doing an activity or tolerating an activity is supply of service. I am getting the payment not to do an activity or to tolerate what he is doing. The supply of? Supply of service. See, in all these cases, title is not very simple. I said the answer in the beginning itself. I said goods, services. If it is service, it is always supply of service. If it is goods, title is transferred, supply of goods. Title is not transferred, supply of services. And the last case, we are talking about goods and service both being involved. If it is works contract, both goods and service are involved. But what is dominant nature? Service, supply of service. If it is food related services, restaurant sector, outdoor catering sector, both goods is there, service is there. But what is the dominant nature? Supply of services. Whether you go and have food in restaurant or you call an outdoor caterer at your place or at the place that you have decided, both goods and service are involved. But what is the dominant nature? Service. Supply of service. Supply of service. So in the last 2 cases, works contract and food and drinks, other than alcoholic liquor, because it is outside the ambit of GST, both goods and services involved. Title is also transferred. But what is the dominant nature? Service. We call it a supply of service. Understand that Schedule 2 are giving only examples. Unlike Schedule 1 and Schedule 3, where they are very exhaustive. But Schedule 2 is illustrative. Schedule 2 is illustrative. So these 6 paras of Schedule 3 are only examples to make you understand how to find out whether it is supply of goods or how to find out whether it is supply of services. Are we clear with this understanding? Are we clear with this understanding? Right, there is a circular which is talking about your clubs and members. We have already discussed that. I'll just give examples, try to answer it correctly. A joint venture is there. There are 2 companies, VJ Limited and PJ Limited. There is a joint venture. Joint venture speciality is you need not form a third company. You are not required to form a third company. For some time they are collaborating, then they'll part their ways. Now joint venture is nothing but unincorporated association. And VJ Limited and VJ Limited are nothing but their members. Nothing but their, again we are talking about clubs and members. If VJ Limited and PJ Limited are investing capital, investing funds, it's not at all supply, mere transaction in money. Neither goods nor money and securities are neither goods nor services. Definition of goods and services. Right. Now, when you talk about this association or this joint venture requires a machinery, which PJ Limited is selling that I am having this machinery of no use to me. I am going to give this machinery to you. You need not purchase. Why to invest? I will give this machinery to you. I will give this machinery to the joint venture. Now, member is giving machinery to joint venture. Is it supply? Yes. Obviously for a consideration. PJ Limited will take some rent or lease. Is it supply? Yes. Who is the supplier? PJ Limited. Recipient? Joint venture. GST will be that. GST will be that. This joint venture has invented a certain maybe it is doing an R&D. It has brought out a new product. New product. Right. The patent of which is taken by the joint venture, and VJ Limited is telling that I'll be the first person to use this formula. I'll be the first person to use this formula. And obviously both the members, VJ Limited are agreeing. Now whatever is the output of that joint venture is used by VJ Limited on payment of some amount to joint venture. Whether GST will be there? Yes. Who is the supplier? Joint venture. Who is the recipient? VJ Limited, member. Right, so that will be supply. What is the net crux of the circular is joint venture and members. Joint venture and the co-venturers, they are nothing but association and the members. If at all there is any supply element, tax it. If there is no supply element, don't tax it. If there is a supply element, like PJ Limited giving machinery to joint venture, tax it. Or like joint venture giving the formula to VJ Limited, tax it. But if there is no supply element, just putting the capital amount does not make any supply, don't tax it. Don't tax it. That's all about this particular circular. Right. We are done with our entire understanding of supply. Very detailed understanding of supply, but obviously we have walked through all the points of supply. Now what we are going to see in this chapter finally is to understand what is composite supply and what is mixed supply. What is your composite supply and what is your mixed supply? So this will give you an understanding of all the ambits of supply. Right. Now before we take that, you have to answer me the definitions, 3 definitions. What is meant by taxable supply? One word. Levy means taxable supply. What is meant by non-taxable supply? No levy, non-taxable supply. Examples of non-taxable supply. Fine notified, petroleum products and alcoholic liquor. Supply is there but non-taxable. It is non-taxable. What is exempt supply? Exempt supply, levy is there but there is no collection. Why? Either when you talk about taxable supply, as we discussed, there is levy. Non-taxable supply, there is no levy. Exempt supply talks about nil rate or fully exempted. Either the rate itself is 0 or rate is something but it is fully exempted. But wait, it includes non-taxable supply. It includes non-taxable supply. Taxable supply, no levy. Taxable supply, levy. Non-taxable supply, no levy. Exempt supply has got levy but no collection, nil rated, exempted, fully exempted. Also, no levy, no collection, non-taxable supply. Right? Mathematics should not be applied here. Why? Taxable supply includes exempt supply. Exempt supply includes. Stop that. Don't tell that taxable supply includes non-tax. Stop that. Why they have written this kind of definition? To make sure that aggregate turnover is more. To make sure that your aggregate turnover is understand that alcoholic liquor for human consumption and fine notified petroleum products will never attract GST. But in many places in GST, including threshold limit, you find out aggregate turnover, which will include the turnover of alcoholic liquor for human consumption, which will include the turnover of 5 notified petroleum products. Though you don't pay GST, but for calculation of aggregate turnover in various places in GST, you will include that. That is the objective of including it. Now, when you talk about composite supply and mixed supply, you have to understand what is taxable supply, what is exempt supply, what is non-taxable supply. Composite and mixed supply, there are three conditions. There are three things. One simple word, composite supply, naturally bundled. Mixed supply, artificial bundling. One word. Composite supply, natural bundling. Mixed supply, artificial bundling. But when you talk about the exact definitions, both these supplies are made by taxable person. Both are made by taxable person, and in both these cases there are 2 or more supplies. But the difference is here, one area there are 2 or more. In composite supply there are 2 or more taxable supplies. Here there are 2 or more individual supplies. 2 or more in composite supply, there are 2 or more taxable supplies. Here it is 2 or more individual supplies. So first condition is both are taxable, and here though 2 or more supplies are there, but they are individual supplies. Second, in composite supply there should be natural bundling, which means they are supplied in ordinary course of business together. Natural bundling, and one of the supply is principal supply. One of the supply is principal supply. Whenever there are 2 or more supplies, one should be the main character, main hero. So one of the supply is principal supply. In mixed supply, I said there are 2 or more individual supplies, and they are given for a single price. They are given for if at all they are given for different prices, it is neither composite nor mixed. If you go to Big Bazaar and you purchase multiple items, 2 or more supplies, and for each of the items separate pricing is given, it is neither composite supply nor mixed supply. So it is for a single price. Mixed supply means it is for a single price, and it is not a composite supply. So first, what you have to check? You have to check composite supply or mixed. First you have to check whether it is composite or not. Then you have to check whether it is mixed or not. Can there be 2 or more supplies which is neither composite nor mixed? Yes. How? There are multiple supplies which is not composite, and separate pricing is also there. It is not naturally bundled, plus also separate pricing is there. If it is not naturally bundled, it is not composite supply. If separate pricing is there, it is not mixed supply. It is not mixed supply. If you want to see the differences very specifically, composite supply, first you have to check, only then you have to check mixed supply. Composite supply, there are 2 or more taxable supplies. Mixed, there are 2 or more individual supplies. Composite supply, it is natural bundling. Mixed supply, artificial bundling. Composite supply, the pricing may be single or multiple, it remains composite. But mixed supply, there should be a single price. There should be a single price. Composite supply, for sure there should be one principal supply. Mixed supply, there is no concept, there is no hero. See, there are movies where there is no lead character. There are no heroes. Each one of them is equally important. So there is no concept of any principal supply. What is the tax treatment of composite supply? Composite supply. Why are we discussing this? Is only for tax treatment. The entire discussion about composite supply, mixed supply is only for tax treatment. What is the tax treatment of your composite supply? It will be that of principal supply. If the principal supply is having 18%, it is having 18%. Entire supply is having 18%. The principal supply is having 5%. Entire supply is having 5%. If the principal is having supply is having 0%, entire supply value is at 0%. What is the tax treatment of mixed supply? If there are 3 supplies, 5, 12 and 18, it will be taxed at 18. If there are 3 supplies, 5, 12 and 28, 28. If there are 3 supplies, 0, 5, 12, 12%. Right. So highest among all of them. Not highest 28. Highest among all of them. Right. Examples of your composite supply. A lot of examples. Your classroom teaching is an example of composite supply. Teaching along with books, it is an example of composite supply. Or you're talking about a hotel along with breakfast free, composite supply. It is again an example of composite supply. Purchasing of goods along with transportation insurance. It is an example of composite. Though they are charging it separately, but it is an example of composite supply. Hospital. Your treatment with medicines is an example of composite supply. Right? Naturally bundled. You have to see the industry and decide. Mixed supply. Diwali is about to come. Diwali gift box. Different items are there. Mixed supply. Diwali gift box. Customized Diwali gift box. Different items are there. They are all mixed supply. Classic example. I take this example for sure. Toothpaste and toothbrush. Mixed. Don't think and paste and brush. Paste and brush. They are. Why? They are not naturally bundled. You cannot expect them. Though they are used together, but they are not naturally bundled. Right. So that is an example of mixed supply. Tennis ball along with boost. Tennis ball free along with boost. Mixed supply. Mixed. Whenever you go for a combo product, go to Big Bazaar, you will get a combo item. You get a combo item. They will tell that all these items together. Refrigerator along with say utensils. There is no connection. But it is a classic example of mixed supply. Right. That is all about your composite supply and mixed supply. How to decide it? You have to basically see the normal industry practice and perception of the customer, what is expecting. So it depends on industry to industry. There is no straight jacket formula. You have to see the industry, decide whether it is naturally bundled or artificially bundled. Now there are few circulars. I'll quickly tell all these circulars. Very simple points are there. Very simple points. Book printing and customized card printing. That is paper and printing involved in both the cases. Book printing and customized card printing. Card I have purchased, I am writing my name and a quote. Customized card printing. Card is already there. There is only printing of the customized proverb and the name. Book printing. Paper printing is there. Customized card printing, paper printing is there. But book printing, both are composite supply. Both are naturally bundled. Book printing. Principal supply is printing. We are going for printing, not for papers. So supply of service. Principal supply in card and customized printing. Card was already there. Principal supply is paper. So supply of paper, supply of goods. I will make it more very clear. If at all I get that book. If I give that book along with classroom teaching. Again composite supply. Principal supply is coaching, not the book. If I sell that book separately. Supply of goods. There is no principal, there is no composite or mixed. It is an individual supply. Right. You have some problem with your vehicle. You go to a mechanic shop. He is replacing your tire, engine and doing normal service. What is the supply? No. Tire he will charge separately. Neither composite nor mixed supply. Engine he will charge separately. Neither composite nor mixed supply. You see the invoice. They will charge it separately. Normal service is a composite supply. Where he will be using water, grease, nuts and bolts and all. It is a composite supply of service. But not the tire and the engine. Tire and engine is neither composite nor mixed. Because separate pricing will be there. That tire, old tire with the mechanic shop, he is giving for rethreading. He is giving to someone for rethreading. What it is? That other person will do rethreading and give it back. What it is? Job work. It is job work. Supply of? He is using some goods. But what is the principal supply? Service. Supply of service. That mechanic person is getting the refurbished tire. And he is selling the tire. Supply of goods. Supply of goods. You need to understand. This is the concept where you can play with this composite supply and mixed supply once you understand these two circulars. Right. So we are done with your composite supply and mixed supply as well. Right. There is one more circular which is talking about bus body building. It depends. If at all the body is of yours and I am just doing bodybuilding, then it is supply of service. If it is my body and I am building the body and selling it, supply of goods. Right, when you talk about yoga along with stay, free. Accommodation, you can go for a 10 days yoga course where stay is free, food is free, then Supply of yoga service. Accommodation and food is ancillary. Principal supply is yoga. If yoga is exempted, entire supply is exempted. Getting that particular, so we are done with all these circles now. Right, composite supply, mixed supply, for surely that will be there in your paper, either a direct question which is rare or part of a bigger question. Or a part of a bigger question, for sure it will be there. Supply also surely you will find, might be in marks wise. Only where there was one instance in RTP where they gave it for 8 or 10 marks. Normally it is asked for 2-3 marks. Supply also will be finding a place in your exam paper. So that is all about your Levy chapter. Everything about your Levy chapter. Now when you talk about your valuation provision, let's start with the valuation provision. Section 15 is the valuation provision. So if you see the section, it's section 15. Rules are there. So section 15 is the basic valuation rules. Whatever rules are there will be seen directly when you are seeing the valuation rules. Now when you talk about your section 15, it tells that if the conditions are satisfied, you are covered in normal valuation. If the conditions are not satisfied, you are covered in special valuations. What are the conditions that they are expecting? They are telling that basically 3 conditions. 2 conditions specifically. One is indirect implication. 1, supplier and recipient are not related. 2, price is the sole consideration. 3rd is an indirect condition. You are not talking about special notified cases. You are not talking about notified cases. So if it is an unrelated party transaction, price is the sole consideration. Other than notified cases, you are covered in normal valuation. You are covered in. So when you are covered in valuation rules, if you are talking about related persons, or price is not the sole consideration, or you are talking about notified supplies, even if the other 2 conditions are satisfied. In those scenarios, you are going to valuation rules. Section 15.4, section 15.5, you are taken to your valuation rules. You are taken to your valuation rules. So normally when you are covered in normal scenario, unrelated party transaction, sole consideration, other than notified supplies. If it is a normal thing, understand that how the questions are being asked. First, the question will clearly give you basic point, which is selling price or service charges. Selling price or service charges. So we are trying to find out what is the value, not trying to find out when to pay. When to pay is the subject matter of time of supply. When to pay will be decided by, see, only when you know time of supply you can find out due date of payment. If I tell time of supply is April, your due date of payment is 20th May, normally. If I tell you time of supply is May, your due date of payment is 20th of June. If I tell you time of supply is March, your due date of payment is normally 20th of April, normally. Obviously in different cases it will change, but normally it is next month 20th. Right, but we are trying to find out value. So whether you are talking, when you talk about the basic price, whether you get in advance, or at the time of supply or after supply, that will be included in valuation. If I have 1 lakh selling price, whether you pay in advance or give at the time of supply or later, 1 lakh will be taxed. When is a separate question? 1 lakh will be price actually paid or payable. Basic price. Price actually paid or payable. So that will be basic starting point of valuation. Price actually paid or payable. Now when you talk about your includes part, how many inclusions are there? Totally there are 5 inclusions. 5 inclusions. Toys. T-O-I-I-S. Toys. There are totally 5. You may not even by heart it. There's no need to remember all these things. Automatically 5 inclusions are there. Toys is the short form to remember that. Right. So rather, if at all you want to have a story, kids will always ask toys. In Hindi, when you are asking something, it is they, DD. So you are talking about exclusion 2DD, discount, at the time of supply or after supply. At the time of supply or after supply. So you are talking about, first we will talk about your inclusions. Very specific points, all with your exam related points, one by one, all the permutation combinations, all we will discuss. First is taxes. First is taxes. Understand that when you talk about tax, all the taxes will be added other than GST. GST cannot be on GST. All the taxes will be added other than GST. So if at all there is excise duty, GST will be on price plus excise duty. If it is road tax, GST will be on price plus road tax. If it is other municipal taxes, GST will be on price plus municipal tax. So GST will come in the end. GST will come in the end. So GST will not be on GST and compensation cess, but GST will be on all other taxes. All other taxes. Let it be your excise duty, let it be your road tax, let it be your municipal tax. I see a question will focus on your municipal taxes. Let it be entertainment tax levied by local authority, so that all will be included. But when you talk about taxes, taxes will not include your income tax TCS. They will not include your income tax TCS. First of all, it is of income tax. It is not an indirect tax. It is of income tax. Second of all, when you talk about income tax TCS, it is not at all tax. Why? When you talk about your income tax, say for example 206C 1H, which is 0.1%. 0.1%. One of the TCS I am taking, recent TCS that is there. This TCS, first of all, it is an income tax. Second, is not at all tax. Why? When I collect that TCS, I will be paying and you will be getting in your 26 days. And if you don't have any tax, you will get the refund. You will get the refund. Right. So income tax TCS will not be included. So if the question tells price 1 lakh, municipal tax is 10,000, income tax TCS some percentage. So GST will be on 1 lakh plus municipal taxes multiplied with the GST rate. It will not be on income tax TCS. 1, it is not indirect tax. 2, it is not at all tax. It is not at all tax. Right. That is all about your first addition. Second addition. O. Obligation of supplier met by the recipient. If it is not already added. See, understand, for all the inclusions, if it is already included, don't include it again. If it is already included, don't include it again. Obligation of the supplier met by the recipient. Put in a very simple language. Recipient making the payment to third party on behalf of supplier. So if I am supplying you, you are paying me 10 lakhs. You are paying me 10 lakhs. And you are paid 1 lakh to third person on my instruction. On my instruction. Value will be payment by recipient to supplier 10 lakhs. Payment by recipient to third party on behalf of supplier 1 lakh. Value will be 11 lakh. Value will be 11 lakh. But if you are paying me 10 lakhs and you are paying 1 lakh to third party without my instruction, not on my behalf, independently, then value will be only 10 lakhs. 1 lakh will be added only if it is payment by recipient to third party on behalf of supplier. I am giving you instruction. You don't know who is the third party. You don't know his name also. That would be the situation. Right. So that is this particular second addition. Third addition. Incidental expenses for anything done before or at the time of delivery. Incidental. It can be the list of expenses. I am giving you say 10-15 expenses, but it may not be. Question will ask you different things. Normal packing charges, special packing charges, protected packing charges, transportation charges, insurance charges, weighment charges, loading charges, unloading charges, inspection charges, installation charges, testing charges, erection charges. Can be anything. Warranty. I can keep on adding all these stuff because these are all different words used by ICA in different questions. All you have to ask, was it the charges which was asked before delivery? If you see the word incidental expenses for anything before or at the time of delivery. Before or at the time of delivery. See, delivery means constructive delivery. If I get this projector, after delivery only installation will be done. But when they do installation only, then I get the constructive final delivery. So this is also before or at the time of delivery. So for along with this projector, installation charges will also be added. You're getting that point? If you get a set-top box, so when you talk about the set-top box, what will happen? They'll come and install. For that, they might ask a separate amount. So their value is the sale value of set-top charges plus installation charges also. Right. Now talking about, this is the third addition. First was tax, second was obligation, third was incidental. Now you're talking about interest. We have already discussed about this interest. It will be added, and when it will be taxed also we discussed. This interest is for late payment. This interest is for late payment of consideration. Your customer is paying you late, for which you are asking interest. For which you are asking interest. This interest is not related to your loan. This interest is for late payment. Late payment. Please differentiate both. It is interest is for your late payment of charges. Right. So one important point for your exam. Interest on late payment. ICAI always believes that it is cum tax. All other additions, if the question is giving you 10,000, you are 10,000. But for interest on late payment, it may be called as, ICAI may use the word interest. It may use the word penalty. It may use the word late fees. Whatever it is for late payment added. But for this addition, you have to do cum tax calculation. For this addition, you have to do, which means 10,000 will not be added. It will be 10,000 multiplied by 100 divided by 100 plus rate. 100 plus. So if there are two additions, one is incidental charges, one is interest for late payment. Incidental charges 10,000, add it fully. Interest on late payment 10,000, you are not going to add it fully. 10,000 multiplied by 100 divided by 100 plus rate of tax. And the last addition here is subsidy. Subsidy has got two conditions for you to add. First, subsidy should be given by other than government. Other than government. It should not be from central government, state government. It should be from other than government. Second, it should be directly linked to the price. Two conditions. It should be from other than government. Second, it should be directly linked to the price. Other than central government, state government, directly linked to the price means it is not a general subsidy. If it is a general subsidy, you cannot find it the value for that transaction. So it should be subsidy linked to the price. Second, it should not be given by government. If it is given by government company, add it. Government is different, government company is different. Government is different, government company is. If it is given by holding company, add it. If it is given by a non-government organization, add it. Government given by anyone, but not being central government or state government. Are you clear with this understanding? Are we clear with this understanding? These are all the additions that you add. Now subsidy, another important headache that is there for your exam. Actually, valuation has got a big headache only in this subsidy. Wordings are not at all clear. Wordings are not at all clear. So you have to be very, normally subsidy, if the question is giving you subsidy, price 1 lakh, subsidy other than government, directly into the price 10,000. Normally you add it. You don't assume that 1 lakh includes subsidy. First point, normal assumption is, it is extra. It is extra. That is a normal assumption. At times, the wordings of ICAI questions are very, very confusing. ICAI itself has given note that you can take other assumption also. So they tell the price 1 lakh. Subsidy considered in price above. Considered in price above 10,000. Now considered in price above has got multiple meanings. Correct? One meaning, considered in price above, it means already it is included. So don't add it again. Other meaning is considered in price above means this price is deducted and final price from customer is given 1 lakh. So this has to be added back. Got that? There your assumption or your note will carry marks. If the question is silent, nothing is very clear. I mean, a very basic question. What you have to do? Add it. You have to think that the price is not including subsidy. Price is taken from the customer. In addition to that, someone is giving subsidy. That is a normal assumption. Then you look at the wordings. And write your notes. Not always assumptions will help you. If the wordings are highly confusing, like the example that I have said, considered and all, then there is an assumption. At times wordings will be very clear. Wordings will be very, at least maximum clarity will be there. Price after deducting subsidy 1 lakh, subsidy 10,000. You have to add it. You have to add it. So wordings at times will be very clear. There your assumptions will not help you. This assumption will not help you. Right. So if you have your TYB, if you are using your TYB, you'll know all these ifs and buts because you already walked through the questions, and you'll find a lot of author's note also telling that how you have to interpret it, and there is a possibility of other assumptions in certain cases, not in all the cases. Now excludes part. Excludes part. 2 exclusions. One very normal exclusion. Both are discount. Discount at the time of supply or before supply. The only condition to deduct discount is it should be on the invoice. Actually, value is net selling price. Value is always net selling price. Price minus discount. Which type of discount? Any type of discount. It can be differential discount, damage discount, quantity discount, trade discount, cash discount, quality discount, any type of discount. If it is there at the time of supply, deduct it. 1 lakh minus discount 10,000, GST will be there only on 90,000. But if discount is given after supply, which means initially you charge 1 lakh, you already pay GST on 1 lakh. Discount is given after 6 months. Can you reverse output tax? You have paid output tax on 1 lakh. Now can you reverse output tax to the extent of 10,000 discount? Yes, but agreement for discount should be there at the time of supply. Though discount is given later. The agreement to give discount was at the time of supply. Second, it is linked with invoices. That is, you have to give credit note, which is linked with invoice. Credit note will have reference of invoice. Most important condition. You are reversing your output tax. Because if I now deduct 10,000, which means I am going to reverse output tax. I have already paid tax on 1 lakh. Say rate of tax is 5%, I have already paid 1 lakh multiplied by 5%. Now if I want to reverse 10,000 multiplied by 5%, I will reverse output tax to the extent of 500, but my customer should reverse ITC to the extent of 500. They are putting obligation on the supplier that you reverse output tax, but your customer should reverse ITC. If they don't reverse ITC, will recover from him, also from you. You are also equally responsible. Are you clear with this understanding? Are we clear with this understanding? So you are talking about 3 conditions. Agreement at the time of supply, credit note linked to invoices. You reverse output tax, supplier, but your customer should reverse proportionate ITC. Proportionate ITC. Then we will allow you to reverse output tax. In case of first category, there is only one document, tax invoice. In the second category, there is tax invoice followed by credit note. Tax invoice followed by, and one more important point, which we'll see in document also. Credit note is optional, which means I can forget about GST. I can give credit note without GST. I can give credit note without, which means I need not reverse output tax. My customer need not reverse. I'll give only credit note of 10,000 without GST effect. I'll give discount but not impacting GST. So that is also a possibility. So that is all basically about your general valuation. Basic valuation. Now what is left out is your valuation rules. Valuation rules. When you talk about your valuation rules, basically when you see your valuation rules, you see your valuation rules when the conditions are not satisfied. Price is not a sole consideration, or related party transaction is there, or notified supplies. So first we are talking about a scenario where price is not the sole consideration, or it is a related party transaction. Notified cases is to be seen separately. Now what are the first 2 conditions? Price is not the sole consideration or related party transaction. For that you have to see valuation rules starting from 27, 28, 29, 30, 31. 27, 28, 29, 30, 31. Right, notified supplies you have 31A, 32. So first we see 27, 28, 29, 30, 31. Now 27 is applicable when? 27 is applicable when price is not the. That is non-monetary consideration. That is whether part or full. That is some non-monetary consideration. Then you are talking about 27. When you see 28, where you are talking about related person transaction or distinct person transaction. Related persons or distinct persons. Branches having different GST number. When you see 29, principal and agent. Principal and agent. We are seeing all the three together. We are comparing and seeing all the three together. First is 27 is non-monetary, 28 is related person or distinct person, 29 is principal agent. Principal and agent. Now when you talk about your one difference which is evident there, in the first two cases, 27 and 28 it is about goods as well as services. Principal agent is only about goods. Only and only about goods. In 27, what are the 4 steps? First, you try to find out your open market value. You see some other transaction, identical transactions and find out open market value. Open market value basically means looking at identical goods or services. Open market value. Next, you see what? You go with whatever monetary consideration is received. Take, if at all there is no open market value, then whatever monetary consideration you have received, take that, add monetary value of non-monetary consideration. Monetary value of, that is possible if the non-monetary consideration is a new item. You can find out the monetary value. So you have given something monetary plus non-monetary. Monetary consideration, say 1 lakh rupees. Non-monetary consideration, say a particular machinery. So if it is a new machinery, I can find out the monetary value of non-monetary consideration. Now, even if that is not possible, then when that is not possible, if at all there is no market value of that non-monetary consideration, or if because it is a second-hand item, or it is a customized item, either or, you are not able to find it. Down, go to third step. Value of goods or services of like kind and quality. Like kind and quality. Here, like and quality means similar goods or services. Not exactly the same, but more or less the same. Similar goods or services. Finally, if you tell that identical goods, open market value is not there, I cannot find out the monetary value of non-monetary consideration. There are no like kind quality goods, services, like kind and quality goods and services. Finally, you go with monetary consideration plus money value of non-monetary consideration. Now you may wonder that money value of non-monetary consideration is ruled out in step number 2. But here money value of non-monetary consideration as per rule 30-31. As per rule 30-31. What is rule 30? 110% of the cost. 31 best judgment. So you may go for that best judgment. Roughly. See, you are going from most accurate to least accurate. Most accurate to, I'll correct my words, most approximate to least approximate. The moment you enter inside valuation rules, it is itself is approximate. So most approximate to least approximate. These are the 4 steps where you have to walk down and find out the value. 4 steps. That is for rule 27. What if it is rule 28? From the 4 steps, remove step number 2. From the 4 steps, remove step number 2. What was the first step? What was the first step? Open market value. Open market value. What was the third step? Second step is removed. Like kind and quality. Last step. Now there is no non-monetary consideration, so forget about that. As per rule 30 or 31. As per rule 30 or 31. Right. And whenever you talk about supplier of service, he is always having an option first to see rule 31, ignoring rule 30. So that option is all. Supplier of service, it's difficult to find out the cost of the service. So directly you can go with rule 31. Step number 1, OMB. Step number 2 is removed. Directly now step number 2 is like kind and quality. Step number 3, rule 30-31. Wait, before we go to the next rule, two important aspects. First, rule 28 has got something which is not there for other cases. What is rule 28? Related person, distinct person. It tells that when you talk about open market value, there is a very, 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 very special and important point. If the If the recipient is eligible for full ITC, whatever value you give will be deemed open market value. Whatever value you will give will be deemed open market value, deemed OMV. Though the value may be 10 lakh rupees, if you give only 1 lakh, if the recipient is eligible for full ITC, whatever value you give, you will pay output tax, you will take full input tax. So government is not much bothered. Whatever value you will give, it will be deemed open market value. Deemed open market value. So that's the concept of deemed open market value, which is not there in 27, which is not there in 29. It is there only in 28. 28. Second important point. There's something called as optional valuation. There's something called as. Now this optional valuation is for 28 as well as 29. This optional valuation is for 28 as well as 29. What is this optional valuation telling? Optional valuation is telling that forget about the steps. Forget about the steps, 3 steps in 28 and 2 steps in 29. What you can do, you can take the selling price of the next person in line and multiply it by 90% to find out your value. Now, this optional valuation, first is applicable only for rule 28, 29, not for 27. Second, it is applicable only for goods. Third, it will be applicable only if the next person in chain, not myself, if my next person in chain is a trader. I may be, for me, you are trying to find out my value. I may be a manufacturer trader, but my next person should be a trader. So whatever goods I am giving him, he is selling as such. He is selling as such. For my valuation, I am dependent on him and he is selling as such. He is selling as such. Supposing you are my related person. I gave you the goods. My value was 100 rupees, which government is not relying on because related person. You are selling for 200 rupees. You are selling for? Understand that government is having valuation issues with my value. They are not trusting 100. But for your valuation, you will be under section 15 itself. Transaction value 200 rupees. There is no problem with your valuation. The problem is with my valuation. Because I am selling to you, you are my related person. You are selling to unrelated person. So there is no issue with you. Issue is only with me. Now, I am covered in rule 28. I have first option. Go with step 1, step 2, step 3. Regular method. OMV or deemed OMV, like kind and quality 30-31. Or I can ignore that. I will tell that I will ignore that. I will take my next person selling price 200 multiplied by 90%. Multiplied by 90%, which will give me 180 rupees. 180 rupees will be my value. Condition number 1. This is applicable only for rule 28 and rule 29. Point number 2. It is only when you are talking about goods, not for services. Point number 3. The next person should be only a trader. Should be only a trader. So that should be that. And he is selling to unrelated person. That is obvious. He is further selling to unrelated customer. Right. So that is that. Now finally you are talking about rule 29. Rule 29. See, from rule 28, which were 3 steps. Now remove second step. So what will be left out? What will be left out? Step 1, open market value. Step 2, 30-31. 30-31. So for principal agent, it will be OMV followed by 30-31. 30. This is regular method. If they want, they can go for optional valuation. Whatever you discuss is equally good for them. Optional valuation, which is only for goods, where the next person is further supplying the goods as such, is there only for 28, that is related person, distinct person, and for 29, principal agent. It is not there for 27. It is not there for 27. That one needs to understand. And one more important point that I have specifically addressed, deemed OMB concept is only for 28 1 year under regular method. Regular method is step 1, step 2, step 3. So step 1 was OMB. If you are a related person transaction, or if it is a related person transaction or distinct person transaction, with the condition that recipient is eligible for full ITC, whatever value you will give will be accepted as open market value. Deemed OMB concept. Now what is 30 and 31? 30 tells that you go with your cost. Take, if you are a manufacturer, 110% of cost of production. Trader 110% of cost of acquisition. Service provider 110% of cost of service. You go with the cost. Normally, you will not directly test 30. You have seen the reference of 30, 31 on all the three rules 27, 28, 29, but you are inside 27, 28, 29. There is a possibility to come directly to 30. When? One classic example, giving gifts of free samples to unrelated person. Giving gifts of free samples to unrelated person. 27 will not cover it because there is no consideration. Forget about non-monetary. 28 is not covered because it is unrelated person transaction. 29 is not there, no principal agent. So directly you will come to 30. So 31 talks about best judgment. Reasonable means. Normally the sequence has to be applied first 30 then 31. But supplier of service is having an option to ignore 30 and directly apply 31. Supplier of service is always having an option to ignore 30 and directly apply 31. So that you need to understand. Now, if you see valuation rules, one part we have already completed. What was that part? What was that part? When the first two conditions are not satisfied. Price is not the sole consideration or it is a related party transaction. Now we are talking about notified supplies. Notified supplies. 31A, betting, gambling, lottery, including horse racing. 32, talking about different scenarios. So first we will see 31A. We'll quickly go through. All the computation formulas are directly there. 31A talks about what? So one side actually talks about betting, gambling, lottery, including horse. See, horse racing is included in betting. It's a clarification. Now when you talk about lottery, they have given a formula. For lottery, it is 100 divided by 128. Why divided by 128? Come tax calculation. Rate of tax is 28. Of higher of face value of the ticket or price notified by the organizing state and gazette, whichever is higher. You take this particular formula. First you take face value or price notified and gazette by the organizing state, whichever is higher, multiply that by 100 divided by 120. That is the answer for lottery. That is the answer for lottery. See, understand that they don't collect tax. So it is a come tax calculation mechanism. But when you talk about your betting, gambling, which includes even horse racing, it is 100%. There is no come tax calculation here. It is 100% of the face value of the bet. It is either the face value of the bet or they are both mutually exclusive. Amount paid into totalizator. Whatever amount of betting that you are paying into totalizator. So it is not whichever is higher concept because it goes either or. Either it will be the face value of the bet where you are not given any betting amount, you just quoted the bet amount, or amount paid into totalizator. You pay that amount. Right. So that will be the answer. Totalizator is an automated machine where you give your betting amount and you put that particular amount. Right. So here it's not higher concept and all. Now when you talk about other areas, rather the most important of the other valuation rules. ICA will always give a question in your section 15. And at times it may have given question of normal valuation section 15 as well as valuation rule. And when it has touched valuation rule, normally it will not touch 27, 28, 29, 30, 31 or 31A and all. It will touch your 32. It will touch your 32. And in your 32, it has most of the times touched your money changer. Money, you are talking about your banks and authorized dealers. Banks and please understand that when you are going for money changing, so if I want $100, the rate is 80 rupees per dollar. I should actually pay 8,000, but I end up paying more. So 8,200 rupees. So we are not focusing on 8,000. 8,000 is mere transaction money. 200 rupees is supply of service margin. Right. So how to find out that 200 rupees we are trying to find out? There are two options. Option 1, Rule 32 2A. Option 2, Rule 32 2B. Understand that options 1 exercise cannot be withdrawn during remaining part of the year. For one transaction, you go for option 1. For other transaction, you go for option 2. You have to select either option 1 or option 2. Throughout the year, for all the transactions, you have to be under that option. Right. Option 1. Option 1 is a very normal option. Right. The normal, you're trying to find out the normal margin. How? If both the currencies, if one of the currencies is Indian rupees and there is a benchmark rate. For India, what can be the benchmark rate? RBI reference rate. Being in India, the benchmark rate will be the RBI reference rate. So, you just go with the RBI reference rate. Whatever you have paid or whatever you are getting, minus the RBI reference rate. Minus the RBI reference rate will be the charges multiplied by the number of foreign currency. Multiplied by the number of foreign currency. So, it will be the difference between buying rate or selling rate and the RBI reference rate. Right. So, example, DK has purchased $100 by paying 6,400, which means he has paid at 64 rupees per dollar. RBI reference rate is 63. Now, what is the difference that he has paid extra? He has paid $1 extra, 1 rupee extra per dollar. 1 rupee extra per dollar. How many dollars? So, the margin is 100 rupees. Margin is 100 rupees. If I tell, if one of the currency is Indian currency, but there is no RBI reference rate. For a particular currency, you may not have find a RBI reference rate. For dollars, obviously you'll find. But that might be for currency where you don't have the benchmark rate. Then the answer is 1% of gross amount of INR that you pay or that you get. That you pay if you want the foreign currency. That you get if you're selling the foreign currency. Either you'll pay Indian rupees or you'll get Indian rupees. Correct? So take that. If I take the same example, if I take the same exact example and I tell that there is RBI reference rate is not available, what I have paid? 6,400 multiplied by 1%, 64 rupees. Correct? If I tell both the currencies are foreign currencies, then what to do? Convert both the currencies into Indian rupees by taking RBI reference rate. Convert both the currencies into Indian rupees by taking the RBI reference rate. Multiplied by 1%. Margin cannot be more than 1% and all. Whichever is lower. A very important. Normally government goes with whichever is higher, but here it is whichever is lower. So if it is say dollars to pounds, I'm not taking the example. Convert dollars into rupees, convert pound into rupees, multiplied by 1%, whichever is lower, that will be the service charges. That will be the service charges. That is option 1. Option 1. Option 2, remember that it works like your income tax slab. It works like your income tax slab. Option 2, what you'll do? Option 2, you'll always take whatever Indian currency you have got or you have paid. See, when I'm dealing with foreign currency, either I pay Indian rupees or I get Indian rupees. So, gross amount exchanged in Indian rupees up to 1 lakh. They think that the margin is 1%. And if it is from 1 lakh to 10 lakhs, it is 0.5%. If it is more than 10 lakhs, for the amount more than 10 lakhs, it is 0.1%. I repeat, it works like your IT slab. It works like your, so if at all gross amount of Indian rupees exchanged is say 1 crore, for the initial 1 lakh, 1%. For 1 lakh to 10 lakhs, that is 9 lakhs, it is 0.5%. For more than 10 lakhs to 1 crore, that is 90 lakhs, it is 0.1%. I'm not taking examples. There are numbers, you can play with numbers. Wait, one important point. Whenever you get the answer, they keep upper limit as well as lower limit. They tell that whatever answer you get, it cannot be lesser than 250 rupees. So if you get an answer less than 250 rupees, bring it to 250. If you get an answer more than 60,000 rupees, bring it to 60,000. So if the answer is lesser than 250, answer is 250. The answer is more than 60,000, then bring it to 60,000. At least one more caution, remember it. This answer, all the answers, whatever valuation rules or provision we discuss, it is per transaction. Per transaction. We find out for one transaction. Don't multiply by number of transactions, because then your percentage income tax slab will become higher, answer will become lesser. No, it is per. First find out the answer for single transaction. Then if such transactions are hundreds of transactions, multiplied by 100. First find out this for single transaction. Single transaction. You got that? Supposing I'll make it very simple. There are two transactions ideally which I have converted for 2 crore rupees. It is 2 crores and 2 crores. You cannot take it as 4 crores. Otherwise, you will end up having lesser answer. So 2 crores, find it for one answer, multiplied by 2. You got that? Because you are working like your slab. You are working like your. If you combine it, more than 10 lakhs will be 3 crore 90 lakhs. For entire 3 crore 90 lakhs, you will look at only 0.1%, which is wrong. Which will give you a lesser answer. No, you work out for each transaction. If there are same type of transaction, find out for one transaction multiplied by the number of transactions. That is option 2. Right. Now all the other small cases, they are pretty simple. First special case for betting, gambling, lottery, 31A. Then we have discussed for money changer. Now things are very pretty simple points, straightforward points. And that is another reason why IC has never touched these areas. Air travel agent, if they ask about air travel agent, it is a bonus. If it is domestic bookings, 5% of basic fare on which he is getting, not other charges and all. There might be other charges, etc., other charges, tax and all. No, it is 5% of only basic fare. If it is international bookings, 10% of basic fare. Other charges you should not include. 10% or 5% of the basic fare, depending on international booking or domestic booking. International 10%, domestic 5%. If it is LIC business, here you are not talking about agent, mind you. Previously it was air travel agent. Airline company, it is basic fare plus other charges, etc. Air travel agent we spoke about. Now it is about life insurance company, not about agent. Life insurance company, just ask a simple question. Whenever you are paying for any LIC, most of you would be paying actually. So you know there is a risk policy as well as risk plus savings. It is purely risk policy. So you will get only at the time of death. Purely risk policy. Entire premium is subject to GST. If it is risk plus savings and savings portion is intimated to you, then savings portion is mere transaction in money. So GST will be on full premium less savings portion. If it is risk plus savings, but savings portion is not intimated, you don't know what is the savings portion, then obviously you know that full premium cannot be taxed. Correct? Because there is some savings portion. What you have to do? You have to ask another question. Is it a single premium annuity policy? Which means one time premium you are going to pay. If you are going to pay one time premium, the premium will be huge. So it is 10% of gross premium. They treat risk portion as 10% of gross premium. If it is a normal policy, which means yearly you are going to pay. Yearly you are going to pay. First year policies 25%. Second year, third year, fourth year. Actually for LIC company, all of them will come together. How? There will be certain policies where it is only risk. For you, full premium. Certain policies there will be risk and savings portion. Savings portion is intimated. For you, full premium minus savings portion. Balance means risk and savings portion is there, but it is not intimated. Then there will be few cases that is single premium annuity. For you guys, 10%. Or yearly premium will be paid. So among you, few of them will be having first time premium 25%. Others will be having second year, third year, fourth year. It will be 12.5%. So LIC company for a particular month they'll have all these permutation combinations. Right. Next you are talking about other small concepts. Second hand goods. Yes, this has been asked once. Interesting thing. Second hand goods, sale of second hand goods, including anything. It can be any type of second hand goods. Any type of second hand goods, not necessarily motor vehicle, they should be sold as such or after minor processing without changing the nature. So second hand good, I should not change, I should not be manufacturing it. Small repairs and maintenance I can do. Second hand goods, understand that I can go for normal option. What is the normal option? I pay GST on the full selling price. Full selling price. I'll enjoy all ITC. Or this rule is talking about a margin scheme. Margin scheme. I'll pay on the difference between selling price minus purchase price. If selling price is 1,50,000, purchase price is 1,00,000, I'll pay GST only on 50,000. If selling price is 1,50,000, purchase price is 2,00,000. Zero. So two important points. Two important points. One, if there is a margin, I'll pay on the margin. If there is a loss, don't make it as negative, it is zero. Make it as zero. Second important point, ITC is not allowed on that second hand item. Other ITC is allowed. Only on that second hand item that you're purchasing, selling, it's not allowed. It is allowed on all the other goods and other services. Right, so that you need to understand. These two important areas you have to understand. Now, this actually is over. There's a special scenario which IC has asked. Interesting to find purchase value. If at all it is repossession, which means there's a higher purchase. There's a higher purchase. So you purchase the goods, you're paying installment. You're failing to pay installment. You're failing to pay installment. So I was the financing company which gave you finance. So I'll take that vehicle again or goods again. So initial transaction is a normal transaction. Fresh item. Now when you fail to pay the installment, I took that goods, vehicle or goods. I am selling that goods. Understand that when I get the goods and sell that goods, it is a second hand item. It is a selling price will be known. When I get from you and sell it, say selling price is say 1,50,000. I know the selling price. But what is the purchase price? What is the purchase price? Purchase price will be a question mark. How to find out the purchase? See, margin scheme, answer is the same still. Selling price minus purchase price. Selling price is clear here. Question will give you, what is about the purchase price? Purchase price is the original purchase price by you. Original purchase price by you. So, original purchase price by you subtracted by 5% per quarter or part thereof. Between what? Between the first purchase made by you and last sale made by me. Between the purchase made by you, initial purchase made by you and last sale made by me. So initially if you purchased in April, I repossessed in June, I sell it in December. So it will start from April to December. April to December. Got the point? So it will be purchase price of you. I am taking your base. So I should start from your purchase date. From April till I sell it. Till I sell it. Right. Quarter in GST always means calendar quarter. If it is April to December, it is 3 quarters. If I change it from June to October, even then it is 3 quarters. Because June will be treated as one part of the quarter, July to September, another quarter, October will be treated as another part. So whether it is April to December or June to October, I have reduced 2 months here, 2 months here. But still answer is 3 quarters. Still the answer is 3 quarters. Calendar quarter. Now when you are talking about the last of such cases, where you are talking about value of a voucher or coupon. What will be the value of a voucher or coupon? If you understood the time of supply in voucher case, it is very simple. It will be the value which is redeemed against that voucher or coupon, whatever it is. Supposing I gave you 1 lakh voucher. I have used only 60,000 voucher. So you will not be taxed on entire 1 lakh, it will be only on 60,000. It will be only on 60,000. Are you clear with this understanding? So that is the last scenario. There is one more scenario where you are talking about supply between related person or distinct person for notified services and all. It's not at all relevant because there are no notified services. There are no notified services. So I am not taking rule 32 Sub rule 7 because it is redundant. There are no notified services. That is everything about your valuation rules starting at 27 to 31 first part and 31A and 32 second part. Now talking about the other set of rules in your valuation, they are rule 33, 34, 35. They are not principal valuation rules, we call them as supporting rules. They will likely not give the answer for value, unlike your 27, 28, 29, 30, 31 or 31A or 32. They will guide you in finding out the value. There's a rule called as rule 33 which talks about your pure agent. Now this pure agent tells that if being a supplier you are collecting extra amount from the recipient, acting as pure agent of the recipient, then that is not included in the value. If you recall, one of the addition point which was there in your inclusion section 15.2 was payment by recipient to third party on behalf of supplier. This is reverse of this. Payment by supplier to third party on behalf of recipient. This is exactly ulta. Payment by supplier to third party on behalf of recipient. What amount recipient has to pay, it is now being paid by supplier, and supplier is going to take that as reimbursement. We are talking about the concept of whether reimbursement will attract GST. Simple question. Whether reimbursements that is being collected by supplier from recipient will attract GST. Answer is no if the conditions are satisfied. If at all the conditions of pure agent are satisfied, you are not going to include it. If they are not satisfied, you are going to include them. You are going to just recollect this point. In one of the addition it was payment by recipient to third party on behalf of supplier. That was added. This is ulta, reverse of it. Payment by supplier to third party on behalf of recipient acting as pure agent. It will not be included. Now what is pure agent? Simple. Agent without profit. Agent without profit. Just remember that. Agent without profit is pure agent. What is meant by agent? Agent means you are first entering into an agreement. Supplier and recipient are entering into agreement telling that supplier will act as pure agent of recipient, pay the amount on behalf of recipient, then collect it from the recipient. Next, agent, whether agent gets any title, agent will pure agent. Supplier will not get any title over the goods. Supplier will not get any title over the goods or services because they belong to the recipient. Plus, supplier will not use that goods or services because they belong to the recipient. That is the definition of agent. There is an agreement. Agent will never get any title. Agent will never use the goods or services belonging to the principal. Pure agent means agent without profit. Last point, there is no profit. He collects only the actual amount. Whatever he has incurred, he will collect the actual amount. Supposing I am a chartered accountant providing incorporation services of a company. My charges are 1 lakh plus 20,000 are reimbursement for ROC fees, stamp duty, etc., printing charges. I am going to pay GST only on 1 lakh. 20,000 is reimbursement. 20,000 is supplier has paid to third party on behalf of recipient. Now look at the conditions. There was an agreement to pay and get back the amount. The supplier never took the title, never used the goods, and no profit. Whatever was actually incurred will be given. Always in this case, my invoice 1 lakh plus 20,000 reimbursement will be supported by other person's invoice. Other person's invoice to prove that I have collected only the same amount. Right? That is the definition of pure agent, and along with that, other conditions you have to satisfy. When you are not required to collect GST on that 20,000. If you are a pure agent, we have seen the definition of pure agent. Plus, you show the breakup on the invoice. That 1 lakh is my service charges, 20,000 is reimbursements. 20,000 is reimbursement. And the last and the most important condition, you are talking about addition to the supplies made. You are not giving the supplies which are in nature of your inward supplies. I'll just give an example, otherwise this will not make sense. This is an extra effort. I could have said no. I could have said no, I will not pay ROC fees, stamp duty, printing charges. You pay yourself. You pay yourself. I had the right to tell no. I am taking some extra efforts to satisfy my client or recipient. Extra. Supposing I am a chartered accountant. Right? Because of an extra work that I got, I hire 2 part-time interns. Right? And I tell my client that, see, normal charges is 1 lakh rupees and you are insisting me to do the work, but I am not interested. I am already tightly held up with my work, but you said that you want my service only, so I have to take 2 part-time work for part-time interns for next 2 months, to whom I will be paying say 20,000. Right? So my charges will be 1 lakh plus 20,000. My intern charges. Client also agrees because he wants only work to be done by me. Now, will I pay GST on 1 lakh or 1 lakh 20? I am not acting as pure agent in this case. It is 1 lakh 20. It is 1 lakh 20. How? They are my inward supplies. Without my interns, I cannot do that particular work. They have got nothing to do with it. Though the client has agreed to pay 20,000 for whatsoever reason best known to the client, but understand that I am using their services. Who is using intern services? The client or myself? They are under payroll of whom? They are under my payroll. They are not under my client's payroll. You got the point? So that will be included. Another case, my client in Bangalore tells that only you have to come and do the audit services. I am incurring expenses for traveling, food and stay. I show them as reimbursement. Can I apply the same pure agent concept there? No. Because travel, food and stay, I use it. I use traveling services. I have my food. I am staying there. So that expenses cannot be, because they are in nature of my inward supplies. Only if they are there, I can give my outward supply. Only if they are there, I can give my outward supply. You get the point? So these things cannot be excluded. They should be my extra outward supply. Extra work. I am doing an extra work without charging anything. As an interior decorator, my interior decorator need not go and purchase these electrical fittings. I have to purchase this. He will show that these are the electrical fittings that you have to purchase. But I request my architect or interior decorator that you purchase, you take the name in the name of Vidyapith Academy, I will reimburse you. No, that is pure agent. Why? My architect or interior decorator, when he went to the shop, he was acting as pure agent. There was an agreement. He never used the fans or electrical items. He never took the title of them. He did not have any profit. Whatever he paid, I reimbursed that. He put that in separately on his invoice. And that was an extra work done by him. Could my interior decorator tell me no, that I am not going to do it? I will show you the shop name, you go there and purchase. Yes. You could have said that. See, what you want is the type of electrical fittings, the model number, etc. And I am also showing you the shops that you can go and purchase. I am not there to do that service. He could have said me no, but obviously I would have got up. He want to retain his clients. He has done that for purposes best known to him. You getting that point? I took the example of ROC, the classic example, to remember that. Right. So that pure agent you will not be including. CHA. Your customs broker pay a lot of expenses at your Chennai port. Customs broker pays a lot of expenses at Chennai port. Obviously, he can take the benefit of pure agent. He pays there for your dog dues. Demerit charges he pays on your behalf. Customs duty he is paying on your behalf. Transportation charges he is paying on your behalf. Now when he gives the invoice, he will write his clearance, his charges, plus all these expenses. All the other expenses, that is including demerit charges, dog dues, port fees, transportation charges, he has incurred on my behalf. Pure agent. He need not charge GST on all these amounts. He can charge GST only on his service charges. Right. And the last example that I am taking with the help of circular, a lengthy circular was given, but a very simple point in that circular was that airline is there, right? When you talk about airline sector, understand that a classic example to end this pure agent. There is Airport Authority of India. They want to collect user development fees and passenger service fees from you. But whenever you go to book any airline, you don't pay anything to Airport Authority of India, isn't it? So if you are booking a flight, do you pay it to them? No. Then who collects that? Airport Authority of India tells the airline company, say Indigo, telling that when you are collecting for the tickets, also collect user development fees and passenger service fees. Is that clear? Now, there are two contracts. Airline to me, passenger. Airport Authority of India to me. But I am paying to whom? I am paying only to airline. But there are two contracts for that. So, airline company will pay GST on its charges. On its charges. That is basic fare, other charges, travel tax, etc. Airline company will also collect user development fees and passenger service fees, which is not their service. They are collecting on behalf of Airport Authority of India. So, will airline company pay GST on user development fees and passenger service fees? No. Who will pay GST? Airport Authority of India. Airport? So, on user development fees and passenger service fees, Airport Authority of India will collect and pay GST, though it is via airline company. They will collect via airline company. Airline company will pay GST on their travelling charges, other charges, travel taxes, etc. Though entire payment I am making to airline company, but there are two contracts. So that is a classic example to explain your pure agent concept, because they are not having any profit margin on that. They are collecting on someone else's behalf. They are collecting on someone else's behalf. Now, that is all about your rule 33. Rule 34. Rule 34 talks about your exchange rate. Again, as I said, 33, 34, 35 are not valuation rules, they are supporting rules. So 34 talks about exchange rate. Whenever you get foreign currency, you have to convert that into Indian rupees to calculate the final value. Correct? How to convert it? First step is find out time of supply. Step number 1 is always time of supply. Step number 2 is on that date, go with the exchange rate. So what is step number 1? Finding out time of supply. There will be various dates. First to find out time of supply. Then on the time of, supposing time of supply is 12th April. 12th April. On that date, for goods, what will be the exchange rate that you will be taking? For goods, you will go with exchange rate notified by CBIC on, say, 12th April. Because time of supply is 12th April. For services, you will go with exchange rate as per generally accepted accounting principles. That is your accounting standards. First step, you will find out time of supply. For example, say time of supply is 12th April. On 12th April, if it is supply of goods, see CBIC rate. Supposing it is supply of services, on 12th April, see what your accounting standard tells as per to take which exchange rate. Right, so that you need to understand. It is only to convert your foreign currency into Indian currency. But step number 1 is, I always tell this, first find date, then find exchange rate. Date rate. DR. First is letter D, then it is R. So first find date based on time of supply. Then find exchange rate based on rule 34. And finally, you are talking about your rule 35. Rule 35 is talking about your come tax calculation, which you have already discussed. Come tax calculation means whenever you find you are in a situation where the amount is including GST, what you have to do? Take the amount including GST multiplied by tax rate divided by 100 plus tax rate will give you tax amount. If it is value multiplied by 100 divided by 100 plus tax rate. Always remember this example to make sure that you never go wrong. 100 rupees plus 10 rupees. GST charge 5. This 100 rupees is selling price. 10 rupees is say transportation charges. You have charged GST only on 100 multiplied by 5%. Later on you found that valuation should have been 110. and rate should have been 18. Rate should have been 18. You found that valuation you did a mistake, also rate you did a mistake. What is the differential tax that you have to pay? Differential tax that you have to pay is, what is the total amount that you have collected from customer? This is equally applicable for you guys. Please focus. What is the total amount of that you have collected from the customers? 115 multiplied by, what is the correct rate? 18 divided by 100. Whether right or wrong, you have finally collected this amount. Whether right or wrong, you have finally collected this amount. You cannot collect anything extra from the customer. Minus, what is the tax that you have already paid to the government? 5 rupees. What is the tax that you have already paid to the government? 5 rupees. Right. So this will be the answer. 115 is the final amount that you have taken from the customer, including the tax. Whether right or wrong, value was wrong, tax was also wrong. But whether right or wrong, this is the final amount that you have collected from the customer, multiplied by the current rate of tax divided by 100 plus current rate of tax, should be the final amount. Minus, what is the tax that you already paid? 5. So what is the value that you will get? So you will get 17 point something. 17.5 minus 5, which will be 12.5. In indirect taxes, rounding off is to nearest rupee 1. Nearest rupee 1. And that is all about your rule 33, 34 and 35. Yes, when you talk about your reverse charge mechanism, we'll be discussing this along with your exemption entries, as questions are also asked along with exemption and RCM. So all the entries of RCM will be covering, exemption few important entries which are connected with RCM, that simultaneously also will be covered. Now when you talk about your RCM, as already discussed, you have 3 categories. One is RCM type 1, section 9353 of CGST and IGST Act respectively. RCM type 2, section 9454 of CGST and IGST Act respectively, and a category which is neither RCM or SCM, which is electronic commerce operator, section 95, section 55. The difference is, when you talk about your section 93, supplier can be any person. Supplies of notified goods and notified services, but for your exams, notified goods is not that. We will not be having notified goods category for your exams. It is not there in syllabus. Right. And recipient can be any person. So supplier is any person, recipient is any person. Goods and services are notified, both notified goods, notified services, but for your exams, you have only notified services. And who will pay the tax? It is the recipient under RCM. When you talk about your section 94, supplier have to be unregistered. Supplier category is unregistered. Recipient is notified plus registered. He should be registered plus also he should be notified. As of now, real estate sector is notified. And goods and services are notified goods and notified services. We have this for your syllabus, even in your QR infographics, the detailed chart, rather the best infographics that we have presented there is this infographics. But the time involved and the efforts involved are not worth for the exams. So never ICAR even tried to test that in exams. Forget about exams, RTP, MTP is not touched. So we will not be touching this area, but be aware that conceptually what is happening. Here supplier is unregistered, recipient is registered plus notified category, and goods and services are also notified goods, notified services. Again here it is the recipient who has to pay RCM. And eco category, supplier can be any person, recipient can be any person, but what is being supplied is notified services via eco. Previously there were 3 notified services, now you have 4 notified services via electronic commerce operator. Here neither the supplier will pay tax nor the recipient will pay tax. It is the electronic commerce operator who will come and pay tax. Right, that is the basic points about this 939495. And when you talk about your RCM and FCM, as you already know, when you talk about your FCM, supplier will collect price plus GST from the recipient, the burden is passed on, and then he will pay GST to the government. So the entire responsibility for taking registration, making payment, filing returns, documentation is all on supplier. When you talk about your RCM, supplier will collect only his price and tell Tata bye bye. Recipient needs to pay GST to the government directly. He'll pay RCM input tax, and if eligible, he can claim RCM input tax credit same month. Now, in this case, the burden of registration, payment, filing of returns, documentation entirely lies on your recipient. Electronic commerce operator, neither the supplier pays the tax nor the recipient pays the tax. The intermediary, ECO, who's facilitating the supply between the supplier and recipient has to pay the tax on the value of the supply of the supplier. So we'll be seeing that as well. And what do you mean by supplier and recipient? Supplier means any person who's supplying goods or services, includes agent. But recipient means a person who's liable to pay consideration. A person who's liable to pay, not receiving. A person who's liable to pay consideration. Normally it will be the definition of recipient. But in cases where there is no consideration payable at all, you have Schedule 1 cases where there is no consideration payable at all. In that scenario, recipient means for goods, the person who's getting the goods, to whom the goods are made available or delivered to, and for services, the person to whom the services is rendered. So normally recipient means the person who's liable to pay the consideration, not paying consideration, liable to pay. But if at all there's no consideration, the person who's getting the goods or getting the services happens to be the recipient. Now talking about your combination of exemption and RCM. Right, so we have categorized your RCM entries in such a way that wherever exemptions are there, we have discussed along with exemption and RCM. We'll start with one of the most important services where you're talking about your Goods Transportation Agency, GTA. So when you talk about your GTA means a person who's providing services of transportation of goods by road. Entire transportation is by road, and he is giving a document called as consignment. Entire transportation should be by road. Right, courier agency is different. It is time sensitive transportation of documents, goods or articles. So time is involved, very fast. It can be goods, documents or articles, and door-to-door delivery, the most important point. You need not go there and give the goods, and you need not take there and take the delivery. There, courier agency will come to your place, collect the goods, and they will deliver at the destination, at the address. So that is the difference between GTA and courier agency. One more difference, courier agency, partial transportation may be by air, by road. So combination is also possible. Not entire transportation need to be by road. Courier agency, everything is taxable. But for GTA, there is some exemption, and when taxable, when there is FCM, when there is RCM, we need to understand. So we'll directly start with that particular exemption. If at all, GTA is giving their services to government who are registered only for TDS purposes. If GTA are giving the services to governmental department or establishment of government, or you are talking about local authority or government agencies. So they are giving their services to pure TDS detectors. See, government will be registered surely for TDS purposes, because anyone who is supplying goods or services to government is required to detect TDS beyond a particular limit. So government will have TDS registration. Government may or may not have normal GST registration. Now we are talking about which category of government or local authority or government agency? That establishment or department of government or local authority or government agency which is having only TDS registration, it is not having normal registration, then it is exempt. If I tell that the government is having TDS registration as well as normal registration, it is not exempt. So government or local authority or government agency having only TDS registration, then if that is the recipient, then they are exempt. And if you are talking about persons other than specified recipient, if you are talking about your recipient not being specified recipient. Now what is meant by not being specified recipient? You should not be a registered factory, registered under Factories Act, registered society, registered under Societies Registration Act, cooperative society or body corporate or partnership firm, whether or not registered, including association of persons. You should not be registered factory, registered society, cooperative society, body corporate or partnership firm may be, whether registered or not. Also registered GST person. Registered? if you are covered under these categories, you are a big person. You are a big person. You should not be covered in any of these categories. So when it is exempt, when you are not a registered factory, registered society, cooperative society, body corporate, partnership firm, including EOP, basically you are talking about an individual or HUF. You are talking about a proprietorship concern or a HUF entity which is also not registered in GST. Basically, who is covered here? You are talking about an individual or HUF entity which is also not registered. Then it is exempt. So to simplify it, you are talking about individual HUF which is not. But why this cannot be summarized always? Even an individual or HUF can be a registered factory. So you need to understand that also. Individual HUF not being registered factory, registered society. Registered cooperative society or body corporate cannot be there. So even that individual and HUF should not be a registered factory. So that you have to be very careful. Now others, these two are the persons who are exempted. Now others, if it is specified goods transportation, it is exempt. Specified goods transportation, it is exempt. Now what are the specified goods? NAMO RD. The short form to remember is NAMO RD. So you are talking about registered newspapers, magazines, agricultural produce which includes wheat but not rice. Paddy is covered but not rice, but never to worry, rice is separately exempted. Milk, salt, food grains. Be very specific. Milk, salt, food grains including flours, pulses and rice. So here sugar is not covered. Sugar products are not covered. They were covered long back in service tax, but now they are not covered. What is covered is milk, salt, food grains which includes flours, pulses and rice. Organic manure, the relief materials in case of natural or artificial disaster or calamities, and defense materials or equipments. These are the 6 products when exempted, when transported through GTA, they are exempted. So first we have seen person specific exemption. Pure TDS deductor other than specified services with small persons. Then it is goods based exemption. This is goods based exemption. Even if you cross this, then you have value based exemption. If the amount is less than or equal to 1,500 for the entire truck, if you are booking the entire truck, the exemption limit is 1,500. If it is only part of the truck, then the exemption for you is 750 per consignment. Then it is exempt. Then it is exempt. So if it is not covered by person based exemption, not covered by goods based exemption, not covered by value based exemption, finally, it will be taxable. And friends, when it is taxable, again you have to think whether RCM or FCM. If GTA is opting for 12%, it tells that no, I want 12%, I want to enjoy ITC, then it is FCM. If GTA decides not to opt for 12%, rather than reading opts for 5%, not opting for 12% would be the right term, then it is RCM. Recipient have to pay GST in RCM and he can take credit. Who cannot take credit is GTA, but recipient can take the credit. So that is all about your goods transportation agency. Now we are talking about your legal services by advocate. Legal services by advocate. We will read this along with your arbitral tribunal services. Because when you talk about legal services by advocate and arbitral tribunal services, one thing which is common is when they are providing services to client. Advocate has got complication only when they are providing services to another advocate. Right. So when you are talking about legal services by advocate as well as by arbitral tribunal, there are few things which are common exemptions. So we are talking about legal services by advocate as well as arbitral tribunal. Arbitral tribunal. If the services are given to government or local authority or governmental authority, exempted. Non-business entity, if it is given to non-business entity, exempt. Small business entity in India, taxable territory, exempt. Big business entity in taxable territory, taxable. Business entity in non-taxable territory, taxable. So when the services are given to government, local authority or governmental authority or governmental entity, it is exempt. When it is given to non-business entity, it is exempt. When it is given to small business entity means previous year. Normally when you are checking exemption, it is of current year, but here you are checking for the opposite person. So previous year aggregate turnover is within the threshold limit. Previous year aggregate turnover of the recipient is within the threshold limit of 40 lakhs, 20 lakhs or 10 lakhs, it is exempt. He may be registered also, but forget about the fact. His previous year aggregate turnover is within the threshold limit, exempt. If the business entity's previous year aggregate turnover is more than the threshold limit, more than 40 lakhs, 20 lakhs, 10 lakhs as the case may be, then GST is there, but under RCM. If you are talking about business entity non-taxable territory, foreign country, and GST is there, you need not check whether it is small or big because for them threshold is not there. It is GST is there, but under FCM. So this is equally true for any advocate and arbitral tribunal. Any advocate and arbitral tribunal. Right, so what you need to understand is, when you are talking about advocate to clients, the answer is exactly same for any type of advocate, very similar to or exactly same that of arbitral tribunal. There is no change at all. There is no change at all. And as discussed, when you are talking about your governmental entities also covered, when you are talking about your business entity, small or big, this will be using many places. You are not talking about your turnover, you are talking about the recipient's turnover. So you are going to check previous year aggregate turnover within the threshold limit 40, 20, 10 lakhs, depending on who is it, who is the opposite person, what is he doing, then it is exempted. If it is crossing the limit, then he is a big business entity, it is taxable under RCM. The fact that the opposite person is registered or not registered, forget about it. That is not relevant. That is not. He may be a small business entity but registered, still exempt. Or he may be a big business entity but unregistered, still taxable under RCM, which means opposite person now has to take compulsory registration. So that you need to understand. Right. Then where the entire issue comes up? The entire issue comes up only and only when you are talking about advocate to advocate. Advocate to advocate is the only place where you will have all the sets of issues. When it is taxable, how much, who has to pay. So advocate to advocate, you have to categorize them into first senior advocates to advocates. Senior advocates to any advocate. Second, you are talking about other advocates. When I talk about other advocates, it covers two categories. Other than senior advocates, don't call it as junior advocates, other than senior advocates and firm LLP of advocates. So on the left hand side you have senior advocates, supplier. On the right hand side you have other than senior advocates, firm or LLP of advocates. Now who are their recipients? Recipients are also advocates, subcontract. Recipients are also, if the recipient is client, there is no issue at all. And this category what we are discussing, normally ICA has never even tested in exams. Forget about tested in exams. RTP, MTP or study mat, they have not tested, but still we'll just walk through it, the difference between these two categories. Now you have to ask a question whether it is representation services or other services. Other services means advisory services. Whether the service is to represent in an appellate authority or tribunal or court or before any authority. Before any authority. Other services, sitting in the office, they are giving the services by way of advice, consultancy, etc. Now if it is representation services, you have to ask another question, whether the litigant is a business entity located in taxable territory. Whether the litigant is the business entity located in taxable territory. And if that is the case, which means I am the senior advocate, you are the other advocate, you have a client who has come to you and you have come to me. So you are talking about other advocate has a client called as business entity in taxable territory, you are not able to handle it, therefore you have come to me, I will be taking up your case in that appellate authority or court or tribunal on your behalf. So basically you are my recipient, other advocate is my recipient. Right? You're talking about that category. But forgetting the fact that the other advocate is the recipient, now you have to ask a question whether other advocate's client, which is a litigant, for whose behalf representation will be made, whether that litigant is a business entity in taxable territory. If that is the scenario, ask another question. Whether it is having turnover, small business entity, which means it is having aggregate turnover in previous year less than the threshold limit. If that is the scenario, it is exempt. If that is not the scenario, it is taxable under special RCM. Litigant will pay. Taxable under special RCM. Technically, my recipient is other advocate, but my other advocate will not pay. It will be paid by the final beneficiary. Litigant. Final beneficiary. So neither senior advocate will pay nor other advocate will be paying. It will be paid by the business entity in taxable territory. See, in very simple context, whenever it is representation services plus the litigant is a business entity in taxable territory, forget the fact that there is another advocate in front. You look at only litigant. Ask whether he is small. If it's small, exempt. If he is big, it is taxable under special RCM. When I tell special RCM, litigant will pay. Now, if you look at even the same category of when the service is provided by other than senior advocate firm LLP of advocate, and if the service happens to be representation services for business entity located in taxable territory, it is exactly the same. If his turnover is lower in the previous year, which means small business entity, exempt. If it is big, then it is taxable under special RCM, which means this category representation services with a condition attached that you are talking about litigant being a business entity, not a non-business entity, plus in taxable territory. The answer is the same whether it is a senior advocate or other than senior advocate or firm or LLP of advocates. So this category again is the same whether you are a senior advocate or other than senior advocate or firm or LLP of advocate. If you are giving your services to another advocate where you are giving representation services on behalf of a litigant which happens to be business entity in taxable territory, answer is exactly the same. Just ask a simple question. In those scenarios, forget about the fact that the recipient technically is other advocate. That other advocate removes from the picture. You have to only see the litigant. Ask a question whether the litigant is small business entity, exempt. Big business entity, taxable, special RCM. I am calling it special RCM. Litigant will pay. Technically, my recipient is other advocate, but who will pay? Litigant will pay. So that you need to remember. So this area is same for senior advocate, other than senior advocate, firm LLP of advocates. Now where lies the difference? The difference is in representation services, where either it is a non-business entity or it is a business entity located in non-taxable territory. In that scenario, first we are talking about. Now our entire focus is on senior advocate. In that scenario, you have to ask a question whether the opposite party, now the opposite party is whom? Who's the recipient? Other advocates turnover in previous year is lesser than the aggregate turnover, threshold limit, exempt. If it is more than the threshold limit, taxable under RCM, advocate will pay. Now you are not looking at the other advocate's client, you are looking at the other advocate itself, because technically he is the recipient. And if it is advisory services by senior advocate to other advocate on behalf of other advocate's client, don't see the other advocate's clients, only see the other advocate. If the other advocate is small person, exempt. Big person, taxable under normal RCM. So when you see this particular area for senior advocate to other advocate, which means which area? One is advisory services, one is representation services to non-business entity or business entity in non-taxable territory. You are looking technically only at the other advocate as a recipient. Ask whether he is small, exempt, whether he is big, taxable under RCM. Taxable under RCM. No, the difference is only in this area. If the same kind of services is given by other than senior advocate or firm LLP of advocates, which means if they are giving representation services to non-business entity or business entity in non-taxable territory, or they are giving advisory services, then you are not checking. You are not at all checking who's the other advocate, big or small, it is exempt. So difference lies only in this area which I have marked or circled in green color. Right, so to make it very simple, representation services to business entity where the litigant is business entity in taxable territory, do not categorize into senior advocate, other than senior advocate, firm or LLP of advocates, because the answer is the same. You forget the other advocate, look at the litigant. Litigant is small, exempt. Litigant is big, taxable, special RCM. Litigant will pay. Now, other than that services, which means representation services to non-business entity or business entity in non-taxable territory or advisory services, if it is senior advocate, then you have to check the other advocate's previous year aggregate turnover. If he is small, exempt. If he is big, taxable under RCM, the other advocate will pay. If the service is given by other than senior advocate or firm or LLP of advocates, then it is these services, that is representation services to non-business entity or to business entity in non-taxable territory or advisory services. Do not bother about the other advocates turnover and all. It is straightly exempt. Straightly it is exempt. So that is all about your advocate, legal services by advocate and arbitral tribunal services. Now you are talking about sponsorship services. So when you talk about sponsorship services is exempt only in one particular category. Sponsorship is for an event organized by notified bodies. And what event? Only sports event. So it is exempt for sports event plus other condition, notified body. It is exempted when the sponsorship is always for an event. Now it is exempt only when it is for a sports event where it is organized by notified body. Now who are all notified body? Again, the name itself will make you feel that okay, they have some affiliation with national authorities or state authority or district authorities. Name itself will give you that indication. National Sports Federation or affiliated federation where the participating team or individuals are representing any district or state or zone or country. Right. Obviously, your BCCI and all will automatically get covered here. Association of Indian Universities or Inter-University Sports Board or School Game Federation of India or All India Sports Council for the Deaf Paralympic Committee of India or Special Olympics Bharat. Again, that category is exempted. Normal schools may not be covered here when they organize that particular sporting event. Then you are talking about civil services, Central Civil Services, Cultural and Sports Board. Then you are talking about you are participating as a part of national games by Indian Olympic Association. And finally, you are talking about promotion of sports in village under a particular scheme, Panchayat Yuva Krida or Khel Abhiyan scheme, where it is focusing on promotion of sports in villages. So these are the notified bodies. You need not buy out the names, just be familiar. Okay, the names are symbolizing that they are having some connection with the governments. Right, so these bodies, if they are these bodies, if they receive sponsorship, which means they are getting the amount, they are the recipient. Rather, beg your pardon, they are the supplier. The recipient is the person who is sponsoring that particular event. Then it is exempted. They are getting that amount and they are making sure that in the entire event, the person who has sponsored that is the recipient. Entire event, his name or the company name is promoted. Right, so this is the only category which is exempt in sponsorship services. Any other sponsorship services, it may be for, if at all I want to be very specific, it is sports event but other than notified bodies or any other event, then it is taxable. Now once it is taxable, please ask yourself a question. Forget about who is the supplier. Please focus on who is the recipient. If the recipient is body corporate or firm or LLP. Condition number 1, body corporate firm or LLP. And in all RCM, the one condition will be very common, that the recipient should be in taxable territory, then RCM. Now, if the recipient is not body corporate firm or LLP, other cases, or it is body corporate firm or LLP but not located in taxable territory, then it is FCM. Then it is FCM. You are not required to see who's the supplier. You are required to see who's the recipient. And the challenge in sponsorship services is finding out who's the supplier and who's the recipient. Just remember this example, you'll never go wrong. So if it is say Pepsi IPL or Vivo IPL, right, who's the supplier? Organizers of IPL are the supplier. They are getting the amount. The person who's getting the amount is the supplier. And who's the recipient? Pepsi or Vivo company. Who's giving the payment? Why Pepsi or Vivo is giving the payment? So that their name is that throughout the event. They are getting, sponsorship is a type of advertisement service. Specific type of advertisement service. Right, so be very careful in the question who's the supplier and who's the recipient. Then forget about who's the supplier, see the recipient, whether it is body corporate firm, LLP in taxable territory, RCM, otherwise FCM. Now friends, we are talking about services given by government. One of the biggest services, rather the biggest services for exemption and RCM. And once you are through it, you will find all the exemption entries and RCM entries quite simple. So when you talk about services given by government, that is central government, state government, union territory or local authority. So when the services are given by government, first ask yourself a question. Whether it is PML services. What is PML services? Which we have discussed long back in your supply. Panchayat services, Article 243G. Municipality services, Article 243W. L. Alcoholic liquor license fees. Liquor license fees. PML services. If it is PML services, it is not at all supply. It is not at all supply. Right. Forget about supply. It is not at all supply. It is not under Schedule 3 here. It is notified category. It is not supply. Notified category. Not supply by virtue of notified category. PML services. Other than PML services. So first category, remember it as PML. PML, not at all supply. Then other category, focus on PPT. Now what is PPT? PPT stands for Post, Port, Airport and Transport. PPT. PPT. When you talk about postal services, if you are talking about normal postal services, it is exempt. It is exempt. Now you may ask, what is normal postal services? For that you need to understand what is special postal services. Special postal services means we are talking about speed post, express parcel post, life insurance and agency services. Speed post, express parcel post, life insurance and agency services means it is acting as an intermediary, maybe to give mutual fund forms or bonds or passport applications or collection of electricity bill or phone bills. It is acting as an agent. It is not exactly giving that services, but it is acting as an agent between you and the other government body. So it is acting as an agent. Agency services. These are all special postal services. So normal postal services basically talks about your postcard, inland letter, book post, registered post. Book post, registered post comes in your normal postal services. Opening of your post office savings bank account, transfer of money order, postal order, that is all normal postal services. Normal postal services exempt. Need not remember what is normal postal services. Remember what is special postal services. Speed post, express parcel post, life insurance and agency services. Wait, not always it is taxable. If it is given to government, which means Department of Post giving to other department of government, then it is exempt. If it is given to other than government, that other than government can be business entity or non-business entity. It can be business entity or then it is taxable under FCM. It is taxable under your FCM. No RCM till now. So postal services, be very careful. Normal postal services to anyone exempt. Special postal services to government, exempt. Special postal services to other than government, whether it is a business entity or a non-business entity. You and I, if we go for speed post, we may be non-business entity, but still it is taxable under FCM. Port airport services. Port airport services, which means whatever services you find inside the port or airport or precincts of the port or airport given by the government. Right, Port Trust of India or Airport Authority of India, given by them, then it is taxable to you or to the airline companies or the shipping companies. It is taxable under FCM. The services may be given to you or it may be given to airline company or the shipping company. It is taxable under FCM. Transportation services. Transportation services, you have to ask a question whether transportation services is, if at all it is by private entity, if it is exempt, by government also exempt. If by private entities it is taxable, then for government also it is taxable. So there is no special point for government. So for transportation services, you have to refer transportation sector, see whether it is exempt for private entity, it is exempt for government also. If it is taxable for private entities, it is taxable under FCM for government also. Right, that is the answer for PPT. First we have seen PML, not at all supply, PPT may be exempt and it may be taxable. When taxable, it is taxable only under FCM. Till now we have not seen RCM. Other than PML, PPT services. Now you are talking about other than PML, PPT services. So it is not PML, it is not PPT services. Then ask yourself a question whether it is to non-business entity. If it is to non-business entity, exempt. If it is to business entity, wait. Ask yourself a question whether it is to government or your local authority, government, central government, state government, union entity or local. Supplier is also government, recipient is also government, exempt. So if it is to non-business entity, exempt. If it is to business entity, wait. If it is to business entity which happens to be the other department of government, exempt. If it is to other business entity, then again you have to wait. You have to ask yourself a question whether that other business entity is a small business entity. Whether the other business entity is a small business entity, exempt. If it is a big business entity, no. Wait. Again you have to ask a question whether the value is small. What is meant by small? 5,000 per contract, but if it is continuous supply of services, 5,000 not for one payment, 5,000 for the entire financial year. Normally it is 5,000 per payment contract, but if it is continuous supply of services, you have to see 5,000 for the entire financial year. Right. Now, if you look at other than PML PPT services, you have to ask multiple questions. Non-business entity, exempt. Business entity, wait. Government, exempt. Other than government, wait. Small business entity, exempt. Big business entity, wait. Small value up to 5,000, exempt. Big value, again wait. If it is big value, you have to wait for notified services. There is a list of notified services that you have to go through and be familiar. Do not try to buy it, go through it and be familiar. Then it is exempt. Then it is exempt. Now, other than these notified services, then for the first time it is taxable. For the first time it is taxable. You have to come through this chain. So if it is other than PML PPT services, you have to ask multiple questions. First, non-business entity, exempt. Business entity, wait. Government, exempt. Other than government, wait. Small business entity means previous year aggregate turnover is less than the threshold limit, exempt. Big business entity, wait. Small value up to 5,000 per contract. Normally, if it is continuous supply services per financial year, exempt. Big value, wait. Notified category, exempt. Other than notified category, for the first time it is taxable. And friends, once it is taxable, again you have to ask another question. Is it renting of immovable property? If it is renting of immovable property, then RCM, FCM answer is different. Renting of immovable property, if the recipient is unregistered, it is taxable under FCM. If the recipient is registered, it is taxable under RCM. So for renting of immovable property, you have to ask, it is taxable, but you have to ask whether the recipient is registered. Registered means he can take care, RCM. Unregistered, he cannot take care, FCM. And for other than renting of immovable property, you have to ask another question, whether the recipient is in non-taxable territory. If he is in non-taxable territory, you cannot ask him, FCM. If the recipient is in taxable territory, then he can take care. It is under RCM. It is under RCM. Right. First you have to cross all these categories. When it is taxable, again bifurcate into two. Renting of immovable property, other than renting of immovable property. Renting of immovable property, recipient, registered, RCM. Unregistered, FCM. Other services, recipient in taxable territory, RCM. Outside taxable territory, FCM. Right. So actually, strictly speaking, only these are the two categories where for government it is under RCM. Rest all categories, wherever it was for taxable, it was under FCM. It was under FCM. Right. So you have to walk through all these challenges. PML, PPT, keep it separate. Other than PML, Panchayat Municipality Alcoholical License fees, and PPT, post port transport. Then keep on asking questions. Non-business entity exempt. Business entity, wait. Government, exempt. Other than government, wait. Small business entity, exempt. Big business entity, wait. Small value up to 5,000, exempt. Big value, wait. Notified category, exempt. Other than notified category, taxable, but wait. Renting of immovable property, recipient, unregistered, FCM. Recipient, registered, RCM. Other than renting of immovable property, recipient in non-taxable territory, FCM. In taxable territory, RCM. One special point, this small business entity, big business entity, this exemption is not applicable for renting of immovable property, which means when you are seeing renting of immovable property, you need not see whether the business entity is small or big. That particular check you need not do. When it is renting of immovable property, other services you have to go through all the checks. When it is renting of immovable property, you will check all the other conditions. If it is non-business entity, exempt. If it is business entity but government, exempt. But you need not check whether it is small business entity or big business entity. There's no difference. There's no difference. So for renting of immovable property, the exemption which is available for small business entity is not available. So whether you are small or big, it does not make any difference. So this is a special point you need to remember. Other than that, you will find that this lengthy exemption services and RCM services for government, the lengthiest category of exemption and RCM, we are done with. Now, as I said, real estate sector, yes, you have to see real estate sector. If time permits, real estate sector, not so important. This real estate sector exemption, you have to read it along with section 9.4 or 5.4 RCM. I am not touching this area for your exam purposes. Right. Talking about other small services. Directorial services we have already completed, we will again walk through. If you are talking about managing director, whole-time director, who is getting remuneration, where TDS is also deducted under section 192. It is covered in schedule 3, not at all supply. If it is other directors, other than managing director, whole-time director, who are getting, you are not getting remuneration, they are getting sitting fees or professional fees. Company is also deducting TDS under 194J. Then it is taxable, and once it is taxable, it is under RCM. Right. So that category we have already discussed when we discussed about your supply. Insurance agent services. Insurance agent services. Who is the supplier? Supplier is the insurance agent. Recipient is the insurance company in taxable territory. Supplier is the insurance agent. Recipient is the insurance company in taxable territory, RCM. Who will pay? Insurance company will pay. But again here understand that all the RCM entries you have, you will always find that if you change the question, it can be FCM. Here also, if you are talking about companies like policybazaar.com, they may not be insurance agents. If they are having insurance agent license as per section 42 of Insurance Act, then RCM. They are not having insurance agent license as per section 42 of Insurance Act, then FCM. Then FCM. Next, friends, we are talking about temporary transfer or permitting the use or enjoyment of copyright. We are not talking about any intellectual property right. We are only talking about copyrights. Which means if it is other than copyrights, it is always FCM. We are only talking about copyrights. Only and only focusing on copyrights. You have to divide that into two. First category, original dramatical work, musical work, artistic work. So first category is only DMA. DMA, dramatical work, musical work, artistic work. Second is original literary works, literature. Original literary works. In the first category, who is the supplier? The supplier is the music composer, photographer or the artist. And the recipient is the production house. The recipient is which means a music company or a producer in taxable territory. It is under RCM, which means the music company or the producer will pay GST under RCM. But wait, important point is, it is always focusing on original work. So if at all you are talking about A.R. Rahman composing music for Sony Music, it is Sony Music who will pay under RCM. But if Sony Music is further giving the copyrights to various apps like your JioSaavn or say Spotify, then it is not original literary works. It is further transferring the copyrights. Then it is under FCM, because it is not about original musical works. Now when you talk about literary works, original literature work, who is the supplier? Supplier is the author. Who is the recipient? Publisher located in taxable territory. Who will pay tax? Publisher located in taxable territory will pay tax. It is RCM. But wait, author can tell, no, I want it to be under FCM. Normally if it is under RCM, supplier cannot tell I want it to be under FCM. This is an exception. Normally if a category is under RCM, only recipient has to pay tax. Supplier cannot come forward. But here, supplier, the author can tell that, no, I want it to be under FCM. So author has to do what? Author has to be registered. He has to tell that I want to go under FCM by giving a declaration to jurisdictional commissioner. When he is giving the declaration, he has to promise that he will not withdraw that option of FCM for next 1 year. So first main condition is he has to be registered and he has to give a declaration to commissioner telling that I want to go under FCM. I will not withdraw within 1 year. Obviously, when he is going for FCM, he has to write even on his invoices that he has opted for FCM. On his invoice, this is not a main condition, this is a procedure. That on his invoice, he has to write that he is opting to pay tax under FCM. What are the conditions? He should be registered, he should inform the jurisdictional commissioner that he is willing to pay under FCM and he should not withdraw that within 1 year. Right, procedure on his invoice he has to mention that he has went for FCM so that publisher will not pay again. Right, so that is the category when you are talking about your temporary transfer or permitting the use or enjoyment of copyright. Next you are talking about banking sector, a lot of services which comes under your RCM. First, you are talking about services of a recovery agent. When they are provided to banking sector, that is banking company, financial institution, NBFC located in taxable territory, it is under RCM. Recovery agent to banking sector is under RCM, but recovery agent to other companies is under FCM. The same recovery agent can be appointed by other companies like say Tata or Reliance, then it is under FCM. Next, we are talking about services of direct selling agent. I am not touching the previous point. First, we will talk about recovery agent, direct selling agents. If the direct selling agent happens to be individual, then it is RCM. If the direct selling agent happens to be, say, a partnership firm or LLP or body corporate, then it is FCM. You getting the point? For all RCM, remember 2 points always. That if you change the question, it can be converted to FCM. Second, Conditions are different for all RCM. Who should be supplier, who should be recipient. Normally when we are seeing RCM, we focus on who should be recipient. But in this case, we are focusing on who should be the recipient. Should be banking sector. That is banks and NBFC located in taxable territory. But supplier should be individual direct selling agent. If it is other than individual direct selling agent, it is FCM. Then you are talking about a particular community. Right, so you are talking about members of overseeing committee of RBI. Members of overseeing committee. RBI will have a lot of committees. One of the committees is overseeing committee. So these members will be providing their services to RBI. RBI will pay under RCM. So members of overseeing committee to RBI, RCM, RBI will pay. Members of other committees to RBI, then that will be covered under FCM. Now friends, we are talking about two categories where we are talking about business facilitator or business correspondent. Business facilitator or business correspondent. To be in a very simple terms, business correspondent is actually working like a bank. Directly working like a bank or insurance company. You will never feel that they are not part of the bank or insurance company. Business facilitator is a small person who will be doing few works again of the banks and insurance company, but not getting so much authority. More authorities to business correspondent, lesser authorities to business facilitator. Remember that. Both are banking and insurance mitras. Both are helping out the banking sector and the insurance sector. So when you talk about business facilitator, always remember that he is a person who is having lesser authority, small person. Now first let us talk about the exemption, then let us talk about FCM RCM. When you talk about business facilitator to bank or insurance company in rural area, exempt. In rural area it is exempt. So if business facilitator is providing services to a bank or insurance company in rural area, it is exempt. It is exempt. Likewise, same way, if the business correspondent is providing services to bank or insurance company in rural area, it is exempt. To that extent, there is no difference. Business facilitator or business correspondent providing services to banks or insurance branch in rural area, it is exempt. Now, where is the difference? Business facilitator or business correspondent can get the help from agents. They might not be able to give their entire services. They may take the help of third persons. If the agent is providing services to the business facilitator or business correspondent in relation to rural area or rural branch of bank, it is exempt. Which means if an agent is providing services to business facilitator or to business correspondent in relation to an insurance company branch in rural area, it is not exempt, it is taxable. It is taxable. The difference is now to this extent, actually there is no differentiation between, for exemption, whether it is business facilitator or business correspondent, there is no differentiation. If BF or BC is providing services to insurance company in rural area or banking company in rural area, it is exempt. Both. But if agent is providing services to BF or BC in relation to, they are not providing services to bank and insurance company, they are providing services to BF or BC in relation to a rural branch of bank, it is exempt. But if it is in relation to rural branch of insurance company, it is taxable. It is taxable. So when we are seeing this exemption entry, need not differentiate between business facilitator and business correspondent. When the differentiation comes, when it is taxable, whether it is FCM or RCM, that differentiation comes. Now, anything else, what is covered in exemption is taxable, which means if at all it is all related to urban area, then everything would have been taxable. Right, now when you are talking about FCM, RCM, you need to differentiate who are you, whether you are BF or BC. Your BF or BC. Exemption entry is same for BF and BC, but RCM, FCM is different for BF and BC. So now you are talking about BF, a small person. BF to bank. BF to bank, RCM. Bank will help. BF to insurance. BF to bank, it is RCM. Bank will help. BF to insurance, it is FCM. Insurance company will not help. Insurance company will, technically this should also be have under should have been under RCM. BF would have been free. Agent to BF. See, BF is a small person. He tells that I cannot help you. You pay under FCM. You pay under. Remember that BF is a small person. If you remember that, your work becomes very, very simple. Agent to BF. BF cannot take the responsibility. So agent will pay under FCM. BF to bank. BF is a small person. Bank will take the responsibility. RCM. BF to insurance company. Technically, this should also have been under RCM. But now, in this case, insurance company will not help, though it's a small person. It is under FCM. Now, as you know, BC, business correspondent, is a big person. If you remember that, everything becomes very, very simple. He is a big person. So, agent to business correspondent. Business correspondent will help. RCM will help. He will pay under RCM and he will take the credit. Business correspondent to bank or to insurance company. He is a big person. He need not have anyone's help. FCM. So, if you see BC, it is fully logical. Right? Agent to business correspondent, he is a big person. RCM. Business correspondent to bank or insurance company, he is a big person. He can take care of himself. FCM. But if you see BF, mostly it is logical except for one point. Agent to BF, he is a small person. He cannot help. Therefore, agent has to pay under FCM. BF to bank, he is a small person. Bank will help. RCM. BF to insurance company, though he is small, insurance company will not help. It is under FCM. BF has to pay. So that you need to remember. So we have discussed exemption for BF, BC, also RCM, FCM for not only for BF, BC but also for the agents of BF, BC. Next, you are talking about security services. Security services. Now friends, when you are talking about your security services, be very careful. Who is the supplier? Who is the recipient? If the supplier is other than body corporate, recipient is registered. Whether he is body corporate or not body corporate, forget about the fact. Because we will be seeing another entry where supplier is other than body corporate, but recipient should be there. Forget whether it is registered or not registered. So be very, very careful. Security services, supplier should be other than body corporate. Recipient should be registered, GST registered person in taxable territory. Then it is under RCM, but wait. Then basically it is under RCM, but wait. In following cases, RCM will not apply. When I tell RCM will not apply, it is FCM. What all cases? Though supplier is other than body corporate, though recipient is registered, but still FCM. What all cases? If recipient is department or establishment of central government, state government or local authority or government agencies who are registered only for the purpose of, these are government entities who are registered only for TDS purposes, not for normal GST number. They don't have normal GST number. They have only GST TDS number. Then it is this point we have already seen elsewhere. GTA, but there it was about exemption. Here it is about FCM. There it was about if GTA is providing services to same category, department or establishment of government or local authority or government agencies who are registered only for TDS, then it would have been exempted. Now, here you are talking about supplier being other than body corporate, recipient being government who are registered only for TDS, then it is under FCM, not exempt, it is under FCM. It's not exempted, it is under FCM. Or or the recipient is registered but under composition scheme. But under composition scheme, it is under FCM. In both these cases, it is, see, look at this way. First of all, understand that there's no exemption for security services. Every time it will be taxable. Only thing that you have to decide is whether it is RCM or FCM. That is the only decision that you have to take. Supplier is body corporate. All the cases, FCM. Need not see anything. If supplier is body corporate, forget about everything else, FCM only. If supplier is other than body corporate, ask yourself a question. First question, if it is unregistered, FCM. If it is unregistered, FCM. If it is registered but under composition scheme, FCM. If it is registered but only for TDS purposes, FCM. If it is registered, normal GST number and regular scheme, then it is RCM. Then it is RCM. You have to be very careful when analyzing your RCM entries. This is not only true for this. For all the cases that we have seen, you will change the question, you will find that RCM suddenly converts to FCM. The next services, you are talking about renting or lending services. Renting or lending services. So you are talking about your renting of motor vehicle designed to carry passengers, where cost of fuel is also included in consideration. Normally, whenever you go for renting of motor vehicle, cost of fuel is always included, other than the fact that it is your own vehicle. If you for your own vehicle, you will not be paying rent. So cost of fuel is always included. If you go for any renting of motor vehicle, they will not tell that you pay me only beta. Right? They will tell that you have to pay also for the cost. Whenever they quote an amount, they will tell that this is say rupees 12 per kilometer. For what they are charging rupees 12 per kilometer? For cost of fuel plus a small beta amount, extra charges that they will take for per day. Right, so cost of fuel is basically included. What you have to ask? Supplier is other than body corporate and not opting for 12%. Two conditions. If supplier is body corporate, forget everything else. FCM. Do not look at anything else. Supplier body corporate means supplier is other one body corporate, but he wants to go for 12%. FCM. Supplier is other than body corporate and is not willing to go for 12%. Wait, don't conclude at RCM. Wait, recipient should be body corporate in taxable territory. Now, whether recipient is registered or unregistered, forget about it. If it is not registered, it has to take compulsory registration. Recipient should be body corporate in taxable territory. Now, how many cases of FCM can be there? Many. If supplier is body corporate, whosoever is recipient, FCM. If supplier is other than body corporate but opting for 12%, whosoever is recipient, FCM. If supplier is other than body corporate, not opting for 12%, recipient is other than body corporate, recipient is other than body corporate, FCM. For RCM to be there, recipient should be. So if now when specifically RCM comes, supplier should be not body corporate, supplier should not be opting for 12%, recipient should be. If recipient is body corporate in non-taxable territory, FCM. If recipient is body corporate in, so there are two conditions for supplier. Supplier should not be body corporate, should not be opting for 12%. Recipient should be body corporate in tax. If all the four conditions are satisfied, only then it is. Otherwise, it is FCM. Only then it is RCM. These four conditions, only then it is RCM. Now you are talking about security lending scheme, the last category, security lending scheme. Security lending scheme, where you are talking about, you don't know who's the supplier, who's the recipient. If you have securities under your account, you can give them on lend for 3 months through stock exchange. After 3 months, you will automatically get that stock again in your assets. You have that stock in your assets always. You are giving your shares or securities on lend via stock exchange. Mind you, this is the only RCM entry which will always be under RCM. Lender is the supplier, borrower is the recipient, they will never know each other because it is all via stock exchange. They will never know each other. It is all via stock exchange. Right? This is the only category where FCM is not at all possible. To be very specific, there is a circular explaining this, telling that it is always RCM and it is always IGST. You don't know who's the borrower. So whether you might find out place of supply. See, recipient has to pay, so he might find out place of supply. But he will never know where is the location of the supplier. To decide whether it is CGST, SGST or IGST, you should know location of supplier and place of supply. You will find out place of supply. But recipient has, because recipient is going to pay GST, he will know what is place of supply, but he will never know location of supplier. That being the case, it is always under RCM, always IG. This is the only entry where it is always under RCM. Always under RCM. Are we clear with this understanding? Are we clear with this understanding? So these are all the RCM entries for your intra-state supplies as well as interstate supplies. Now we'll discuss your RCM where you are talking only about your interstate supplies, basically import of services. Import of services can never be intrastate. So we are discussing RCM where RCM is only for your interstate supplies, importation of services. When it is all about importation of services, categorize them into three. One is normal, one is OIDARS services, and the last is transportation of goods by shipping line, by foreign shipping line, because only if it is supplier is a foreigner, it makes sense, by foreign shipping line. So you have to categorize your importation of services into three categories. Now, for normal, you have to ask two questions. For OIDRS, a single question you need to ask. For OIDRS, there is a single question that you need to ask. And for transportation of goods by foreign shipping line, directly answer. Directly there is answer. Now for normal importation of services, there are few notified categories which are exempt. GST won't be there. Say for example, if importation of services by a charitable trust, section 12AA or 12AB, then it is exempt. Say for example, importation of services of periodicals, online periodicals or books by colleges, not by schools, by colleges, then it is exempt. So likewise, you have few listed categories that you have to walk through, that is exempt. Other than notified category, there is one more point which talks about exemption. If it is for non-business entity, which means one of the exemption entry is when the services are given to a non-business entity, it is exempt. Right? If it is to business entity, then it is taxable under RCM. For normal importation of services, there are few categories which are exempted. Two examples I have given. There are other few categories also. And other categories, you ask a simple question whether the recipient is non-business entity. Again, that is also covered by exemption. Business entity taxable under RCM. For OIDRS services, if the recipient is non-business entity, they call it as other name, non-taxable online recipient, which is technically individual, government or local authority or governmental authority which are not registered. Right, we are talking about non-taxable online Technically the name is non-taxable online recipient. And other than non-taxable online recipient. If it is non-business entity, that is a non-taxable online recipient, it is taxable. If it is business entity, it is taxable. So in both the cases, it is taxable. Difference is, if it is non-business entities, it is taxable under FCM. Here it is taxable under RCM. It is taxable under RCM. So that is a difference now. For online information and database access and retrieval services, which are automated services, no one is giving the services there. All the apps that you have on a phone are all OIDRS services, automated services through the help of information technology. Right? It is always taxable. If it is non-taxable online recipient, roughly non-business entity, it is taxable under FCM. If it is business entity, then it is taxable under RCM. If it is transportation of goods by foreign shipping line. See, in importation of services, one thing you have to be very clear, that supplier is in non-taxable territory, recipient is in taxable territory. Only then it is importation of services, correct? Also place of supply should be taxable territory. So one thing is very clear, supply is outside India, recipient is in India. So I need not tell that. Otherwise, normally when I write RCM, I write business entity in. I have not written anywhere that business entity is in taxability, but it is because it is implied. Is in taxability. In this particular case, where transportation of goods is by vessel, foreign shipping line, then always it is taxable. Under RCM, special RCM, importer will pay. You need not see who is the actual recipient. Whosoever is the recipient, importer will pay. Importer may be the recipient, importer may not be the recipient. How importer may not be the recipient? It might be a scenario where this particular freight payment would have been done by the foreign exporter. Would have been done by the, you have paid to the foreign exporter CIF value, cost insurance freight. You don't know what is the freight amount. You have said that I will pay you entire amount. You make sure that the goods are reaching India. So he is not having any contract with foreign shipping line. He is not having any contract with, but still for the purpose of this particular RCM, for the this will always, it will be always stated that the importer is the recipient and he has to pay RCM. Understand that there is a double taxation. Why? When the goods are imported, this importer is required to pay import duty on what? CIF value, cost, insurance and freight. When he is paying import duty, he is paying BCD, SWS and IGST on CIF. Again, for the second time, importer will pay IGST. One is customs duty, one is GST. Customs duty on value of goods, GST on freight services. He will again pay IGST on the freight portion. On the, you may tell that again he is getting the credit, that is all good. But we do have clients where they are not eligible for credit because they are dealing only with exempt goods. For them, IGST portion of customs duty is also cost. Again, IGST on freight is also cost. By the way, this is next attempt, this will be changed because there was a High Court judgment of Mohit Minerals where it was said that this RCM is ultra virus. It is now upheld even by Supreme Court. It is now upheld even by Supreme Court, telling that this cannot be RCM. Importer is not basically the recipient here. He may not be the recipient here. Are you clear with this understanding? Are we clear with this understanding? Even in your ICM material, you will find this particular note telling that in Mohit Mineral case, this has been said by High Court that this particular RCM is ultra virus. Right, ultra virus is the act as well as ultra virus is the constitution. Double taxation is also involved. Right. But now the same judgment is upheld even by the Supreme Court, telling that this RCM is not correct. Right. So that you need to remember. As it is so, expectation of this type of question in exam is very less. Because now this is also ratified by Supreme Court. You are in that intermediate. Next attempt it might be a valid question. Because Supreme Court judgment is there, then they may ask you to test whether it is there or not. Right, for your exams, the expectation is this type of question is alias, but nevertheless, you know the answer. What would be the answer? Just write a note that in Mohit Mineral's case, it has been upheld by High Court that it is ultra virus. Because for your exam, though Supreme Court judgment has come, it is not applicable, but because it is after year 30th April. After 30th April, anything comes, it's not applicable for your November 2022 exams. Now, talking about the last category where you're talking about neither RCM nor FCM. Neither RCM nor FCM, where you are supplying notified services via electronic commerce operator. Electronic commerce operator. So what is the electronic commerce operator? A person who owns, operates or manages digital or electronic facility or platforms. In a simple language, apps or websites. Now what is electronic commerce? Supplying goods or services, including digital products through your websites or apps to digital or electronic platforms. That is electronic commerce. Now, whether everything provided via eco is under 9.5? No. First, make it very clear. Not everything is under 9.5. First of all, goods via eco is not under 9.5. It is only services. That too, notified services. So, when you are supplying notified services via eco, only then it is taxable under 9.5. Now, what are the notified services? Passenger transportation services, accommodation services, housekeeping services, a new addition, restaurant services. Any other services via eco, 9.5 is not applicable. 9.5 is not, it will be FCM. It will be FCM. Right. Now when you talk about passenger transportation services via what all categories? Via radio taxi, motor cab, maxi cab, motorcycle. They have corrected the definition now. Omnibus, new addition. Any motor vehicle, new addition. New addition. So when you talk about radio taxi, you are talking about radio taxi or a radio cab where they have two-way radio communication via your GPS, GPRS, where there is a centrally controlled office. How they do have two-way radio communication? Because GPS or GPRS is enabled. There is a centrally controlled office. Nowadays, any app, any cab that you book, it is a radio taxi radio app. You can easily find out where the cab is. Previously, that facility was given only to the owner of the app. Now, the owner has given that facility even to the customers. You can easily find out where the location of the cab is. Motor cab. Motor cab is again a kind of motor vehicle where you are carrying passengers up to 6, not more than 6. 1 to 6, not counting the driver. Don't count the driver. The passenger capacity other than the driver is 1 to 6. And if it is maxi cab, it is 7 to 12. 7 to 12. Passenger, don't count the driver. 7 to 12. Motorcycle, normal two-wheeled motor vehicle, inclusive of a detachable sidecar. Nowadays, you don't find that, but even if it is included of a detachable sidecar, you will have that where there is an extra wheel attached to the motor vehicle. So that is also covered. Motorcycle. Two-wheelers. Rapido is also covered. So when you talk about Rapido kind of apps, they are also covered. Previously there were doubts whether Rapidos are covered or not. Now it is very clear that even they are covering two-wheelers, motorcycle. Omnibus. Omnibus, you are talking about bus where the capacity is to carry more than 6. Now you may wonder why already more than 6 was already covered. But wait, that was a cab, maxi cab. 7 to 12. Here you are talking about bus. More than 6. Anything is covered. And any other motor vehicle. Where motor vehicle definition is a normal definition. Mechanical propelled vehicle. Where it is not inside a premises. That motor vehicle should not be working inside a premises. It should be working on roads. It will exclude special type of motor vehicles which can be used only for special purposes, which means dumpers, tippers. That will not be covered here. Also, it will exclude vehicles with a engine capacity up to 25 cc. So these two categories will not be covered. See, it will exclude three categories basically. If you are having motor vehicles which will walk on certain railway tracks, kind of railway tracks within the premises of a factory, that is not covered. It will not cover motor vehicles where the engine capacity is up to 25 cc. It will not cover special type of motor vehicles which can be used only for special purposes. That will not be covered. Normal motor vehicles. Basically, they have expanded the coverage of passenger. If I want to conclude it in very simple terms, you need not remember anything. Passenger transportation services via eco is more than sufficient. Previously, you need to remember whether it is by radio taxi or motor cab or maxi cab or motorcycle. Now forget about anything. Even if it is via bus, forget about it. Passenger transportation services. Whether you are booking a small ride in Rapido two-wheeler, whether you are booking Ola car, cab, or whether you are booking a seat in bus. A seat in bus via red bus. All three cases are covered. What are they telling? They are telling that now Rapido or Ola or red bus have to pay GST not on their commission. Normally they will pay GST on their commission, and the owner of the two-wheeler or the cab or the bus will pay GST on ride charges. Both will be under FCM. Normal scenario, Rapido, Ola or red bus will pay GST on their commission FCM. And the two-wheeler owner or the cab owner or the bus owner will pay GST on the fare charges under FCM. Now what is happening? What is happening? Both are merged. Now Rapido, Ola or red bus is asked to pay GST under 9.5, which means they will not pay GST on their commission. They will pay GST on the fare charges. That is the difference. If it was under FCM, that were two FCMs. Now both the FCMs are merged, and Rapido, Ola or red bus is asked to pay GST on the entire fare charges. Entire fare charges. Are we clear on this understanding? Right. Next category, accommodation services. Accommodation services. When you talk about accommodation services, you are talking about accommodation in hotels, motels, inns, etc., etc. One thing you need to understand. When it is not covered under 9.5, if you are talking about a scenario where the hotel is liable for registration under section 22, which means hotel's turnover is more than 10 lakhs or 20 lakhs as the case may be. 40 lakhs is not applicable for services. 10 lakhs or 20 lakhs as the case may be. Then it is under FCM, which means if I am booking a hotel through say Trivago, if I am booking Taj Hotel through Trivago, it is liable for registration under section 22. So Trivago will pay GST on its commission FCM. Taj Hotel will pay GST on the accommodation charges FCM. But if I am booking a small hotel not liable for registration through Trivago, then Trivago will pay GST on accommodation charges under 9.5. Under 9.5. The same understanding is for housekeeping service. Exactly same understanding. If you are talking about housekeeping services like carpenting, plumbing services that you can book through apps now. Urban Club is a classic example. Now, if the carpenter or plumber is liable for registration under section 22, then it is FCM. 9.5 will not cover it. Again, I will tell the example. Supposing you are booking a carpenter via Urban Club, but that carpenter is having a registration, a turnover of about 1 crore. About 1 crore is liable for registration. Then Urban Club will pay GST on its commission FCM, and carpenter will pay GST on its charges under FCM. But if the carpenter is not liable for registration under section 22, then Urban Club will pay GST on the entire carpentry charges under 9.5. In the last and the new addition, very important for your exams, you are talking about restaurant services. Classic examples, you are ordering for your meals via Swiggy, Zomato, etc. You have to ask yourself a question. whether that particular hotel is inside a premises That particular restaurant is inside the premises of a hotel where declared tariff of any unit of accommodation is more than 7,500 per room per day or equivalent. Per room per day, more than 7,500. Because first, you have to bifurcate this into three categories. I am ordering my meals through Swiggy, which is a normal restaurant, not a restaurant inside an hotel. If it is a normal restaurant, then it is 9.5. Then it is 9.5. Swiggy will pay GST on entire food value. Swiggy will not pay GST on its commission. Hotel will not pay GST on food value. Swiggy will pay GST on the entire food value under 9.5. Second, I am ordering food through Swiggy in a restaurant which is part of a hotel. Where no hotel room is having declared tariff value more than 7,500 per day per room. In that case, again, Swiggy will pay GST not on its commission but on the entire food value under section 9.5. Third, again I am ordering food through Swiggy, but this time it is from a restaurant which is inside a hotel where even a single room value is more than, declared tariff value is more than 7,500 per room per day. There may be hundreds of rooms. Even if there is a single room where the declared tariff value is more than 7,500 per room per day, then Swiggy, 9.5 is not applicable. Swiggy will pay GST on its commission. Hotel will pay, restaurant inside that hotel will pay GST on food, FCM. Now it is FCM, two FCM categories. So that is all about this 9.5 categories. Few important notes. If eco is there in India, it will pay GST. If eco is not there in India, then it has to have a representative who will pay GST under 9.5. If eco is not having representative also, then it has to appoint a person to pay GST. Eco cannot escape under 9.5. If eco is already registered, it need not take separate registration for paying 9.5. See, if Swiggy is already registered for paying GST on its commission, it need not take separate registration for paying GST under, same registration will hold good. Eco will pay taxes even if the supplier is, if it is covered under 9.5, eco will not see whether the supplier is registered or not registered. Now, make one thing very clear. When, say I am continuing the example of Swiggy, but it is equally applicable for all the 4 cases. When you are ordering food via a restaurant where Swiggy is paying GST under 9.5, but whose turnover it is? Turnover is of Swiggy or of restaurant. So make one thing very, very, very clear. Though eco may pay taxes, the turnover is not of eco, the turnover is of the supplier, not of eco. Because eco is not so. Eco is taking the responsibility of supplier to pay GST. That doesn't mean that it has become its turnover. It is a turnover. This is even true for RCM. If at all you are paying GST under RCM, it does not mean that it becomes your turnover. It is still the turnover of the supplier. It is still the turnover of the same is holding good for 9.5 also. Turnover on which eco is paying taxes will on eco is very special. See, in RCM, the turnover is of the supplier, though the recipient is paying under RCM. But the fact is, it is inward supply for the recipient. But for eco, it is very special. For eco, when Swiggy is paying GST on the services given by restaurant, it is turnover of the restaurant, not of Swiggy. For Swiggy, it is neither the outward supply nor the inward supply. It is neither outward supply nor, rather than paying GST on the commission, now it is paying something more. It is very special. For RCM, it is not the outward supply, it is the inward supply. But for 9.5 eco category, it is neither outward supply nor inward supply. Nor, why it is very important. In RCM, we always tell you pay GST RCM one hand, get credit under other hand. It will not happen in eco. So Swiggy will pay GST under 9.5 on extra value. Rather than paying on its commission, it is now paying on extra value of the supplier. It cannot take the credit. It cannot take the credit again. What is the normal concept of RCM? Pay RCM by cash ledger one hand, take RCM credit ledger other hand. Same thing is not true for eco. Because for eco, it is neither the outward supply nor the inward supply. It is paying on extra value. It has to pay on the extra value, but it cannot take the credit. Right. And the last clarification that has come out is eco has to raise invoices separately. Where it is paying on its only on its service charges, or where it is paying on the full value. It has to do separately. It has to do separately, because when it is paying on the full value, TCS will not be applicable. When it's paying GST only on its commission, TCS will be applicable. So it has to raise separate type of invoices to identify whether TCS is there or TCS is not there. When it is covered under 9.5, TCS is not applicable. When it is not covered in 9.5, TCS may be applicable. So it has to differentiate both. It has to think about Swiggy. Swiggy will have a lot of complications. Few categories Swiggy will pay GST only on its commission. Few categories Swiggy will pay GST on the entire food value. If it is paying on the entire food value, no TCS. If it's paying only on its commission, TCS may be. So it has to show that separately. Very clearly it has to show. So that tomorrow if any department officer comes for scrutiny, he can easily identify the transaction. So that is everything about your RCM and your eco category. Now when you talk about the time of supply, the sections that are involved are only two. Section 12, section 13. One is for goods, one is for services. So one happens to be for goods, one happens to be for services. And section 14 is there in case of change in rate of tax. That is both for goods as well as services. So section wise it is only section 12, 13 and 14. And basically when you talk about section 12 and 13, one for goods, one for services, it is categorized into 5. One, time of supply for forward charge mechanism. Other, time of supply for reverse charge mechanism. Then time of supply for voucher supply, time of supply for residual cases, and time of supply in case of interest on delayed payment of consideration. Interest in case of delayed payment of consideration. We are not talking about interest on loan. That is exempted. Interest in case of delayed payment of consideration. It may be written as interest or late fees or penalty or any other amount in your question. That is for delayed payment of consideration. Now, first we are talking about time of supply both for goods and services. We are seeing section 12 and 13 both together in case of forward charge mechanism. So our focus is first on forward charge mechanism. The answer is different for your goods and the answer is different for your services. We have different answers for your goods and services. Now, before you find whether the time of supply in case of forward charge mechanism, this principle keep in your mind forever. If at all it is time of supply for forward charge mechanism, there are two steps. What is the first step? First step is due date of invoice. Second step is finding out time of supply. Whether the question is asking you or not, first step is due date of invoice. Only the second step is finding out time of supply. So we have this column. If at all it is multiple questions, 3-4 questions in particular question, then you have this column. First find out due date of invoice, then write time of supply. It is a single question. First answer for due date of invoice, then answer for time of supply. Even if the question is silent on that particular aspect. Now first we'll see due date of, we'll go with the steps. Because first step is due date of invoice. Due date of invoice for goods as per section 31 for goods. Normally, goods, supply of goods will involve movement of goods. Normally, so invoice should be raised on or before removal. Normally, the supply of goods movement will be there. So before removal, on or before removal. In case there is supply of goods but no movement of goods, rarely it will be there. Though there is supply but there is no movement of goods. Rare scenarios you may find that the goods are with you, then you are purchasing it. Right? It may be a scenario where you took the goods on rent first, lease first. It was supply of services. Finally, you are purchasing the same. Now it is supply of goods, but does not involve movement. So it is on or before constructive delivery. On or before constructive delivery of goods. In simple language, there is no breathing time. If supply involves movement of goods, before removal. If supply is there but no movement of goods, on or before constructive delivery. There is no breathing time. There is no breathing time. But there is another special case that you are talking about sale on approval basis. In case of sale on approval basis, you should give invoice either at the time of actual acceptance or 6 months from the date of removal, whichever is earlier. Whichever is earlier. The goods are given on approval basis on 1st April. They are accepted on 15th August. Invoice should be given on or before 15th August. They are accepted on 15th December. 1st October. Invoice should be given on or before 1st October. 6 months is over. Right. Though acceptance happens on 15th December, you need not wait for that. Invoice should be given on 1st of October. Right. So actually, it is a hidden deemed supply. Now we are discussing about acceptance, rejection. You have given the goods on 1st April. The goods are rejected on 15th August. No need of giving invoice. It is all delivery challan. All the movement to and fro is by way of delivery challan. The goods are sent on 1st April on approval basis. The goods are rejected on 15th December. So once you cross 6 months, you have to raise invoice. So 1st of October, you have to give invoice. It becomes hidden deemed supply. Then what you will do on 15th of December? Give credit note. Give credit note. Getting that point? So it is a hidden deemed supply. So the time limit for raising the invoice in case of supply on approval basis is actual acceptance of supply of goods or 6 months from the date of removal, whichever is earlier. Whichever is earlier. In case of services, there is breathing time. There is breathing time normally. Normal sector, normal service sector, you have breathing time of 30 days. But if it is banking sector and insurance sector, it is 45 days. Banking sector and insurance sector, it is 45 days. So breathing time is 45 days. And when you talk about special cases now, in the first special case, what is happening is the supply is terminated in between. That's termination of contract or cessation of contract. In between, you did some work but not the entire work, supply is terminated. So first point, you have to raise invoice not for the entire contract value but for the part of the work that you have done. So if the agreed value was 10 lakhs, you have done only 10% of the work, you will be raising invoice only for 1 lakh. When? Immediately. Immediately. Now there is no breathing time. Immediately. Normally service has got breathing time. But when supply is terminated in between, you raise invoice only for that portion of the work that you have done, but raise invoice immediately. Raise invoice immediately. And the last is a special scenario where the supply is between distinct person of notified persons. Branches. Supply is between branches of who are the notified persons? Banks, insurance and telecom sector. Here there is a special point. Telecommunication sector. Bank, insurance and telecommunication sector. Then they tell that you have to raise invoice at the time of recording in books of accounts or at least before expiry of the quarter. Before the expiry of the quarter. Supposing the supply was in June. Before 30th of June. Supposing the supply was in July. Before 30th September. Supposing the supply was in October. Before 31st December. Supposing the supply is in December. Before 31st December. Right. So again here extra time is given. Extra time is, but wait, it is for what? First point, only between branches. Second point, only of banks, insurance and telecom sector. Banks, insurance and telecom sector. Now you can categorize your supply into two. Supply to branch offices, supply to others, customers. Both when it is attracting GST. Both when it is attracting GST. General category. Whether it is to branch office or to other customers, the time limit is 30 days. 30 days. Banks and insurance. If it is to branch office, expiry of quarter. If it is to customer, 45 days. 45 days. If it is to telecom sector, if it is to its own branch office, end of quarter. But if it is to customer, then it is 30 days. Then it is 30 days. Are you getting the differences? So things are different for different categories. Now, talking about your due date of invoice in more special cases. We discuss about due date of invoice for goods, 3 categories, for services, 4 categories. There's something called as continuous supply of goods and continuous supply of services. Continuous supply of goods means a supply which is on continuous basis or on recurrent basis. Continuous basis or on recurrent basis. Condition number 1, where invoice is raised periodically. Invoice will be raised not every transaction, periodically. Continuous supply of service also means the same, with a small difference that supply is on continuous basis or recurrent basis, where periodic payment obligation is there, which means again invoice is raised periodically, but one special point, for a period more than 3 months. This condition of more than 3 months is only for continuous supply of services, not for continuous supply of goods. Otherwise, meaning is one and the same. See what happens in continuous supply of goods and continuous supply of services. For every transaction, you cannot raise invoice. Otherwise, recipient will become upset. He has agreed, supposing Jio company has agreed with me that I have to supply cables for entire Coimbatore city. Every now and day, I will be getting orders. Today, 1000 meters cable in this street. Correct. Tomorrow 10,000 meters cable in that particular area. I cannot raise invoice again and again. Continuous supply of goods. Or for the same Jio company, I have agreed to do the construction work, laying of foundation. After the buyer digged underground, I have to lay the roads again. Again it is continuous supply of services now. I am not giving cables, now it is continuous supply of. So every work that I do, I cannot keep raising invoice. So what is the due date for invoice for continuous supply of goods? Before at the time of issuance of successive statement or receipt of successive payment. Issuance of successive statement or receipt of successive payment. Normally, whenever I will give statement, understand the statement concept. Along with the statement, I will give the details that on all these dates, this many meters of cables I have given. That statement will be given along with the invoice. Supposing we have agreed to give monthly statement. So monthly statement I will give along with that invoice. Supposing we have agreed to give quarterly statement. Quarterly statement I will give along with invoice. Supposing I have agreed to give quarterly statement, but I am giving after 6 months. So whenever I am giving the statement, it will be along with invoice. Right? Or at times I may tell Jio company that I want advance. I have done some work, statement will take some time. So give me advance. So that successive payment will come there. I have not given the statement, but I have received the payment. Right. So that is the due date of invoice for continuous supply of goods. For continuous supply of services, there are 3 scenarios. All 3 are independent. First scenario, you are talking about a scenario where due date of payment is ascertainable. Contract itself tells that payment should be made on or before 7th of next month. So before such due date of payment, I have to give invoice. Or contract does not tell due date of payment, but contract tells that once 20% of the work is over, invoice will be raised. So payment is linked to completion of event. So moment I complete that 20%, I have to raise the invoice for that 20%. If the contract is silent, it is neither talking about the due date of payment nor the payment is linked to completion of event. If the contract is silent, then the date of receipt of payment. All 3 are independent. If the contract talks about due date of payment, on or before due date of payment. If the contract is talking about payment linked on completion of event, on or before completion of event. If the contract is silent, on or before receipt of payment. On or before receipt of payment. We have discussed, friends, only about due date of invoice. This is all due date of invoice. You have to first find out due date of invoice. After that only you will be finding out time of supply. Why? If due date of invoice is found, then you have to ask a question. Whether invoice is raised in time or after time. If it is raised in time, answer one answer. If it is not raised in time, another answer. So first we will take up for goods. Invoice is raised in time. Actual date of invoice. Invoice is not raised in time. Due date of invoice. Due date of invoice. For services. Invoice is raised in time. Actual date of invoice or date of receipt of payment, whichever is earlier. Here you give importance to payment also. For services, if invoice is not raised in time, it is not due date of invoice. Friends, it is date of provision of service. You will find out due date of invoice even for services. There will be a date for that also. But the answer is date of provision of service. Date of provision of service or date of receipt of payment, whichever is earlier. You getting that difference? For goods, if you see carefully, payment is not relevant. Even if you get advance payment, forget about it. For goods, you don't even seek payment. If the question gives you payment, forget about it. Invoice raised in time, actual date of invoice. Invoice not raised in time, due date of invoice. Due date of invoice. For services, payment is relevant. Advance payment will be taxed. Invoice raised in time, actual date of invoice or date of receipt of payment, whichever is earlier. So if payment is received in advance, it will be taxed. If invoice is not raised in time, then it is date of completion of service. Write there specifically that it is not due date of invoice. Why I am telling this again and again is even for service you will have due date of invoice, but the answer is not due date of invoice. It is date of provision of service or receipt of payment, whichever is earlier. So if payment is received in advance, it will be taxed. Now few important points here. When you talk about receipt of payment, it is always payment in books or payment in bank, whichever is earlier. Whenever you see date of receipt of payment, it is always payment in books or payment in bank, whichever is earlier. First important point. Second important point. Whenever you are talking about this payment portion, if at all payment is received in installment, if at all payment is received if I receive the payment in 3 installment, treat it as 3 separate questions. Treat it as 3 separate questions. For one contract, the value of it say 1 crore, I have received 20 lakhs, 30 lakhs and 50 lakhs. Treat them as 3 separate questions. Treat them as 3 separate questions. Don't try to interlink it. So payment, there are 2 important criteria. If it is payment in books versus payment in bank, take whichever is earlier. If the payment itself is, say payment of 1 crore, received in books is on one day, receipt in bank is on one day, it is the same question, whichever is earlier. If payment of 1 crore is made in 3 installments, 20 lakhs, 30 lakhs, 50 lakhs, they are 3 separate questions. Work them separately. So please always remember that payment has got 2 important points. Now there is one more criteria. This was what our discussed was for regular scheme. If at all you are talking about composition scheme, there is no change in answer for services. There is no change in answer for services. What was the answer for service? If invoice is raised in time, actual date of invoice or receipt of payment, whichever is earlier. If invoice is not raised in time, date of provision of service or date of receipt of payment, whichever is earlier. The difference is only for goods. In goods, you have to categorize into 2. Regular taxable person. Invoice in time, actual date of invoice. Invoice not in time, due date of invoice. But, if it is a composition taxable person, invoice in time. It is actual date of invoice or receipt of payment, whichever is earlier. Payment becomes relevant here. Payment becomes relevant here. If it is invoice is not raised in time, it is due date of invoice or date of receipt of payment, whichever is earlier. Understand that ICAI has changed its stance multiple times. So when you talk about composition taxable person, if you see the earlier study materials for composition taxable person, ICAI said that even for composition taxable person, receipt of payment is not relevant because turnover will not include advances. Turnover will not include advances. Thereafter, in one of the exam, they changed the answer. So here, this area is a kind of litigative area because ICAI has given multiple views. First view is based on notification. Notification which gives relaxation for goods for forgetting the receipt of payment is only talking about regular taxable person. Therefore, this answer is right. But another view of ICAI was based on aggregate turnover definition. Aggregate turnover definition. Where it initially said that advances are not included in aggregate turnover. So, though composition taxable person are not covered in that relaxation notification, 66/2017, but still equally the same thing holds good for them. But now you have few high-end technical questions for CA final level where ICAI has included advances in aggregate turnover. So obviously now for composition taxable person answer is different. Make it very clear. Service. As far as service is concerned, forget about the fact whether it is a regular taxable person or a composition taxable person. Invoice raised in time, actual date of invoice or date of payment, whichever is earlier. Invoice not raised in time, date of provision of service or date of receipt of payment, whichever is earlier. Service is same for regular taxable person as well as composition taxable person. So answer is the same. For goods, it is different. Regular taxable person, invoice raised in time, actual date of invoice. Not raised in time, due date of invoice. Composition taxable person for goods, invoice raised in time, actual date of invoice or date of receipt of payment, whichever is earlier. Not raised in time, due date of invoice or date of receipt of payment, whichever is earlier. Whichever is earlier. That clarity you should have. Now one last point about this particular forward charge mechanism. This basically is for service sector. Basically, because advance payments are actually taxed only basically for services. So what they have said, if it is a petty advance payment, if it is a petty advance payment, if it is a petty advance payment up to 1,000 rupees along with previous invoice, along with, so understand that first condition is petty advance payment up to 1,000. Second condition, it is not normal advance, it is along with the old invoice. You are making the payment for the previous amount which is 1,800, but you are making 2,000 rupees payment. So that 200 rupees is advance along with when you are making the payment for previous invoice. Then you can ignore 200 rupees for that receipt of payment. You can advance, how much is that? Only 200 rupees. You can ignore that 200 rupees advance. You can have time of supply as the actual date of invoice. Because why you are giving this 200 rupees advance? It will be adjusted in the next billing cycle. It will be adjusted in the next billing cycle. So two conditions. It is up for a petty advance up to 1,000. Second, that advance is not normal advance payment. It is along with previous invoice payment. Then forget about the date of receipt of payment. Forget about that advance payment. Don't tax that advance. Time of supply will be the actual date of invoice, because when you are paying that 200 rupees, it is an advance payment, billing for which will be done next month. So no need to tax 200 rupees now. When you are raising the invoice next month, then you can pay the tax. And this is mainly in telecommunication sector. This is mainly there in telecommunication sector. And that is a small relaxation. So that is all and all about time of supply for your forward charge mechanism. Forward charge. The most tricky area in time of supply is FCM. Rest all are very, very simple. Now we are talking about time of supply in case of reverse charge mechanism. When recipient is paying the tax. When recipient is required to pay the taxed. Wait, before I go to that particular reverse charge mechanism, there is a question which is asked by ICI, and it is a very tricky question. If you understand that, you will not go wrong anywhere in your time of supply. It was a case of continuous supply of goods. Continuous supply of goods. So this scenario was of continuous supply of goods. When you talk about continuous supply of goods, the question said that there are multiple events, E1 to 1, E1 2, etc. Right? E1 to 1, E1 2, E1 1. Just remember that I will give you simple dates. E1 to 1, the event was over on 30th of June. So successive statement was given on 30th of June. Statement was given on 30th of June. E1 2, the statement was to be given on 31st of October. Say quarterly statement, right? But there was a payment received in advance, which of say 15th of August. If I tell that there was an agreement to give statement on quarterly basis, and the first statement was given on 30th of June, along with that invoice should have been given. Second statement was to be given on 30th of September. 30th of September, but I wanted some payment, so I asked for advance payment, and the payment was received on 15th of August. Right. Now, actual date of issuance of invoice. Actual date of issuance of invoice in the first case is say 30th of June. In the second case is say 30th of September. So in the first case, successive statement is given on 30th of June and along with invoice on 30th of June. In the second case, payment is received on 15th August, but invoice is given on 30th September. What will be the time of supply? What will be the time of supply? Make one thing pretty clear, very clear. If it is a forward charge mechanism case, there are two steps. First is due date of issuance of invoice. Second is time of supply. What is the due date of issuance of invoice in the first case? When is the statement given? Successive statement 30th June. So I should have raised the invoice on 30th June. Have I raised the invoice on 30th June? Yes. I have raised the invoice on time. I have raised the invoice on time. What is the time of supply? Actual date of issuance of invoice, which is 30th June. In the second case, I should have raised the invoice on 15th of August. Why? Receipt of successive payment was on 15th of August. But I raised the invoice on? I gave the statement along with invoice on? I received advance on 15th of August. But normal practices, I gave the statement along with invoice on 30th of September. Did I raise the invoice in time? Did I raise the invoice in time? I should have raised the invoice on 15th August when I have received the successive payment. But I raised the invoice on 30th September. I did not raise the invoice in time. What is my answer? What is my invoice? Answer. Due date of invoice, which is 15th August. One may ask, what is special question? So special point here. The special point here is payment is getting indirectly taxed. Advance payment is getting indirectly taxed. Normally, we have an understanding that on goods there is no payment on advances. There is no payment on, but here it is indirectly. Even here, they are not trying to touch the payment, but due date of invoice happens to be successive payment. Due date of invoice happens to be receipt of successive payment. Formula for time of supply is same. Invoice given in time, actual date of invoice. Invoice not given in time, due date of invoice. They are not talking about payment. Time of supply is even now not touching payment. But due date of invoice here happens to be successive payment. Successive payment. You getting that point? So advances are getting indirectly taxed for continuous supply of So there might be a possibility there. That is the maximum level that they can complicate here. All other things will be quite simple. Now coming to reverse charge mechanism for goods. What is the time of supply for goods? It is the date of receipt of goods, or you are talking about recipient. So look from this angle. Date of receipt of goods or payment made by the recipient, or 31st day from the date of invoice of the supplier. Supplier may not give GST invoice, but he'll give some document, right? Some invoice. So 31st day from that, earlier of all the 3 events. What are the 3 events? Receipt of goods or payment. Payment means payment in books or payment in bank, whichever is. So whenever I am talking about payment, it always means payment in books or payment in bank, whichever is earlier. Third, 31 days from the document of supplier. Find out all the 3 dates, whichever is earlier. Whichever is earlier. Right. So that is when you talk about goods. What is the answer when you talk about services? Services, you have to categorize into 2 scenarios. One, normal scenario. One, special scenario. Normal scenario, understand that for services you cannot have receipt of services. For services you cannot have receipt of services. Intangible. Right. So it is date of payment or 61 days from 61 days from the document of supplier. 31 days gets changed to 60. There are 2 changes. First change, no concept of receipt of services. Second change, 31 days changes to 61 days. 31 days changes to 61 days. So there are only 2 events. Payment 61 days from the document of supplier, whichever is earlier. But in service there is a special scenario. What is that special scenario? It is importation of services from associated enterprises. Importation of services from associated enterprises. We are not talking about normal importation of services. Why I am telling this again and again? If it is normal importation of services, it comes in general category. If importation of services from unrelated person, it will come in normal category. Only if importation of services are from associated enterprise, which is nothing but related person. Though the definition is taken from section 92B of Income Tax Act, it is nothing but related. So here it is importation of service from associated enterprise. I repeat, all RCM cases, including importation of services, time of supply for services, payment or 61 days from document of supply, whichever is earlier. For importation of service from associated enterprises, there is a difference. It is payment or entry in expenses entry in books of accounts of recipient. Not payment entry, expenses entry in books of accounts of recipient, which was earlier. Right, payment always means payment in books or payment in bank. Here they are talking about expenses entry, that journal entry for expenses that you pass. Expenses entry in books of accounts of recipient. What they have done is, they are ignoring invoice. They are ignoring invoice of supply, therefore forget about 61 days from invoice of supply. They are telling that supplier may not give the invoice in such cases. So they are focusing on recipient passing the expenses entry in its books of accounts. Are you clear with this understanding? To be very specific, payment in books or payment in bank or expenses entry in books. Payment in books or payment in bank or expenses entry in books, whichever is earlier. But for what? Importation of service from, if it is normal importation of service, payment in books or payment in bank or 61 days from the invoice of the supplier. Or 61 days from the invoice of the supplier. So that you need to understand. If at all, if this point is for both, if at all you cannot find out the event, if at all you cannot find out the event, there are some dates which are missing, then time of supply is date of entry in the books of accounts of the recipient. If the events are not clear, then it's only theoretical, right? Then you are talking about expenses entry in books of accounts of the recipient, because it is RCM, so focus is entirely on recipient, right? Now you are talking about your voucher supply. Please remember, for all the last 3 cases, that whether it is goods or services, answer is the same. For FCM, for goods answer was different, service answer was different for time of supply. For RCM, for goods and for services answer was different for time of supply. Now onwards, whether it is voucher supply or residual cases or interest, answer is the same for goods as well as for the services. In voucher supply, always remember the example of Big Bazaar and Pizza Hut. Right? So Tata company is taking the vouchers of Big Bazaar and Pizza Hut and giving it to its employees. Supplier is Tata or Pizza Hut, Big Bazaar. From whose angle we are talking about? We are not talking from the angle of Tata basically. We are talking about the time of supply for Big Bazaar, time of supply for Pizza Hut. Because Tata company would have made the payment to Pizza Hut and Big Bazaar. Right. Now, Big Bazaar is trying to find out time of supply. Pizza Hut is trying to find out time of supply. Because they have received the advance. They have given the vouchers to Tata Limited. Tata Limited has given the vouchers to employees. But they are trying to find out what is the time of supply for them. What is the time of supply? You have to bifurcate into two. Bifurcate into two. First, supply is identifiable at the time of issuance of voucher. Supply is identifiable at the time of issuance of voucher. Supply is not identifiable at the time of issuance of voucher. Supply is identifiable at the time of issuance of voucher means you are talking about a scenario where the rates are the same. Pizza Hut example. So when Pizza Hut is giving the voucher to Tata Limited, Tata Limited will further give to its employees. Pizza Hut knows that the voucher can be used only for the purchase of pizza or other food items in Pizza Hut. The rate is same. The rate is same. For Pizza Hut, the answer would be date of issuance of voucher. There will be only one single answer. There will be only one. So Pizza Hut will pay GST. Single shot. Single shot because time of supply is only one. Date of issuance of voucher. Employees, supposing the issuance of voucher is in the month of April. Employees may have used it in month of April or May or June or July or August. Pizza Hut is not bothered. Pizza Hut will pay GST for the entire payment received and against which voucher is given. Actually, it is an advance payment for both Pizza Hut and Big Bazaar. Pizza Hut will pay GST on the entire advance at the time of issuance of voucher. What about Big Bazaar? Big Bazaar supply is not identifiable at the time of issuance of voucher because Big Bazaar deals with lot of products having different rates. So what will happen? It is not sure. Which employee will use or purchase what item. Which employee will purchase what item. So what will be the answer for Big Bazaar? It cannot be April month, the month in which vouchers is issued. It will be April plus May plus June because few employees will redeem it in April, few in May, few in June and like on. So first thing, there will be multiple answers. It is date of redemption of voucher. Only when the employees are redeeming the voucher, Big Bazaar will know what items they have purchased. Big Bazaar will actually know what is the rate. So for Pizza Hut, there is only one single answer, date of issuance of voucher. For Big Bazaar, it is date of redemption of voucher. Right. Next, we are talking about residual cases. Residual cases basically means fraud cases. Fraud cases, categorize them into two. Normal fraud, extreme fraud. Residual case means you don't have records. You don't have no records plus no registration, extreme fraud. No records, but you are registered, normal fraud. So if you don't have records, but if you are registered, you have to file periodical return. Time of supply for you is due date of filing of return. But if I tell you don't have records, you don't have registration. No records, no registration. Then it is actual date of payment. No records, no registration, actual date of payment. No records but registered. It is due date of filing of return. Due date of filing of return. No records, no registration, actual date of payment. Actual date of, in this extreme case, no records, no registration, where the time of supply is actual date of payment of tax, you may find out that interest will never come. But nevertheless, penalty will be huge. Understand that first, something is always better than nothing. So at least the government will get tax, interest will not be there because The time of supply itself is date of payment. So interest can never ever be there, but penalty will be there. Penalty will be there. Right. So residual cases divide into two. Write a small point. Periodical returns is to be filed. You can remember it as no records but registered. Due date of filing of return. Other case, no records, no registration. Actual date of payment of tax. And the last is a scenario where we are talking about interest on delayed payment of consideration. The time of supply would be when the same is received. When the same is received. Date of receipt of such interest or penalty or late fees, etc. Receipt of such interest. If it is not received, you will not be paying any tax. Selling price 1 lakh, interest for late payment 10,000. 1 lakh rupees, whether you get it or not, you have to pay tax. But interest 10,000 rupees. Why 1 lakh rupees you have to pay tax? Because 1 lakh rupees will go under FCM case. Whether you get the payment or not, you have to pay tax. Even if it is fully bad debts, you have to pay tax. But for interest on late payment 10,000 rupees. Time of supply is date of receipt of interest. So only when you get it. Supposing I have charged interest 10,000. I am not getting anything, no tax. If I am getting only 3,000, tax only on 3,000. But when? Only when I get that 3,000. Only when I get that 3,000. Right, that is all about your time of supply under section 12 and under section 13. Section 14. It is change in effective rate of tax. Change in effective rate of tax. So when you talk about change in effective rate of tax, again understand that this is a scenario where the events are scattered. If the events are not scattered, then supposing when I tell events, I am talking about supply, date of supply, date of invoice, date of receipt of payment, date of payment. If all the events are before change or all the events are after change, you are not covered here. You go in section 12 or section 13. When are you covered here? When are you covered here? When the events are scattered. When the events are scattered. So when you talk about events are scattered, if you look at this particular heading, you will find a particular scenario. This is applicable only for supply of goods for a composition taxable person and supply of services by any person. So this point is not applicable for whom? Supply of goods, regular scheme. Supply of goods, regular scheme will actually have answer as actual date of invoice or due date of invoice. For supply of goods, regular scheme, you are not even covered here. Normal answer, actual date of invoice or due date of invoice. If invoice is given in time, actual date of invoice. If invoice is not given in time, due date of invoice. So here basically we are talking about supply of services, regular scheme as well as composition scheme, supply of goods, composition scheme. Supply of goods. So one point, make it clear. If it is supply of goods, regular scheme, actual date of invoice if invoice is given in time, due date of invoice if invoice is not given in time. Right. Now, understand that it's a very simple formula. Wherever there are more events, that is the answer. Wherever there are more events, that is the answer. And answer will always be either invoice or payment. Either invoice or payment. You'll get the answer always. So, in the first scenario, what is given? Supply is before change. Supply is, so one thing keep it clear, there is a change in rate of tax from 5% to 12%. Supply is before change. Supply is before change. Invoice is after change, payment is after change. So, supply is on one side, invoice and payment is on opposite side. So, answer will be which is more heavier? After change. So, it is invoice date or receipt of payment date, whichever is earlier. Whichever is, if I say the rate of tax is 5%, now it is changed to 12%. What will be answer? 12%. Why? It is invoice date or receipt of payment date, whichever is earlier, and in both the cases the rate is 12%. If I tell Invoice is before change and receipt of payment is after change. Invoice before change. Payment, where was supply? Supply before change. Invoice before change. So what will be the answer? Before change. Before change is invoice date. 5%. 5%. If I tell supply is before change, invoice is after change, receipt is before change. So supply is before change, payment is before change. Which is heavier? Before change. So answer will be date of receipt of payment, 5%. Understand that answer will never be supply date, it will be either invoice or receipt of payment. Same analogy applied. What change I am doing is supply is after change. Supply is, please listen to the question carefully. Supply is after change. Invoice and receipt are before change. So it will be invoice date or receipt date, whichever is. If the change is from 5% to 12%, the answer will be 5%. If supply is after change, payment is after change, invoice is before change. Now you find supply and payment after change. Heavier is that. On the other side you have only invoice. So answer will be after change, which is date of receipt of payment, 12%. If supply is after change, invoice is after change and payment is before change. So payment is before change, invoice and supply are after change. Which is heavier? After change. Invoice date. It will be 12%. Invoice date 12%. Right. So one clarity that I said you before we started here is this is not applicable for supply of goods under regular scheme. It is applicable for supply of services, regular scheme or composition scheme, supply of goods, composition scheme. Applicable. Right. Another important point. Normally when I talk about payment date, it is payment in books or payment in bank, whichever is earlier. Whichever is earlier. But in this case, there is one change. Normally here also answer same. Payment in books or payment in bank, whichever is earlier only. But if there are certain specific events, what are the specific events? What are the specific events? First you are talking about, you have put entry in books of accounts. Before change you have put entry. Then there is change. Then there is credit in bank account after 4 days of change. That is a particular sequence. First, payment in books before change. Then there is a change. Then credit in bank after. If it is within 4 days, it is earlier of payment in books or payment in bank. It is after 4 days of change. It means the book entry was a dummy entry. Book payment entry was a dummy entry. Payment would be payment in bank. Date of payment in bank. Why? A very simple reason, that book entry was a dummy entry to just get the tax benefit. To get the tax. Understand, this is not the answer for time of supply. This is the answer for date of payment, which you have to use it for time of supply. So this would be the first step. If at all a question is coming about this also, first you have to try to find out date of receipt of payment, then find out time of supply. So this would be the first step, then you find out the time of supply. Normally payment is payment in books or payment in bank, which was earlier. True even for section 14. Only one scenario where there is a payment in book before change, then there is change, and payment in bank is after change, that too after 4 working days after change. Then the book entry was a dummy entry. The date of payment, date of receipt of payment will be date of credit in bank account. Right, only in that particular scenario it will be that. That's everything about your everything about your time of supply. Right, normally a question is expected in time of supply. At times ICI merges this time of supply along with RCM, along with your most of the times it merges with RCM. Rarely there are questions which are directly talking about time of supply. Yes, now let us talk about your composition scheme and your threshold limit for registration. We can call it as small dealers, right? So we are talking about a very small person who are not at all required to take registration. Threshold limit for registration, section 22. So you are talking about very small persons not liable for registration based on threshold, or their turnover is a bit bigger, but they can go for a simplified scheme, which is composition scheme, section 10. So first let us try to find out a very small persons category where they are not at all required to take any registration. What is the threshold limit? It is 20 lakhs or 10 lakhs or 40 lakhs as the case may be. So it depends. It actually depends which state you are in, and then it is being decided. Let us make it very simple with a small chart. So you are talking about special category states. Special category states, not as per your constitution, which are totally 11 in number. We are talking about special category states as per GST, which is three important aspects in politics of India, which is one is money, land and RAM. Money, land and RAM. Tripura, Manipur, Nagaland and Mizoram. Tripura, Manipur, Nagaland and Mizoram. Let us start with the earlier part. Apni politics in India can be summarized into three. Apni politics, our politics in India can be summarized into three, which is Tripura, three things: money, land and RAM. And till you are a qualified chartered accountant, for you it is total time pass. Till you are a qualified CA, politics is actually a total time pass. Right, remember this story so that you can easily understand all the aspects. Now there will be other states and union territories. Other states and union territories. So when you talk about the area written in black, that is Tripura, Manipur, Nagaland, Mizoram, let it be any category, whether only goods or only service or goods plus service. The limit is freezed, and the limit would be only and only 10 lakhs. It would be only and only 10 lakhs. For the other states where you are talking about Arunachal Pradesh, Sikkim, Uttarakhand, Meghalaya, Telangana, Puducherry. So you are talking about AP, Arunachal Pradesh, S, Sikkim, U, Uttarakhand, M, Meghalaya, and time pass Telangana, Puducherry. Again, whether you are dealing with goods or only services or goods plus services, it will be 20 lakhs. It will be 20 lakhs. And we talk about balance states and union territories. Balance states and union territories. Goods, services, goods and services. Services and goods and services, 20 lakhs. Goods, 40 lakhs. Only goods, 40 lakhs. Right. So you have to be very clear which state you are having which limit. Which state you are having which limit. Be very clear. Right. If it is Tripura, Manipur, Nagaland, Mizoram, 10 lakhs, anything. If it is Arunachal Pradesh, Sikkim, Uttarakhand, Meghalaya, Telangana, Puducherry, anything, 20 lakhs. If it is other states, union territory, only goods, 40 lakhs. Services or goods plus services, 20 lakhs. Right. So when you talk about this 40 lakhs point, the moment you start talking about this 40 lakhs point, there are certain special important points which are not there in 20 lakhs and 10 lakhs. See, whether it is 40 lakhs, 20 lakhs, 10 lakhs, there are certain common points. What are the common points? You should not be covered by compulsory registration. Should not be covered by compulsory registration. You should not go for voluntary registration. You should not be covered by compulsory registration. You should not go for voluntary registration. So 40 lakhs, 20 lakhs, 10 lakhs is not available. The moment you are covered by compulsory registration or you are voluntarily registered. And understand that once registered, forget about 40 lakhs, 20 lakhs, 10 lakhs. Once registered, payment is must. Even though it may be a voluntary registration, once registered, payment is must. So what are the common points for 40 lakhs, 20 lakhs, 10 lakhs? Point number 1, you should not be covered by compulsory. If you are covered by compulsory registration, forget about the limits. Point number 2, you should not go for voluntary registration. If you are registered, forget about 40 lakhs, 20 lakhs, 10 lakhs. Point number 3, once registered or liable for registration, payment is must. Payment is must. So that you need to understand. But there are certain points which are only and only relevant for your 40 lakhs. Which are only and only relevant for your 40 lakhs. They are not relevant for your 20 lakhs and 10 lakhs. What are they? Few points, common points you have covered. So when you talk about 40 lakhs, normally what I said, you should be dealing with only goods. But you can be having goods plus only interest on loan. Though it is a service, that service can be there. That service can be there. But whether it will be calculated or counted, yes, it will be counted, but you can still enjoy the benefit of 40 lakhs. It will be counted in aggregate turnover, you can still enjoy the benefit of 40 lakhs. That is point number 1. First special point. Second, you should not be supplying certain items. Pan masala, tobacco, ice cream. When you see this aerated water, be very, very clear. Aerated water will not find place here. It will find place in composition scheme. It is not finding place here. So here it is pan masala, tobacco, ice cream. A new addition being building materials. Building materials. Aerated water is not here. When I tell you should not be supplying, you cannot be a trader or a manufacturer. So if you are a trader or a manufacturer of pan masala, tobacco, ice cream or aerated water, forget about 40 lakhs. How to understand that? Normally 40 lakhs is available only for goods. But if it is goods plus interest on loan, even then you can go for 40 lakhs. Normally 40 lakhs is applicable for supplier of goods. But if you are dealing with pan masala, tobacco, ice cream or building materials, 40 lakhs is not available. 40 lakhs is not. One, there's something available even though there's something more. Second, even if you're a supplier of goods but you're dealing with some special items, 40 lakhs is not available. 40 lakhs is not available. So these two special points you have to remember for your 40 lakhs. 40 lakhs. Common points we have discussed both of 40 lakhs, 20 lakhs and 10 lakhs. Now, one very important point. Normally if ICA will ask question, they'll ask about two states. One, here as well as in composition scheme you see aggregate turnover. Aggregate turnover includes exempt supply and exempt supply includes non-taxable supply. So aggregate turnover will include the turnover of alcoholic liquor for human consumption, also include the turnover of 5 notified petroleum products. So this point you have to keep in mind. Second, you may deal with two states. One having lower limit of 10 lakhs, other having higher limit of 20 lakhs. Which limit will go? So if I am dealing with two states, understand the threshold is only one. Threshold is not state wise. Threshold limit is pan India. Aggregate turnover is. So in both the states together I should be within that limit of 40 lakhs, 20 lakhs or registration is for each state. But threshold limit is pan India. You have to check the threshold limit. So when you are talking about taking registration or not, first step is threshold limit. That is for all the states together, one limit, not for each state. Once you cross that, then it is all about taking registration. That is for each of the state. So if you are dealing with a state where one state is dealing with 20 lakhs, other state dealing with 10 lakhs, or one state dealing with 40 lakhs, other state with 20 lakhs, or one state dealing with 40 lakhs, other state with 10 lakhs. Right, so who will win? So basically you will go with the lower limits, because other states wants lower limits so that assessee can get registered there. But in case the lower limit states The lower limit states are dealing only with non-taxable supplies or exempt supply. Then you will go back to higher limits. Then you will go back to high limits. If I am dealing with Tamil Nadu and Tripura, only goods, I'll first stick to 10 lakhs. But if Tripura is having only exempt supply or non-taxable supply, I repeat, normally when the fight is between upper limit, lower limit will be the criteria for all the states together. For all the states together, because pan-India aggregate turnover. But when the lower state, condition number 1, when the lower limit state is dealing only with exempt supply or non-taxable supply, it has got nothing to do with registration. Anyways, you are not going to take any registration in that state because of section 23 and no taxes will be paid there. So then the lower state tells that, for me, why are you coming down? Anyways, I am not going to get any revenue and assessee need not register in my state. You go back to your upper limit. So two conditions. Lower limit state is dealing with exempt supply or non-taxable supply. Then forget about the lower limit threshold, go with the higher threshold. Go with the higher threshold. So that you need to remember. Right, that is all about your entire story of 20 lakhs, 10 lakhs and 40 lakhs. Now the same concept needs to be applied in composition scheme as well. The difference is, if you are within that limit of 40 lakhs, 20 lakhs or 10 lakhs as the case may be, you need not even take registration. But if you are having some more turnover, you might have to take registration, but still you can think of composition scheme. One thing you need to understand, threshold limit as well as composition scheme are optional, which means if my turnover is up to 40 lakhs, 20 lakhs, 10 lakhs, I may not take registration, or I may take registration under composition scheme, or I may take registration under regular scheme. If my turnover is up to the composition scheme limit, which is 150 lakhs, 75 lakhs or 50 lakhs as the case may be, I may go for composition scheme or I may choose to go for regular scheme. They are all optional. Now composition scheme person has to clearly mention, the document that will be given by a composition scheme person is bill of supply, because he has to pay tax but he cannot collect tax, he has to pay from his pocket. So clearly the document will be given will be bill of supply, and on that document he has to write that he is a composition taxable person not eligible to collect tax. He has to pay, but normally indirect tax is collected and paid, but in this case he has to pay but he cannot collect from the customer. Also composition taxable person, on every notice or signboard displayed at all the places of business, principal place or additional place, he should write on the name board very clearly that he is a composition taxable person. He is a composition taxable person. Right. Now, what is the limit for composition scheme? What is the limit? As I said, the limit is either 150 lakhs or 75 lakhs or 50 lakhs. Now, you have to bifurcate that into two. First, when you are talking about 150 lakhs and 75 lakhs, you are talking about 150 lakhs and 75 lakhs in a scenario basically where you are dealing only with goods or restaurant, outdoor catering sector. Here it is others. Right. So when you're talking about 150 lakhs, 75 lakhs, again states, which state will be the question? Same story, same concept. You need to remember Apni politics summary. Apni politics in India can be summarized into three important aspects. What are they? Money, land and Ram. Now that you have grown bigger from threshold limit to composition scheme, it is not time pass. You have grown bigger. Threshold is 40, 20, 10, very small. Now that you have grown bigger, this politics is no more time pass. So TP will not come here. Obviously, what is the left out category? Left out categories, you are talking about others. Other states and union territory. Now understand that these categories, simple, 75 lakhs. Other states and union territories? Very simple. No ifs and buts and all. No complications like 40, 20 and all. Very quite simple. 75 lakhs, 150 lakhs. Right. What about this category of not dealing with goods or not dealing with restaurant outdoor catering? Any state or any union territory? It is 50 lakhs. It is 50 lakhs. Any state, any union territory, it is 50 lakhs. Right. So that you need to remember. Now, can you have service? In normal, this we call it as normal composition scheme, this we call it as special composition scheme. Even when you talk about threshold limit for registration, 20 lakhs, 10 lakhs, we call it as normal exemption, and 40 lakhs, we call it as special exemption. Now, when you are covered in normal composition scheme, when you are dealing only with goods or restaurant sector, outdoor catering sector, can you have other services? Can you have services? Yes, you can have services within inner limit. Within inner limit. So basically your supplier of goods or basically your restaurant outdoor caterer with service in small quantity. What is that small quantity? 10% of previous year state turnover. 10% of previous year, not aggregate turnover. It is state turnover. State turnover. See, whenever it is concept, it is aggregate turnover. Whenever it is calculation, numbers, it is state turnover. Need not by heart that where aggregate turnover pan India have to see where state turnover. Rule 42-43 will deal only with state turnover calculation. It is all about calculation. Or 5 lakhs, whichever is higher. Whichever is higher. Right, I am working in Tamil Nadu and Maharashtra. I am working in Tamil Nadu and Maharashtra. I am basically supplier of goods in both Tamil Nadu and Maharashtra. My previous year Tamil Nadu turnover is 30 lakhs, previous year Maharashtra turnover is 60 lakhs. Totally aggregate turnover is within 150 lakhs. That I have to take care. I have to take care. This technically is called as outer limit. Technically this is called as, so I have to take care of outer limit as well. 70 lakhs, 60 lakhs means it is within 150 lakhs outer limit. What is my service turnover allowed in Tamil Nadu and in Maharashtra? In Tamil Nadu, previous year turnover was 70 lakhs. Multiplied by 10%, 7 lakhs. So 5 lakhs, which is higher? 7, not lower, which is higher? 7 lakhs. In Maharashtra, 60 lakhs multiplied by 10%, 6 lakhs, or 5 lakhs, which is higher? 6 lakhs. So in current year, in Tamil Nadu, I can have service up to 7 lakhs and I can have service in Maharashtra up to 6 lakhs in current year. That way I have to see my inner limit. I have to see my inner limit. I have to take care of outer limit as well as inner limit. Right? That I need to take care. Now, when you talk about what is covered in special composition scheme then? What is actually covered in special composition scheme? Either I am a pure service provider. Either I am a pure service provider or I am dealing with goods and service. My service is more than the inner limit. My service is more than the inner limit. My service portion is more. I am not covered within that category. I will go for special composition. Always first you have to try for normal composition scheme, only then try special composition scheme. Because special composition scheme first point itself is that you are not eligible for section 10.1, 10.2. Only then you are seeing 10.2a. You are not covered in 10.1, 10.2 is normal composition scheme. Only then you are coming to 10.2a. So special composition scheme is for pure service sector, a chartered accountant or a coaching class or an engineer or an architect or goods and services. Goods and services. But what service element is more than inner limit of normal composition scheme. It may be possible that you are not covered in normal composition scheme because service is more. But when you come to special composition scheme, you see the turnover is only up to 50 lakhs. You are not even eligible that. So you have to check in that particular sequence. Check in that particular sequence. Are you clear with this understanding of threshold limits? Now before we see the conditions, we'll make very, very important differences between your threshold limit for exemption versus threshold limit for composition scheme. Very, 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 very important points. Lot of confusions, lot of times you make silly mistakes because you don't appreciate or understand these points. Now threshold limit for exemption means you are focusing on 40 lakhs, 20 lakhs, 10 lakhs. Here 150 lakhs, 75 lakhs, 50 lakhs. Now understand that threshold limit for composition scheme means first you are focusing on your aggregate turnover of current year only. You are not at all bothered about your previous year. Aggregate turnover, which means pan India turnover, current year. In this case, composition scheme, you have to see aggregate turnover of previous year first for your entry. Whether you can come or not will be decided by aggregate turnover of previous year. If my aggregate turnover previous is more than 150 lakhs, 75 lakhs, 50 lakhs, forget about it. I cannot enter. Also, when I enter, I cannot remain in composition scheme forever in current year. Aggregate turnover of current year for seeing when I have to exit. When I have to leave that composition scheme for my exit point. For my exit point. First point is clear. Second point. When you talk about your threshold limit for exemption, interest on loan, which is an exempt service, is counted. It is counted. Here, interest on loan, which is again an exempt supply. Exempt supply is included in aggregate turnover, right? But it is not counted. It is not counted. You don't even take into account. Neither for aggregate turnover nor for, because in composition scheme state turnover will also be relevant. State turnover will also be relevant. You don't count it. If at all the question is talking about interest on loan in composition scheme, in previous year data, forget about it. In current year data, forget about it. Do not count it. Do not count it. Another important point. When you talk about your threshold limit, state turnover is not at all relevant. State turnover is not at all relevant. Here you have to use state turnover for multiple purposes. One purpose just now we have discussed, to calculate the inner limit for current year. What can be the inner limit of service for current year is what? 10% of previous year state turnover or 5 lakhs, whichever is higher. Also you need it for payment purposes. When you pay tax under normal composition scheme, you pay tax of 1% or 5%. Under special composition scheme, you pay 6%. When you are paying tax, you pay based on state turnover. See, whenever there is calculation, it is all state turnover. You require state turnover for payment of composition tax. For payment of composition tax, 1% or 5% or 6% state turnover. Obviously current year state turnover, when you are paying tax, it is for current year. Are you clear with this understanding? Are we clear with this? These are all areas where silly mistakes are made time and again. Once you know it very clearly, forget about any scope for any silly mistakes. You know, okay, these are all the differences. I have to be very, very careful when I am doing all these workings. Are we clear with this understanding? Are we clear with this understanding? Right. Now, the difference between 40 lakhs, 20 lakhs, 10 lakhs and difference between 150 lakhs, 75 lakhs, 10 lakhs. 150 lakhs, 75 lakhs, 50 lakhs rather. Composition scheme is to be checked every year. I am starting my business. Can I go for composition scheme? Yes. Because my previous turnover was 0. Current year my turnover is 140 lakhs. I'll pay composition tax on 140 lakhs. I enter second year. Can I be in composition scheme? Yes. When I go to second year, my previous year turnover is up to 150 lakhs. Assuming that I am talking about limit of 150 lakhs. Right. Second year, my turnover is 170 lakhs. Am I under composition scheme? Yes. But up to 150 lakhs, I'll pay composition tax. For more than that, I'm outside composition scheme. On 20 lakhs, I'll pay normal tax. I'm entering third year. When I enter third year, previous year is second year. What was my previous year turnover? 170 lakhs. Can I go for composition scheme? No. I have to go to regular scheme. My third year turnover is 130 lakhs. On entire 130 lakhs, I have to pay regular tax. Because I am outside composition scheme. Year 4. When I enter year 4, my year 3 turnover. So that keeps on. Now when the moment I enter year 4, it is similar to year 1. So that you keep on working. Every year I need to check. Right. So the checking of every year is there in that checking of every year. This checking of each year check. Here each year check is there in both the places. Here each year check is there to see whether I have to take registration or not. Here to see whether I am under composition scheme or regular scheme. I do check in both the cases. But the difference is, in the first scenario I check that for getting registration. In the second case, I check that for being under regular scheme or composition scheme. Right. Now talking about the conditions. Now if you see all these points here, this area is covered, this area is covered, this inner limit is covered, this what is the category that is there is covered. So many points we have covered in that particular chart itself. Now we'll see the other points. Understand that when you're talking about composition scheme, I repeatedly asked out. Previous year, you see only condition of aggregate turnover, plus you see another condition that you should not be a manufacturer of notified goods. This not be a manufacturer of notified goods is there both in previous year and current year. Previous year as well as current year. Now what is meant by manufacture of notified goods? It is pan masala, tobacco, ice cream. The point that we were discussing earlier, aerated water and building materials. And you need not remember these points. Building materials. Aerated water is extra. Now two differences. First, they are only talking about a manufacturer. Second, they are talking about even aerated water. So if I were to put this in a chart, again for your MCQs or for your bigger question, one small point they may talk. So if you are talking about pan masala, tobacco, ice cream, building materials, and if you talk about aerated water, you are talking about say for example, you are talking about a trader, you are talking about a manufacturer. Now when you talk about pan masala, tobacco, ice cream, or building materials, can I go for 40 lakhs? Whether I am a trader or manufacturer, I cannot go for 40 lakhs, but I can go for 40 lakhs for aerated water. Right. Now when I am talking about composition scheme, can a trader go for composition scheme? Always. A trader can always go for composition scheme. Manufacturer of pan masala, tobacco, ice cream or building materials or aerated water cannot go for composition scheme. So if you see the answers here, none of the answer is common. Isn't it? If you summarize this matrix, this is nothing but matrix, right? All the permutation combination is simple. table called matrix. You will find that none of the answers are common. And one extra point which I cannot write in this matrix is when you talk about 40 lakhs. You check the condition of this pan masala, tobacco, ice cream or building materials only for the current year. Previous year relevance is not at all there. But when you talk about composition scheme, you check it both for previous year as well as current year. You check it for previous year as well as for current year. So whenever you're talking about this composition scheme, you see previous year as well as current year. And whenever you're talking about this 40 lakhs, you only focus on current year. You only focus on current year. Are you clear with this understanding? Are you guys very clear with this understanding? Alright, now coming back here, why I am telling this is, other than that, in composition scheme, previous year is relevant only for two purposes. One, aggregate turnover, entry point. Two, manufacture of notified goods. Two, manufacture of notified goods. Rest all the conditions that we are going to see is for current year. It is all for current financial year. I should not be CTP, NRTP in current financial. I may have been CTP, NRTP in previous year. I should not be CTP, NRTP in current financial year. I should not be making non-taxable supply, that is alcoholic liquor for human consumption or 5 notified petroleum products in current financial year. I should not be making interstate outward supply. In previous financial year, I would have made interstate outward supply. I say will confuse you. Previous year aggregate turnover 140 lakhs, out of which 10 lakhs is interstate outward supply. Let it be. I need not be worried about it. In current financial year, I should not have interstate output supply. I should not supply to other state. I should not export. I should not supply to special economic zone. Can I have interstate inward supply? Yes. I can purchase from special economic zone. I can purchase from other state. I can also import. That is allowed. Outward supply is not allowed. I should not be making supply through eco where TCS is applicable. Where TCS is applicable. These are all the conditions. What about the leftover portions? They are all restrictions. They are all restrictions. Now what are the restrictions that is there? Even though I am under composition scheme, even for me RCM is applicable. I also have to pay RCM. RCM is applicable even for a composition taxable person, and RCM can be CGST, SGST or IG. Normally under composition scheme you pay only CGST, SGST. Why? Your outward supply is always intrastate, but RCM is inward supply. It can be CGST, SGST or IGST, and the rate can be normal rates 5 or 12 or 18 or 28. It's not 1% or 5% or 6% because it is all about your inward supplies. And another special point about RCM. There are 3 special points about RCM under composition scheme. One, normally in composition scheme you pay CGST, SGST, but here it may be CGST, SGST or IGST. Second, normally under composition scheme you pay 1%, 5% or 6% as the case may be. Here you will pay normal rate. Third, normally if at all you are under regular scheme you pay RCM tax and take credit. Here you will pay RCM tax but you cannot take the credit. Next, when you talk about composition scheme, what are the disadvantages of composition scheme? You cannot take credit and you cannot collect tax. On your inward supplies, you cannot take credit. On your outward supplies, you cannot collect. Disadvantages of composition scheme. Now, will you be under composition scheme forever? No. Only till your aggregate turnover of current year is up to. This we have covered in our discussion. Right, this aggregate turnover is relevant for previous year, entry point, current year, exit point. Current year, exit point. And last point is also a restriction that if I am working in multiple states, I cannot tell that one state composition scheme, one state regular scheme. If I want composition scheme, it has to be all the registration I should work under composition scheme. Corollary of that is, if from one state I am removed from composition scheme, I am removed from composition scheme automatically in all the states. All the states. That one needs to understand. That is all about the conditions for composition scheme. All the conditions are of current year except for the 2 points or 2 conditions, main conditions being of previous year. aggregate turnover, entry point, and manufacture of notified goods, which is of both current year as well as previous year as well as current year. Now, conceptual portion of composition scheme we are done with. Now, few points here and there. Questions part, whatever was asked in the questions, we are done with. Your questions will revolve around the discussion that we had. Few points here and there. One, you are talking about entry point. One, you are talking about exit point. When to come in, how to come in, when to go out, how to go out. When to come in, how to come in, when to go out, how to go out. So when you're talking about entry point, two categories: existing registration, and new registration. Existing registration will have complications, which means I'm talking about switch over from regular scheme to composition scheme. Here directly I'm going to composition scheme. So existing registration, I have to give an intimation. That I want to go for composition scheme. And I have to give this intimation prior to commencement of next financial year. Supposing I want to go for composition scheme from 1st of April 2023, I have to give intimation before 31st March 2023, before the financial year starts. And that intimation, that composition scheme will be effective from 1st of April of 2023. I have to give intimation. If I fail to give intimation before the commencement of next financial year, forget about composition scheme in that year. I have to wait another year. So I have to give intimation. And another important point, that I have to give a statement. So when I enter inside composition scheme, we have discussed this in our ITC topic that switch over from regular scheme to composition scheme means you have to reverse ITC. So you have to reverse ITC contained on inputs and capital goods, for which you have to file a form within 60 days from 1st April. And also we have discussed that whether you file in time or not in time, you have to reverse ITC. If you do in time, you will reverse only ITC. If you don't do in time, you have to reverse ITC with interest. Are you clear on this particular understanding? Reversal of ITC. And if at all I am continuing inside composition scheme, first year I have gone, next year I want to go. When you am continuing, intimation is not required. If I am switching over, intimation is required, regular scheme to composition scheme. If I am under composition scheme this year, next year I want to continue, intimation is not required. This is all about the first category. Second category that has been highlighted in your orange sheet, that we are talking about new registration. New registration, you can enter inside composition scheme in between the year when you are filing your registration form GST REG 0001. When you are switching over, you have to start from 1st April of next financial year. But when you are entering inside GST for the first time, new registration, you can select I want to go for composition scheme. That can be in between of a year. That can be on say your 17th October also, 18th October also. That is fine. But you have to select that when you are filing your registration form. And it will be effective from the effective date of registration. Here, there is no question of any reversal of ITC because you have never taken any ITC. Only after you are registered, you can take ITC, right? So, you are taking new registration. So, there is no question of any ITC. Right. So, that is that. Now, you are talking about your exit point. That is all about your entry point. Exit point. Exit can be of two categories. One, respectful exit. One, disrespectful exit. One, you are going out yourself. Other, proper officer is throwing you out. So, one, you are talking about assessee going out himself. Other, officer is throwing you out. When you are going out yourself, it can be again of two subcategories. One, you are going out because you are not satisfying certain conditions. Which means you are CTP, NRTP now, or you have started dealing with interstate outward supply, or dealing with non-taxable supply, or you have started dealing with notified manufacture of notified products, or you are supplying through ECO where TCS is applicable. Suddenly your turnover crosses 150 lakhs, 75 lakhs, 50 lakhs as the case may be. So you don't have an option. You have to go out. You have to give intimation within 7 days. So when you are going out, the switchover is all from what? Regular composition scheme to? So in regular scheme, what document will be giving? Tax invoice. Now you can take credit, you can collect tax, everything will happen. Second is a scenario where you are going out yourself. You are not violating any condition, but you are not happy with composition scheme. You are not happy with composition scheme. So you have to just file an application telling that okay. Here there cannot be any 7 days and all because you are going out on your own without any force. There is no violation of condition. Right. Second, proper officer is throwing you out. So proper officer will give show cause notice telling that you have to go outside because you are not eligible for composition scheme, or you are eligible but you have violated certain conditions later on. Assessor will reply within 15 days of show cause notice. Then officer will decide within 30 days of reply whether to accept the reply and drop the proceedings or to reject the reply and throw you out from composition scheme. But they are very clear. Whenever officer is throwing you out, he cannot throw you out right from the beginning. He can throw you out when you actually violated the condition. Right. Whenever you are going outside composition scheme, you can take credit. And we have already discussed in ITC chapter that you have to file a form within 30 days. 30 days. So that you can take the credit of stock of inputs as well as capital goods, because it is composition scheme to regular scheme, both inputs as well as capital goods. So you have to file a form within 30 days. And when you are going outside composition scheme, you are not going outside composition scheme only in that state, you are automatically thrown outside composition scheme in all the other states. So that is all about your entry point and your exit point. Now what is the tax that you are going to pay? Last part. What is the tax that you are going to pay? Normal composition scheme. Manufacturer 1%. Any other supplier covers trader 1%. Both will pay 1%. But that's the difference. Manufacturer will pay on taxable supply plus exempt supply, whereas trader will pay only on taxable supply. Restaurant and outdoor caterer, supply of food, they will pay 5%. Taxable supply as well as exempt supply. Whenever payment is there, it is aggregate turnover or state turnover. Whenever payment is there, it is aggregate turnover or state turnover. Payment computation means state turnover. Right. This is all about normal composition scheme. Special composition scheme. Which means you are purely a service provider or you are dealing with both goods and services, but service is more than the limit given in normal composition scheme. It is 6%, both taxable and exempt. Clear? There is a very complicated chart given here, which is actually of no use. I can complete it in one word. Interest on loan will not be counted anywhere inside composition scheme. Interest on loan will not be counted anywhere inside composition scheme. Whether it is the previous year aggregate turnover or current year aggregate turnover or current year state turnover, it will not be counted for composition scheme. For checking the entry, for checking the exit, for making the payment, for checking the inner limit. These are all the places where you see turnover, correct? Checking the entry point, previous year turnover, aggregate turnover, 150 lakhs, 75 lakhs, 50 lakhs. Don't count interest on loan. Current year aggregate turnover, for checking the exit point, 150 lakhs, 75 lakhs, 50 lakhs. Don't count interest on loan. Checking the inner limit of service in normal composition scheme. Right. So it is 10% of previous year state turnover. Don't count interest on loan. Payment of taxes current year. It is state turnover. Don't count interest on loan. Interest on loan is not at all counted in composition scheme. Right, ICI once again, ICI wakes up time and again, and it shows that what it is capable of. Right, this one example, I think now when you are clear with the concept, so things would be very, very clear. Basically, you are dealing with, say, only goods. You are dealing with only goods, and you want to enjoy both threshold limit for registration as well as you want to enjoy composition scheme. You want to enjoy both. You want to enjoy both. So when you crossed your 40 lakhs, when you crossed your 50 lakhs, when you crossed your 150 lakhs, when you crossed your 165 lakhs, right? These are the different timelines that you would pass through. When you crossed your 40 lakhs, when you cross your 40 lakhs, your turnover of goods was 30 lakhs and interest on loan was 10 lakhs. When you cross your 50 lakhs, goods turnover was 38 lakhs, interest on loan was 12 lakhs. When you touched your 150 lakhs, goods turnover was 137 lakhs, and interest on loan was, say, 13 lakhs. When you cross 165 lakhs, goods was 150 lakhs, interest on loan was 15 lakhs. You want to enjoy both. You want to enjoy both. Tell me when you will get the registration and what will be the, and finally wait, I stop here, end of the year. So it is 190 lakhs. 190 lakhs, goods is, say, 170 lakhs, interest on loan is 20 lakhs, end of the year. This question can be worth minimum 6 marks. It can be even asked for 8 marks, but not be surprised. You have to link many concepts. Yes, tell me. He wants to enjoy both, and to be very clear, he is there in the state of Maharashtra. So without any doubts, otherwise which state would be a question? He is there in the state of Maharashtra. First of all, is he eligible for 40 lakhs? Yes. Goods plus interest on loan, still eligible for 40 lakhs. If I want to make it more complex, obviously space is not there. I would purposefully give 20 lakhs. Purposefully give 20 lakhs. Now tell me, when he is going to get registered? After walking 40 lakhs or after walking 50 lakhs? So he is going to get his registration after 40 lakhs. He will get registered here. Because when you talk about registration, interest on loan is counted. Though you can enjoy 40 lakhs, but interest on loan is counted. Now when he is registering, he will go for composition scheme. So 50 lakhs was not relevant. Now, till how long he will be enter composition scheme? 165 lakhs. Again, when you are talking about 165 lakhs, you will start from zero, including the earlier part. You will be under composition scheme till 165 lakhs. You will not add more 150 lakhs and all. From the beginning you will count. From the beginning you will count. So, but what will be the composition tax that you will pay? Composition tax that you will pay? Incorrect. You tell me the number. I don't want ifs and buts stories. You tell me the number. Your answer is right that you will get registered when you are crossing 40 lakhs. You will go for composition scheme the same time, and you will exit when your turnover is 165 lakhs because interest on loan will not be counted for composition scheme. Okay, composition tax that you will pay. Composition tax that you will pay. When you are touching 165 lakhs, what is the goods turnover? When you took registration, what was the goods turnover? Why you will pay on 30 lakhs again? You will not pay. 120 lakhs multiplied by, depending on what you are here, it's goods. So like 1%. Right. Finally, what will happen? You will also pay regular tax. You will also pay for this time. See, if you see this, there is no tax initially, then there's composition tax, and finally there will be regular tax. So what is the regular tax that you will pay? Regular tax 190 minus 165, so which will give you 25. No, incorrect. Interest on loan is still exempted. Interest on loan is still exempted. So you will again only pay on goods. 170 minus 150. 20 lakhs multiplied by regular rate. Now I am ignoring interest because it is exempted. I am ignoring interest because it is exempted. So this you need to understand. So that is the maximum ifs and buts that you can expect in this story of threshold limit and your composition scheme. Everything about your composition scheme as well as everything about your threshold limit for registration.